Welcome to the annual Emerging and MWBE Investment Manager Conference. My name is Wendy Garcia, and I'm the Comptroller's Chief Diversity Officer. My position of First in New York City is to champion diversity across the city of New York. My focus is to ensure that the city uses its financial power, from contracts to investments, to level the playing field for women and people of color. I work every day to keep systemic racism and exclusion outside of the halls of government. Today, you're going to be hearing from our New York City Comptroller, Scott Stringer, and our CIO, Alex Donye, who will be outlining the office's efforts to address systemic racism and inequalities in the industry of asset management and strategies that are meaningful for sustainable change. We will also be providing for you an opportunity to learn how to do business with our office. We will be having one-on-one sessions with all our asset class heads and our consultants. And we will be honoring our day-to-day practitioners for their commitment to diversity and inclusion. We know that this is critical information for each of you watching, especially in these challenging times, because just this year, the COVID pandemic disproportionately impacted the health and the wealth of communities of color, shuttering minority and women-owned businesses at higher rates across the country. From New York to London, Black Lives Matter, the biggest demonstration in history, demanded that governments actively put an end to institutional racism, with more than 20 million people marching across the globe just this summer. And the Wall Street Journal just recognized that in the next year, chief diversity officers would be seen as critical in 75% of large businesses. So up next, we're going to be hearing from our New York City Comptroller, Scott Stringer, whose leadership has paved the way for citywide officials to prioritize equity. He has been bold in doing what is necessary to challenge the status quo on how we do business in the city. And he was the first official to call on the Charter Commission, which governs the city's constitution, to appoint chief diversity officers in City Hall and in every agency. In addition, he was the first comptroller to consistently ask the hard question and grade 32 city agencies on how they're spending with minority and women-owned businesses. And his push for accountability and transparency has pushed the city to get their act together, having over 21 to 5 underperforming agencies in just the last 7 years. And because 5 is still way too many agencies, the comptroller told the mayor that moving forward, every city agency that will have to show us justification for any contract submitted to our office with a goal under than 30%. And he has never forgotten that this work starts from the inside out, making sure that we're not just asking the city of New York to try anything that we haven't already done ourselves. He's held his own office accountable, growing our $14 million procurement budget, spending with MWBEs from 12% to 50%. So I am very proud to have worked with him throughout his administration, because I have watched how his integrity, his honesty, and his relentless work to set the tone for our office and our city has shined. Up next, New York City Comptroller, Scott Stringer.
Thank you very much, Wendy. It's been a pleasure to work alongside you. Welcome to our annual Emerging MWBE Manager Conference. I'd like to start by thanking the trustees of the New York City Pension Funds. Your commitment to supporting New York City retirees and their families is unmatched. And of course, thanks to all of you for joining us here today from all over the country. This is our 7th annual Emerging and MWBE Manager Conference. Now more than ever, this conference is a critical opportunity to take stock and plan our strategy to deliver strong results for our frontline workers, the teachers, firefighters, police officers, and city workers who keep our city running. We have been able to make great progress, not just in New York City, but across the industry. The pension funds investments with firms led by women and people of color have grown by 70% since 2014. Last year at this conference, I set a goal to allocate 12% of our assets to MWBE firms. I'm proud to say that we've hit that goal, and currently $14.9 billion, or 12%, is invested and committed to MWBEs. And today, we're moving the goalpost even further and setting a target of over $1 billion in new commitments to MWBEs. Because we know that leading with our own funds will give the best and the brightest in the business a fair chance and set the momentum for everyone else. Last year, we launched Boardroom Accountability Project 3.0. We called on 56 predominantly S&P 500 companies to consider both women and people of color every time they seek to hire a new board member or a CEO. I'm proud to say today that as a result of our efforts, 13 companies have implemented the Rooney Rule in the last year, and we've sent shareholder proposals to 21 companies that were unresponsive to the initial letter. This past year, we also launched a new program to source and engage qualified diverse managers with webinars and workshops throughout the year. We've worked closely with our consultants. We've engaged with 80 diverse managers. We're going to build on that momentum and engage with MWBE investment managers through MWBE University throughout the coming year. And we're going to take it a step further and ask all consultants to provide a rationale and justification when they do not recommend MWBE investment managers. My office will also launch a comprehensive diversity and inclusion assessment to hold New York City pension fund managers accountable. We're also going to recommend to the New York City pension fund trustees that all companies that do business with the Comptroller's Office, including investment managers, present a plan outlining their diversity, equity, and inclusion strategies and goals. Diversity must be front and center in conversations about wealth creation. Today's dialogue provides this shared sense of purpose and mutual foundation we need to walk the walk in this critical work. Up next, you're going to hear from our CIO, Alex Dunier, who has a long track record of doing the work that makes New York City proud. He is a fabulous CIO. He's done a great job in these trying times, and he manages a staff that is pretty incredible. So I'm glad to be here with you. I wish we could all be here in person. Next year we will be. Thank you.
Good morning. On behalf of Comptroller Stringer, our pension board trustees, and the dedicated staff at the Bureau of Asset Management, BAM, I would like to welcome you to our annual Emerging and MWBE conference and our first virtual event. I would like to thank Comptroller Stringer for his extraordinary leadership and for all that he has accomplished leading this office over the past 7 years. Comptroller Stringer has been unrelenting in his focus to not only promote responsible business practices at corporate boards globally and drive robust diversity, equity, and inclusion initiatives with investment firms across our portfolio and throughout all the departments within the Comptroller's office. But he's also grown and protected the retirement benefits of over 730,000 beneficiaries, all while delivering results well above our 7% target rate of return. And he's nowhere near done yet. So thank you, Mr. Comptroller. I would also like to thank our pension board trustees for all of your hard work and dedication on behalf of the pension fund's beneficiaries. I would like to acknowledge all of my colleagues at BAM, the Bureau of Asset Management. I am fortunate and grateful to be surrounded and supported by a highly talented and experienced and dedicated group of professionals who come to work each and every day and put in 120% to help achieve our collective goals and objectives. To help me lead this team is the Office of the CIO, which includes Mike Haddad, Deputy CIO, and Kara Schnapper, Chief Strategic Planning Officer, and the senior staff team comprised of Assistant Comptrollers Brian Cook, Michael Garland, David Jetter, and Susanna Vickers, and our Chief Compliance Officer, Chachibot. Thank you for your partnership. This morning, I will be sharing with you details on the current state of the New York City pension funds and continue to outline our priorities and strategic initiatives. As of fiscal year June 30th, 2020, the AUM of the 5 plans totaled $214 billion. Each plan has its own general consultant, and there are various alternative asset class consultants that represent multiple plans. You will have the opportunity to meet with them later in our breakout sessions. Except for short-term investments, all of the plan's assets are managed externally. Asset allocation and manager selection are recommended by BAM and the general consultant and require board approval. Now, here in the slide are net returns for the fiscal year ended 2020 by system. Although performance fell short of our target, we are proud of these results, particularly in light of the global pandemic and its market impact. Furthermore, if you look at returns over a longer-term horizon, either 5 years or back to when the comptroller took office in January 2014, we have generated strong returns and exceeded both our benchmarks and our 7% assumed rate of return. We thank our managers for this achievement. Now, here in this chart, you can see the strong and steady growth in our AUM over the last 10 years. It's grown from approximately $98 billion in June of 2009 to $214 billion of AUM today. After witnessing the longest bull market in history, we came into 2020 prepared for a period of higher volatility and overall lower returns. However, no one was prepared for a global pandemic and its devastating impact on economies and markets around the world. Although markets have recovered, with US markets hitting new all-time highs as a result of unprecedented monetary and fiscal stimulus, recent excellent news on the effectiveness of vaccines in late-stage trials, and a contentious US presidential election that appears to be near officially settled, we understand that we are not out of the woods yet. Virus cases and hospitalizations have been surging at a pace not seen since the early days of the pandemic. Partial shutdowns are being pursued in certain regions and cities, and only about half of the 22 million jobs lost in the US have been recovered. As a result, we continue to take a cautious and defensive position with our investments, while at the same time being opportunistic and taking advantage of market dislocation. Now, on this very busy slide is a snapshot of our current portfolio, broken into the major categories of our asset allocation. Now, we maintain a strategic approach to investing with a long-term view. And as such, it is important for us to be diversified across asset classes and geographic regions to take advantage of market trends and other tactical shifts when warranted. We have growth assets, which includes equities, both public and private, alternative credit, non-core real estate, and hedge funds, among others. And that's approximately $145 billion of plan assets. It's the largest part of our portfolio at about 68%. We have the deflation hedging assets, which includes treasuries, mortgages, and investment-grade credit. And those are about $48 billion, or about 22% of the portfolio. And we have assets that provide inflation protection, such as TIPS, core real estate, and infrastructure, at about $21 billion, or 10% of total combined plan assets. Now, in our breakout sessions, you will hear from our asset class teams and consultants on specific areas of interest and manager opportunities. Now here, looking at the breakdown of our assets by type of manager, with a focus on emerging and diverse managers as of June 30th. Now, we are proud that we've been able to continue to grow the allocation to small and diverse managers. On this graphic, we focus on actively managed assets, as our passive portfolio is comprised of index fund managers. Now, globally, about $24 billion of the plan's AUM, or nearly 16% of actively managed assets, are managed by small and diverse firms. And we are working diligently, consistent with our fiduciary obligations, to continue to build on that success. Now, here's a further breakdown of our assets by asset class, now with the focus on just diverse managers as of the fiscal year ended June 30th. What we are showing here is the percent of U.S. actively managed assets in the aggregate and by asset class that is currently managed by MWBE managers. Again, I'm excited that we have been able to grow the allocation to diverse managers and have met the 12% goal we set last year. Today, nearly $15 billion, or 12% of U.S. actively managed assets, are managed by MWBEs. We have high allocations to MWBE managers in infrastructure, private equity, public equity, and hedge funds, as you can see on the right-hand side of the table. However, we have more work to do in other asset classes, such as public fixed income, real estate, and alternative credit. Now, later in the presentation, I will discuss the strategies that we are pursuing to increase our allocations to diverse managers across all asset classes. Now, BAM and the Bureau of Asset Management is also focused on minority brokers and business enterprises, known as our MWDB-BE brokerage program. With this program, we encourage current investment managers with whom we invest to attain certain trading goals with MWDB-BE brokers. Now, through this initiative, BAM seeks to provide opportunities for brokers to execute trades on behalf of the system's investment managers using the latest trading technology and best execution practices. The program commenced in July of 2008, and we currently have 14 active broker-dealers. Now, you can see in this table our trading volume goals listed by strategy. We are proud to have met or exceeded our goal in nearly all categories, and we are working with our investment managers to ensure that we hit our government bonds goal as well. Now, another very important part of our portfolio is our economically targeted investments, or ETIs. 2% of total pension assets are allocated to ETIs. Currently, 1.5%, or over $2.8 billion, is currently invested or committed. This portfolio has historically targeted affordable or workforce housing for low, moderate, and middle-income neighborhoods in New York City. But it is not limited to just that. And there is the ability to make investments in other projects that benefit these targeted communities. Now let's review BAM's strategic priorities. First and foremost, as fiduciaries, our primary focus is to maximize risk-adjusted returns. Earlier this year, each of the 5 New York City pension funds approved a new strategic asset allocation, and we are working closely with each system's general consultant to implement their respective plan. And we're also focused on continuing to develop and strengthen our staff. We have recently added several new members to the team. You'll have an opportunity to meet and hear from them at the breakout sessions. We are working with our boards to broaden our investment capabilities, from expanding the geographies where we are looking to invest to launching co-investment platforms in private equity and real estate to go along with our existing co-investment platform in infrastructure. Now, we are also continuously improving our operations and risk management capabilities by leveraging technology and upgrading our systems. Now, as we continue to devise new strategies to expand engagement with MWBEs, we're also looking to increase allocations to diverse investment managers. Next slide. So what are we doing to prudently increase allocations to diverse investment managers? As you heard from Comptroller Stringer, we met our goal to allocate 12% of actively managed assets to MWBEs, which included our recent $1.7 billion commitment to first-time funds and early-stage managers in private equity, real estate, alternative credit, and infrastructure. Our partners who manage these programs, Neuberger Berman, Grosvenor, and BlackRock, will be presenting in our breakout sessions, and we'll also host one-on-one meetings during our networking session. So what's new for 2021? First, we have set a new goal to commit over $1 billion of new capital to diverse managers. We will also launch a comprehensive diversity, equity, and inclusion assessment of the investment managers in our portfolio. This tool will allow us to measure, monitor, and track over time manager performance across various DEI metrics, including senior leadership and overall team gender and ethnic diversity, hiring, attrition, and promotions, and board gender and ethnic diversity, both internally and at portfolio companies where applicable. We have expanded our MWDBBE program to include high yield as a new target asset class. And we are proactively working to increase the number of small and diverse managers that are transitioned to direct allocations. Next slide. So, as you can see and have heard this morning, despite many challenges this year, we had a strong 2020. We met our allocation goal to MWBEs, and we delivered on many strategic priorities. As we turn the page on this year, which I know many of us are anxiously awaiting, there's much to look forward to. I am confident that working together, we will be able to continue to foster the growth and development of diverse firms, increase our allocations to MWBEs, and deliver strong risk-adjusted returns for the beneficiaries of the New York City pension funds. Thank you for your partnership and continued success to you all. In closing, I would like to extend special thanks to Elena Gilligo, our first Deputy Comptroller. Thank you for your leadership. Also, thank you to Susanna Vickers, our Assistant Comptroller for Pensions and Designated Trustee, Wendy Garcia, our Chief Diversity Officer, the entire staff at the Bureau of Asset Management, the conference planning team, and all of our panelists and speakers today. Thank you for making this event possible. And last but certainly not least, a special thanks to all of you for taking the time to attend today. Please enjoy the rest of the conference and have a great rest of the year.
Alex, thank you for that tremendous presentation. Please give Alex Dunier, our amazing CIO, a big round of applause. I want to hear it out in the streets from every building. Alex does an amazing job. And I also want to thank our Chief Diversity Officer, Wendy Garcia, who has also built this platform and made so much of what we've done possible. And of course, I want to thank our first Deputy Controller, Elena Gilligo, as well as our trustee, Susanna Vickers. This is the A-team of investment strategy, and I'm really proud of them, and I'm really glad to see all of you. I am very pleased to present to you the 5th Annual Controllers Diverse Practitioner Awards. These awards honor firms with diverse leadership who head an inclusive investment organization. I enjoy giving out these awards every year because we showcase those who are not just talking the talk, but who are walking the walk. So first, I'd like to bring up Vivium Capital President and CEO Lawrence Bancroft and Managing Partner and Chief Investment Strategist Kai Hong. The award winners for the Controllers Award, I don't know where you go from here, but getting this award is probably one of the great national awards you can get, and it's well deserved. So thank you very much. Let me just tell people a little bit about Vivium Capital. We've had the honor of partnering with Vivium since 2017 in our efforts to invest in emerging and MWBE managers. As a fund of funds, they're charged with finding and investing in smaller, top-performing managers. And also, they have their work has helped form the pipeline of talent that we need and so many others rely on. So I'm really glad to present to you the 2020 Diverse Practitioners Award for all that you've been doing. Thank you.
Thank you. Good morning, everyone. Controller Stringer, Deputy Controller Dunier, members of the Board of Trustees and staff, and all invited guests. Again, I'm Lawrence Bancroft, and it's a pleasure to meet with you this morning and to accept this award on behalf of Vivium Capital Partners. I would be remiss if I did not also recognize my fellow award recipient, Tammy Jones. I know I'm stealing her thunder a little bit of Basis. I'm also a very big fan of all the work that you and your company has been doing. It is indeed an honor to share this recognition with you this year. It's funny, when I received notification that our firm would be receiving this award for our commitment to diversity, I was somewhat taken aback. And, I chuckled a bit because to me, it felt like I was receiving recognition for breathing, as diversity is akin to a natural reflex for me and necessary for life. But one of the many things I've learned this year is that what is second nature for me is not necessarily the case for others. As as the great city of New York, diversity is a core commitment for Vivium, has been so since our very beginning, since our inception. During our investment committee meetings, when we would have these in person, I would look around our conference room table and see that we represent 7 countries and 5 continents. Close to half of our team are women. I often took this diversity for granted, but then as we would discuss ideas, it would hit what an incredible mosaic of experiences, perspectives, and ideas we are bringing to bear for our clients. We strongly believe diversity of thought leads to better decisions. Fitting that the plan beneficiaries we serve and the diverse city of New York mirror one another. In fact, 30% of New York's residents are foreign born, and I'm proud to say that I'm part of that immigrant cohort and a product of New York City public schools. I'm blessed to have lived in 3 of the 5 boroughs, but I got to claim Brooklyn. And much of who I am, has been essentially informed by those early experiences. And experience, as they say, is a great teacher. Over my career, I've learned that management skill are as important as relationships, especially when it comes to truly unlocking access and opportunity. Consequently, I'm very grateful for inclusive ecosystems and nonprofits such as NASP, NAIC, Numerica Alliance, AIM, SEO, Robert Twigo Foundation, and many, many others who work tirelessly to access and opportunity. Now, this year, opportunity, inclusion, and diversity are trending words that have taken center stage and become part of our national consciousness. This moment in U.S. history has morphed into a movement, prompting the very important question: how do we leverage the gravity of where we are as a nation to help our country fully realize its enormous potential? Everyone, as Dr. King has put it, can bend the arc of history. As with the CEO charged to level the playing field, it has to start at the top. If not, a company's diversity efforts will likely fall short or fail. There must be respect for everyone. Knowledge of other cultures must be increased, and ecosystems must be expanded. These efforts cannot end when these words stop trending. These actions must be taken until diversity is a natural reflex, like breathing, and this award will no longer be necessary. Thank you so much, Controller Stringer, for your long-standing commitment to recognizing the return on investment of diversity. Very important. With gratitude from all of us here at Vivium Capital Partners, thank you so very much. We received the award in the mail. Wish I was there to shake your hand and take the picture with you as usual, but I look forward to that next time we connect. Be safe, and thank you again.
Well, let me just say thank you for your very powerful message. And I look forward to next year being able to shake your hand and take that picture, because you are the gold standard of what we're all trying to accomplish. So thank you for those powerful words. Once again, let's give a round of applause in our living rooms and wherever we are to say thank you very much. And as you mentioned, let me mention also your co-honoree today, Basis Investment Group. I want to now recognize Basis and their president, the CEO, Tammy K. Jones. Basis has been an emerging manager and MWB partner with New York City since 2017. And Basis leads pipeline initiatives to make sure the future of the investment industry is even more diverse. And I have to say that you've been a true partner by making sure that 50% of their vendor dollars are going to MWBs. And they've loaned over $6 million to MWBE real estate companies and investors. So it's a great pleasure to award them with the 2020 Diverse Practitioners Award. Again, practicing what we preach and setting the gold standard. So please, Tammy, please give us your words, and let's all give a round of applause to Basis, the award.
Well, good morning and thank you, Controller Stringer and Deputy Condonier and the entire New York City team. This is a great honor to receive this award, and I was truly blown away by this. I'm going to accept this award on behalf of Basis Investment Group and our amazing team, but also on behalf of our foundation, Basis Impact Group, and also Real Estate Executive Council. So anyone who knows me knows that I have tried to be a champion for diversity and inclusion throughout my entire career. And we have taken some steps forward, and unfortunately, we've taken some steps backwards. And there hasn't nearly been enough progress made. There are still too few African American and Latino and even female investment management platforms that have been able to scale. And our biggest challenge is access to capital. When I formed Basis 11 years ago, I wanted to be the change that I wanted to see. And 78% of our team is comprised of women and minorities. We have invested and loaned over $800 million with other minority and woman-owned commercial real estate investment platforms that are qualified. And as Controller Stringer mentioned, 50% of our vendors are minority and women-owned. But that said, there is still so much work to do. And I am so grateful for my partnership with New York City, not just because they gave Basis an opportunity, but because they have been driving real change in this industry. And finally, I am going to cherish this award because for me, it's that glimmer of hope and that reminder that the work really matters. So thank you all again for this amazing recognition. Enjoy the rest of the conference.
Thank you for that wonderful, wonderful presentation. And I'm very proud to be associated with you. And thank you so much. For those of you who are wondering why my books look like they're going to fall on me, I get asked this a lot. They are not going to fall. That is a spiral bookcase that my wife brought with us to our marriage. And people ask all the time. So I thought rather than have the buzzing, I would just set it straight. The bookcase will not fall. But in any event, let me thank all of you for coming and being part of this. I'm very proud of the work of the Controller's Office. I'm very proud of the people who spend a whole lot of time making sure that we find equity and justice in investments. This office has given me great pride as we build this out. But as we are reminded by the awardees, the work is not done. In fact, some would argue we haven't even scratched the surface. There's so much more to do, and I look forward to working with all of you in the future. With that said, let's bring back our amazing CIO and Deputy Controller, Alex Bernier, who's going to lead us through the next session. And again, I'm very proud of all of you. I thank you. Please be safe. New York City's days are just ahead of us, and we're going to come back bigger and stronger than ever. Thank you very much.
Well, good morning, everyone. Good morning, panelists.
Good morning.
And good morning, everyone, once again. I am very excited for this panel discussion this morning on a very important topic that's impacting our nation. This panel will explore the role of the asset management industry in driving initiatives that address systemic inequalities and advance equity and social justice, and ensure that change is both sustainable and meaningful. Now, first, let me begin by briefly introducing our distinguished panelists and having each of them tell us a little bit about themselves and their role at their respective organizations in the area of diversity and inclusion. Now, first we have Pilar Avila, a leader in the asset management industry for over 20 years, and someone who has worked very closely with pension plans across the country on diversity, equity. Pilar, good morning.
Good morning. It's great to be here. Thank you for having me. As you mentioned, I spent most of my career in asset management, both in the industry in private equity, but also as founding executive of New America Alliance, and for 12 years, the CEO of the organization. It is a pleasure to be here. Thank you.
Thank you, Pilar. Next, we have Brenda Chia, who was the first president of the Association of Asian American Investment Managers, or AIM, and is the current board chair. Welcome, Brenda. I think you may be on mute, Brenda. Let me go to the next panelist and maybe we can work on Brenda's audio. Next, I will turn it to Tammy Jones, a recipient of the Diverse Practitioner Award. Congratulations again. Tammy is the first female chair of the board of directors of the Real Estate Executive Council, and also the co-founder and head of a commercial real estate investment platform, Basis Investment Group. Welcome, Tammy.
Hi, good morning, everyone, again. Can you guys hear me okay? So happy to be here and happy to be a part of this discussion. As Alex mentioned, I am Tammy Jones, and I am the chair and founder of Basis Investment Group, also the chair of Real Estate Executive Council. Basis is a commercial real estate investment platform that focuses on investing and lending in the middle market. Since inception, we've closed over $4 billion, investing and lending in 47 states. And I'm very proud of our team. And I'm looking forward to talking about diversity and inclusion on this panel. Critical topic. Diversity is in our DNA, as I often say. And I'm looking forward to a robust discussion.
Thank you, Tammy. And we have Robert Rabin, who's president and founder of the Rabin Group, a national public policy and strategic communications firm with deep roots in advocacy for communities of color and the LGBTQ community. Before starting the Rabin Group, Robert was also the assistant attorney general under President Bill Clinton. Good morning, Robert.
Buenos dias. Thank you for having me, Alex. This is a really, really terrific panel. I'm excited to have a conversation with you about what we're doing to bring people of color into asset management in a way that would meet the performance standards and metrics people say they're interested in. So I'm eager for the conversation. Thanks for having me.
Thank you, Robert. I'm going to try to go back to Brenda Chia. Once again, Brenda, are you back?
I might just introduce myself. I'm Suzanne Donahoe. I'm a partner at KKR and head the strategic growth effort, and also co-chair our Inclusion and Diversity Council, which I've been a member of for the last 6 years. We formalized our effort at KKR. I'm thrilled to be here today with the other panelists. Congratulations to Tammy. It's quite a distinction for Basis, and wonderful to see you receiving this award. And maybe Alex is back at this point.
Sorry for the shaky screen. I'm transferred to my iPad. Delighted to be on the panel today. I wear two hats. The first is I'm a director at Paladin Capital Group, which is a tech investor in deep tech and cybersecurity. The work from home trend, while interesting, has really put a spotlight on security for everybody. So it's been an interesting year from that regard. The other hat I wear is that I am board co-chair of the Trade Association for Asian American Investment Managers. The mission of AIM is to elevate underrepresented groups through education, networking, and policy. We have about 4,000 people in our network, and New York City BAM has been a supporter since the founding of the organization in 2006. Happy to discuss both Paladin and AIM today.
Let me just jump right in and apologize for the technical difficulties. Let me set the stage for our discussion this morning. 2020 has obviously been quite the year, very difficult, unprecedented. First, we've been hit by a global pandemic that no one could have predicted. The coronavirus has had and continues to have a devastating impact on the US and countries around the world. In the US, unfortunately, we now have up to nearly 280,000 deaths succumbing to the virus, and we've lost over 22 million jobs. Only half of those have been recovered to date. And as we heard this morning, we had just disappointing job numbers. So our growth in jobs that we've experienced over the last couple of months, several months, has been slowed down dramatically in the report this morning. So this economic downturn is also having disproportionate impacts on communities of color and small businesses. Second, we witness natural disasters and record-setting weather events that have ravaged the United States. We've had the most destructive wildfire season in the Western US and a hurricane season that has been the busiest on record with 29 named storms as of the end of November. Third, a contentious US election that appears to be nearly officially settled, but with an incumbent president that continues to challenge the results. And fourth, we've witnessed social unrest and mass protest on a large scale across the US against social injustice and racial and economic inequalities. So I would like to spend our time this morning kind of focus on that last point and discussing it through the lens of the asset management industry. The asset management industry continues to lag in the area of diversity, equity, and inclusion, despite countless studies that prove that diverse teams lead to stronger performance and better results. Now, let me begin with you, Robert. As someone who's not only participated in some of these studies, but who is a thought leader in the space and who has dedicated his life's work to the pursuit of social justice. What does the research tell us? I mean, whether it's the Knight Foundation, the McKinsey study, and numerous other studies, what does the empirical evidence show?
Thank you very much, Alex. The empirical evidence shows what women and people of color already know, that there is a pool of talented people of color and women in the United States who are capable of performing at the highest levels of asset management, and that there is a palpable underutilization of them. Well, I'll sort of tick through the studies. I'll also let you know that they're publicly available and you can find them in various sources. One-stop shopping for you would be the diverseassetmanagers.org. Diverseassetmanagers.org has all of the studies in one place. But let me tick through them. First, let me pull the lens back for a second. That you have to prove empirically that which is obvious to the eye and culture is sad. But asset management portends to be a data-driven industry. And those of us who care about making change, that is making sure that women and people of color are fully participating, felt that providing empiricism would be appropriate, both in a data-driven industry and it is a truism in public life. You can't get to people's genuine objection until you satisfy their disingenuous objection. So the number of people, mostly white people, who want to see a business case for why we should be working with people of color is strong. There's a lot of people who say that. I think it's sad that people, need to be proven why they should be working with people of color. But we went through the exercise of providing those numbers. It started with GAO, which is an arm of Congress. They were asked to study the federal pension plans, which are the largest pools of capital in the United States. And those studies, the GAO website, but also at the Diverse Managers Initiative, they show virtually no participation by women or people of color in the hundreds of billions of dollars in federal assets. The next important bodies of study are what's known as the Knight Foundation studies. Diverse Asset Management worked with the Knight Foundation to retain Joshua Lerner of the Harvard Business School. He worked with his team at Bella Research, and they put together two studies to show two different things. One, the pool of talented minority asset managers, that we don't have a problem in the United States, we have a demand problem. And then the second study showed underutilization, that minority and women asset managers perform at par with asset managers. There is a dearth of utilization. Approximately 1.7% of all assets in the United States are managed by women and people of color. So, as I said, we have a demand, not a supply problem. The follow-on studies, and then I'll stop. Stanford University worked with Illumin Capital to put out one of the most troubling and interesting studies in the nation that I've seen in this area, which showed acute bias among the highest performing asset managers. That is, the better that Black and Hispanic asset managers did, the more bias there was. And it's a fascinating and sad revelation, the degree to which white people don't trust minority performance. When they see it, they're suspicious of it, rather than saying, hey, find me more talented Black and Hispanic people just like that. I'll stop there. It's important that people see the study, but I'll repeat an important point. It's a little unfortunate that people needed to see data that they weren't working with Black and Hispanic and Asian people. It was acutely obvious before the data.
I agree with that,
Hey,
Rob.
Alex.
Thank you. And Brenda,
Alex,
turning to you. Hold on, Tammy. I'm turning to you, Brenda.
No, I wanted to jump in, Alex, if I could, on one more study that I found intriguing, because I think, this is the empirical part. And that was it was in the Financial Times. So we're gonna go global here in Europe, same analysis. Willis Towers Watson, who's a global asset manager that has 2.6 trillion under management. They surveyed 24 diverse managers and found, guess what? Outperformance in the diverse teams. And so, we're going to talk about this, but these studies are not new, right, Robert? They've been around for years, and we've had updates of studies. And so this empirical data that suggests that diverse managers help you find alpha. And those of us that are not investing with diverse managers may be leaving something on the table. The business case, the financial case has been out here. And so I think we should talk about why people haven't accepted it.
Thank you, Tammy. I mean, you kind of anticipated one of my questions, but I'll get back to you on that one. I wanted to bring in one more study that was recently distributed and published this week. And Brenda, that's the AIM study. So AIM also commissioned a study, also again with Professor Lerner and Bella Research, focused on Asian American and Pacific Islander owned businesses. Can you tell us what were the major takeaways of that study?
Absolutely. Can you hear me?
Yes, we can.
Okay, great. Thank you. So Professor Lerner and I unveiled the study this past Tuesday, and there are some cultural specificities in the Asian American cohort that is a little bit different, I think, from the others. You may have heard of the model minority stereotype, because we're seeing a lot of Asians being successful in business schools, taking a fair number of jobs in the entry level positions of banks and investment firms. However, we're not seeing the blossoming of Asian Americans moving up the ladder in these large firms, and even more troubling, in a more troubling pattern, we're not seeing the launch of Asian American owned funds. So AIM as an organization wanted to put some data around it and find out what's going on. So in our study, we looked at the ownership of Asian American investment funds. So the ownership has to be over 50%. We looked at the 4 core asset classes, and we used a different time frame from the other reports that Robert mentioned. So the reports are not directly comparable. as such. We looked at Asian Americans compared to the entire US fund market. And this is what we found. The Asian American firms manage 0.5% of AUM. 0.7% of AUM, and 2.9% of all funds are owned by Asian American firms. This is a very low number, but I am an optimist. I see this as great white space for AAPI-owned funds to really scale and grow, as well as for successful investors in the large firms to come out and launch themselves. When we take a look at the returns, the numbers are somewhere between what Robert said and what Tammy said. We found that in the cohort of AAPI-owned firms between 2008 to 2020, there was a slight outperformance in hedge fund IRR and a slight outperformance in TVPI for private equity. So this gives us a lot of encouragement in the work that AIM is doing, and we are going to spread this report far and wide. It's available on the AIM website. But our goal is to really help the small subscale funds in our community scale, as well as to make sure that we put in the scaffolding for investment managers to launch themselves out of their firms and create wealth for our communities.
Brenda and Tammy, picking up on your last comments, these studies, we've all seen them, we've all read them, they've been around for a long time, they've been widely distributed. So in your opinion, why do we still have so few women and minority-owned investment-led asset managers? Why is the industry not buying into the empirical evidence that's been presented throughout all these studies? That's for Tammy.
Oh, okay. Well, I think that there is what Robert said, the notion that we all know is real, which is called unconscious bias. And the thing that's interesting to me is even if you do not buy the business case, the financial case, there's no study that says that we're performing or underperforming, right? Even Brenda's study says slight outperformance. It's always something. But think about what is equitable and what is fair. Why should 98% of the money be going to majority-owned firms when there's nothing that shows that we underperform? And I do think that it's all about stakeholders who have the ability to push change and to make sure that diversity isn't just something that is good, because we all know that diversity of thought makes things better, but that it is a place where you can find returns, to be the best fiduciaries for your capital. And so I do think that unconscious bias plays a role. I think that people like to do business with people who look like them. People are very comfortable with people who look like them. And I also think that there is this, what I'll call, diversity sort of penalty tax, that when we walk in the door, there's all of a sudden the risk flares go up. And so that has to change. So it's got to be a changing of mindset, and it's not going to happen overnight.
Thanks, Tammy. Let me
Alex.
to Pilar. Pilar, you've been
Thank you.
An advocate for over 20 years. You're armed with these studies. You're meeting with the decision makers at pension plans and other organizations. Tell us a little bit about your approach in taking this empirical evidence and advocating for change. How do you go about doing that?
Well, Alex, I think that we've seen enough reports on performance of diverse managers. Will we see more? Yes. But I'd rather, and I'm looking forward for reports on the performance and the will of institutional investors to really take the seriousness of the matter and put their money behind the managers that are performing, including diverse managers. I think that overall what we need to change the situation and the systemic inequities in asset management is collective will and leadership. Not because we're here, but it's obvious that the New York City controllers program has been evolving over the years, and today stands as one of the exemplary programs that we all wish many others would follow. But when you look at the top 20 public pensions in the country, and we all know that public pensions are one of the biggest allocators to diverse asset managers and across the industry. When we look at the top 20, they may manage about, $2 to $3 trillion. About maybe half of them claim to have a program. But I tell you by experience that you're very hard pressed to find the will, the energy, the thinking, the structuring of programs that we see in New York City. And I believe that's what we need. We need more will across the board, a collective will, not only from the institutional investors, but also from trade associations and others, public sector, elected officials, right, that have the power to institute public policies that help level these inequities. So
Thanks, Pilar.
that's how I see it.
Thank you. Suzanne, picking up on Pilar's point of view and what you just mentioned on collective will and leadership, I'd love to hear your view and perspective on, first of all, stepping back, what do you think should be the role of asset management in addressing these issues, and what's KKR's approach to it?
Thank you, Alex. As I was thinking about how much I agree with her comment, that a lot of how we move the needle in our industry is really about all leaning in together. And so, for instance, the work of the Institutional Limited Partners Association, the work of a number of leading LPs and GPs together to create more dialogue about this, I think are positive steps. And that is perhaps one of the few silver linings of the incredibly sad and tragic events that happened this year in our country and for many years before, that caused more people to focus on this topic. And my hope would be to focus in a more sustained and committed way, which I really think is what I hear from Pilar. I also think Tammy's comment about unconscious bias is an unfortunate reality. And what I might add to that list is I think that there is still a problem of lack of role models. So as we think about bringing the many talented people into our industry and nurturing them and developing careers, a huge piece of that, I think, is also for people of all types, all genders, all ethnicities, all sexual orientations, to really be able to look to the senior ranks of different organizations and believe that they have a path to those positions, or to being the founder of their own organization and to business success. And so it's a complicated dynamic, but I think that all these things can be steps forward. In terms of the role of leading asset managers and what KKR, for instance, is doing specifically, we've really been very focused on this topic for a number of years. I think our first steps were to drive it from the top of the organization to ensure that our policies were as supportive as they could be of all of our employees, and to get more aware about inclusivity in our own culture, to re-examine some of our recruiting practices, and to ensure that we were opening the funnel and making it as likely as possible that we could bring people from different backgrounds and different experience sets into our firm and see them succeed. So I would describe it as a journey. I think we believe we have a long way to go, but we're deeply committed to it.
And Susanna, just as a quick follow-up, has that either evaluation or reevaluation of KKR's role and what you should be doing, is that just happening solely internally, internal discussions at different levels, or are you bringing in third parties to help you and assess and devise strategies?
Yeah, we've been fortunate to have a number of great partnerships with external parties, Organizations like SEO, for instance, have been vital partners, I would say. We're fortunate in that Henry Kravis has been the chair of the board of SEO for many years. And so that means we've had the opportunity to really experience the talent level of the SEO students. And in fact, we have, I think it's 13 or so SEO alums who are at very senior levels within KKR. So we live and breathe with that organization as one example. And there are many others. We have, you name the affiliated group, and we have been spending time and sharing best practices. One really interesting pilot project that we've been fortunate to be a part of this year has been in conjunction with the Kellogg Foundation. They have worked together with McKinsey and a small number of asset management firms to really more deeply understand racial equity and what best practices can be adopted or what needs to change. And so we're still in the midst of that work, but we feel very fortunate to have been included in a group of just a few firms that would really help to get that important work launched. And we look forward to it getting shared more broadly.
Thank you. And Tammy, if I can turn back to you for a minute, because this in this area and topic of diversity and inclusion and firms pursuing strategies to advance equity, what is the approach at Basis? And importantly, I asked a question, as a minority-owned firm, what does diversity mean and how do you approach it maybe differently or not?
So I would start by saying that I'll just tell my story about the fundraise, because I think that's really important. Although I had a track record from working at many big institutions, Equitable, and then managing capital for GM's pension plan and the same strategies I'm doing, and also working for a subsidiary of the Case Depot, as many of the managers who are on attending this conference will know, it's hard to bring your attribution record with you. So I began raising capital by strategy and managing capital for various institutions. But when I went to raise my first fund, commingled fund, although I had all of this experience, and I know that this has to resonate with folks because we see some of our majority peers roll out of firms and get $500 million. But for us, the journey is so different. And that's why we're here. I actually had to be really strategic about my fundraise. And New York City was part of that strategy. I worked initially with Grosvenor. We did a seed portfolio of 8 investments that I wanted to demonstrate that this was proof of concept because I wanted to de-risk myself. And New York City was in my first close. And without, the initial seed portfolio and without New York City coming in to support, there was not going to be momentum, because I was a first-time fund. And let's just put the statistics out there. Only 5% of first-time funds make it. And that's a scary proposition. And it didn't just stop there. I actually tried to go around the country to find where my story would be welcome, because that's you want to not waste time and money. And at the end of the day, I can trace every dollar. I say every dollar to a woman or a minority that was somewhere in that process, whether it was CIO, trustee, on the team, that just gave me a shot. And that's all we're asking for, because we are talented. We will do the work. And again, diversity is in our DNA. And I've told you that I don't think that any company that puts forth a business strategy or an initiative would do it without a business plan. So I challenge companies that are majority companies to say, where's your diversity business plan? With concrete strategies, with performance metrics and accountabilities tied to compensation. I'm a business leader. I know how to drive outcomes. And when people poke at diversity and have committees and affinity groups, again, those are great. But if no one's accountable, we're just shuffling paper around. And that's what I think this industry has been doing for many, many years. And there are the people and the players like New York City and some other, state of Illinois that really get it. But I think that what Pilar said is right. It's about collective power with stakeholders that can actually force change, because when you hit people in their pockets and you start actually shining the light the way I know, and I love the ILPA that New York City does now, because it goes deep. Okay, it doesn't just ask about diversity so people can have junior employees and just not even really be, focusing on who's making investment decisions, who's getting paid. And so I welcome that, because I think that is the kind of work that starts to really show the disparity.
If I may, Alex, I'd love to comment and address what Tammy is sharing with all of us. Tammy, I don't have the statistic of how many first-time funds were raised and successful back in 2005, 2006, but I have a feeling it was much more than 5% were successful. And we have to ask ourselves, why? Why haven't we not only made the progress that we can, but I think that we are right now worse off than we were 15 years ago. And what I observe is just a bottleneck of great talent that's coming up, because we have no challenge in finding great talent, but the structure of many of these diversity emerging manager funds, it's such that it's not promoting the growth and the elevation of those firms that were started 15, 20 years ago. And certainly it's not providing an entry for first-time funds and new firms. So this is what we're talking about. It's a very obvious systemic issue that we have that it's driving inequities even more today than even 15 or 20 years ago.
No, thanks,
And just
Pilar.
one
Certainly,
quick comment,
you're
can I just make one quick comment to Pilar's? The issue is also scaling. It's not just about first time. It's look at how many diverse firms have been able to
Absolutely.
scale. I just wanted to add that. Sorry.
A few have very successfully. Let's see more.
Agreed. Robert, let me turn to you. Unfortunately, the sad reality is that Tammy's story, the basis story, is not unique. Unfortunately, we hear it all the time. Firms and individuals, because it is ultimately about people with incredible pedigrees and track records that really struggle. Women and minority-owned, in professionals struggle in growing their own firms and raising capital. From your point of view, Robert, for systemic change to really take hold, what needs to happen? And address that both for asset managers and allocators.
Two things. Thank you. This is a great conversation. Two things need to happen. More white people need to explicitly see that there's good business in working with women and people of color. That too many people, and with all due respect to my new friend at KKR, and I'm only going to pick on you because you're one of the most influential firms in the nation, you're still admiring the problem. I don't get the sense that you've crossed over and really, with joy and ebullience, understand that people of color, women, represent performance, and then take sort of a market approach rather than wait for clients to say, hey, are there black people on your team? Start marketing them. So Grosvenor is an excellent example, the firm in Chicago, and I don't work there and I don't sort of know the intricacies of it, and I'm not a validator of them, but I observe it's one of the few firms, white-owned firms, that has figured out that there's money in people of color because they're talented. And they have aggressively curated a critical mass of people of color, heavily black, to go out there and kick ass. And then it becomes self-fulfilling. Once you're seen as a safer haven for women and people of color, you are then flooded with quality candidates who want to work there. So the first thing is a critical mass of white people need to stop admiring the problem and cross over and say, there's money in them, there are hills. The second piece is diversification happens fastest when there's an exogenous force forcing you to do it, which is why pension plans are farther ahead than everybody else, because there's a political overseer. And in urban areas, many of those political overseers are people of color. And Scott Stringer, who is obviously sui generis and terrific. And thank you, Scott, for your leadership. So In corporate America, in foundations and universities, there doesn't seem to be an exogenous force, an outside entity saying, hey, where are the women? Where are the people of color? That has to happen. Power does not distribute itself on its own. Power is shared when there's force. And I don't mean violence, but I mean force. So what Diverse Asset Managers Initiative is trying to do is be that exogenous force. It's trying to shine a spotlight on the continued exclusion of women and people of color and the stupidity of that, and exercising tactics to get people to move faster. But the first answer I gave is the better one. When white people, mostly men, who were in positions of authority, wake up and realize they're missing out on returns because they're not working with Tammy, because they're not working with Brenda, this is all going to change.
So Robert, maybe I'll step in to defend myself for a moment. And I look forward to actually getting to know you a bit more, because my bet is we have more in common than you might realize. I'll take issue with the idea that we're admiring this problem. I actually think we're deeply troubled by it and putting a lot of time, energy, and resources into helping be a force for change. And I do believe we have a long way to go, and that we can't ever be satisfied with where we are. But I also think that if we got to spend some real time together, we might find that we're actually trying to move things in the same direction. So I really look forward. I know we exchanged emails yesterday, and I look forward to getting to spend some time with you so we can talk in more depth.
Suzanne,
Sounds good.
Suzanne,
So
Alex, may I?
No, actually, let me hold on a second. Suzanne, can you hear me?
Have AIM
I can.
work with KKR as well.
Let me
Reach
hold
out
on.
to you, Suzanne. But from our perspective, what we're doing is really a coalition of the willing from the buyer side, right? So the public pension funds have been true leaders in this field for 20 years. CalPERS, CalSTRS, New York City, New York Common, etc. But there will be a big announcement next week of a new partnership with various trade associations, including AIM, with a money center bank to help them build their diverse pipeline. And this is something that's different, that I don't think has been widely used in the market. And we're going to use this as a tool to reach out to other decision makers and limited partners, people who are influential, to get them on board with looking at diverse managers and really funding them and scaling them up. This is something that AIM and the other trade associations can do very well. And I look at AIM's role really in three buckets. The first is the regulatory bucket. We work with the SEC, the House Financial Services Committee, et cetera, to shine a light on this issue. The second is what I would consider the structural bucket, which is where the buyers are, right? BUYERS. These are the people who can put money behind the managers like Tammy. Can we get them to do more for us? And the third bucket is really the risk mitigation bucket, or the cultural bucket, I like to call it. It's incredibly expensive and risky to come out and launch your own fund. It takes a lot of courage to do that. So how can we as trade associations put the scaffolding to help these managers come out in a risk and cost mitigated way so that they're able to grow in an accelerated manner and do more for our community? So that's how I kind of look at the world that we live in today.
And let me jump back in here, because I wanted, I found, frankly, the exchange with Robert and Suzanne very interesting, and I think very constructive for this conversation. But Suzanne, it may be interesting to delve a little deeper to some of the plans. There's a comprehensive plan at KKR to address DEI, and maybe you can share with us a little bit of what you're doing very proactively, and maybe let's start with talent recruitment, retention, and development.
Sure. Yeah. As you know, you and I have spent a lot of time on this topic over several years. We're deeply committed to continuing to just improve the talent mix in our organization. I share the view that talent is equally distributed, and that often opportunity is not. And so much of the work that we're doing is around making sure our organization is as open as possible to bring in talent of all colors and all genders. I was the first woman partner at KKR and am in my 12th year at the firm. And so I have seen a lot of change throughout my time at KKR. And I was incredibly proud yesterday. We announced our new managing director class. I think 39% of the class is non-white, 35% is female. And while, again, we're not satisfied with that mix of representation, I do think it shows that we've been building a pipeline of real talent over many years. And it's wonderful to see those individuals recognized for their contributions and for their potential in the organization. One of the things that we've also done is recognize the power of our portfolio. So we oversee over 200 companies around the world. We set an initiative about 18 months ago to have the boards of our companies be more representative of the communities in which they operate. And this August, we announced that we had achieved our first milestone in the US, which was to have at least 2 diverse directors on every portfolio company that we control in the United States. And we really are not satisfied to end there. We've actually set a next objective in terms of how we measure that, and we're about 30% of the way there already on that next objective. And really one of the reasons that we're deeply focused on our portfolio is when we step back and say, how can we have the greatest economic impact? We look at the reach of these companies. We have about 800,000 employees in these companies, hundreds of millions of dollars of revenue. And so if we can help drive policies that are more fair and inclusive and have leadership of these companies that is more representative, we think that's one of the most impactful things that we can do to drive equity and inclusion in our country and around the world. We're actually right now working through a dynamic, if you can believe it, many companies in this country and in the world don't actually track demographic data for their employees. And so we're now working with our portfolio companies to instill practices that will track that demographic data under the theory that what gets measured is what gets managed. So that's been a big focus and something that we'll continue to put our muscle behind. And I could go on, Alex. I won't do that. I know we got a lot of other interesting panelists, but thank you for the opportunity to comment.
No, thanks, Suzanne. And looks like we have about 8 minutes left, just as a time check for everyone. And I want to turn the conversation to gender and racial pay equity. I'll give you my quick story. I remember as a young investment banker in the mid-90s thinking how great it was to work in investment banking. For me, it was a perfect meritocracy. I worked hard and I got paid more money than I can ever think was imaginable for someone given my background. But what was interesting was that as I became more senior within the organization, I realized that comp was becoming much more subjective. Political even, and certainly less, it was less of a meritocracy. So there's clearly a difference, and we're all very well aware of it, of how people are compensated and promoted really differs for people of color and women. So Tammy, let me start with you with this question. How do asset management firms, how does the industry begin to truly narrow the pay gap? And how do you ensure at Basis that compensation is fair and equitable?
So you have to make sure that you have the data that supports what various positions at your firms, should be paying. And so that's easy to get. There are so many different places to get that. And then, companies, owners, CEOs have to make sure that they're looking regularly to see, are the women being put into different support areas? Maybe not that accounting and HR aren't awesome areas, but are they getting opportunities, and people of color getting opportunities to be in, revenue generating businesses? And if you have that disparity, then you need to understand why. And so it's all about intentionality, Alex. I mean, you have to make sure that you are managing. I agree with Suzanne in talking about managing metrics, sure that you are refreshing those metrics and making, and if you have to make adjustments, make those adjustments, and not because someone tells you to, but because it's the right thing to do. And again, it goes back to we're responsible. And for me, I left corporate America for two reasons. One, because I had that entrepreneurial spirit, and two, because I never saw myself getting to the C-suite. And I felt that I could have been, and I should have been in the C-suite, not to be arrogant, but to say that I knew I made a lot of money for companies that I work for. And so when I formed Basis, I decided that I was going to create a completely different company. And that's, and by the way, when we talk about pay and equitable, rationing of pay, we also need to talk about wealth creation in the same sentence. And that's what, to me, fueling entrepreneurs and fueling companies. And remember, diverse managers, it's a multiplier effect. And we haven't talked about that. Diverse teams hire each other and invest together. And so it doesn't just investing with a diverse manager in and of itself has tremendous social impact. There can be studies on that. And so I would say that it's being intentional. It's making sure that you have support from third parties on what you're paying, and just making sure that my job as the leader is to look at that and work with my head of HR and other people involved in making sure that that's equitable. That's super important at Basis.
One
Alex.
encouraging thought.
I was going to say, Suzanne, maybe jump in quickly from the perspective of
Yes.
a very large firm. How do you
And I'll follow.
manage gender and pay equity? Is something that you're focused on, and how do you do it at a firm with thousands of employees?
It is something that we're focused on, Alex. I think we've been mindful to make sure we're running analytics to validate that the decisions we're making with a separate lens are fair. And so I think it's an important conscious step. The other thing I was going to mention is something that gives me optimism. We recently made an investment in a company called Burning Glass through our impact portfolio, and that business focuses on data, to Tammy's point. And one of the things that it's very attuned to is recognizing it's really focused on the labor market and data related to the labor market, and also recognizing that often the way to make progress on diversity is actually to look inside your own organization and identify people with the skills for the core job, but who may be sitting in a related role or a role that's quite similar, and then think about the training dynamic to help them get there. So when I've learned what our deal team is doing with a company like Burning Glass to help level the playing field and help provide economic mobility and opportunity, it's really in identifying situations like that where people use their own creativity and are a little more brave and less risk oriented, as was commented on earlier, to think about who can really fill the next level jobs in their organization.
And Pilar, let me
If I may add to, yes, being wanting to comment on all of this, it is in the situation of compensation as well as the representation of diverse asset managers. It's all a top-down situation. We need more leaders at the top that value the talent of diverse professionals and managers for what they can produce. The people at the top need not be diverse people. I would prefer to see an increment. And as we're seeing, there is collective will that we're seeing on diversity on boards, as we see different private and public entities coming together to make that happen. It would be great to see that in the asset management sector as well. We need to stop checking boxes. Let's stop the checking the box. And I think that's a big part of the problem in asset management as well. We cannot have the results on the shoulders of just a few large public pensions and smaller pensions that are doing a great job at engaging diverse managers. And last thing that I want to say is we need to remember what we are talking about here. When we impede the access and participation of diverse leaders in managing assets, what we're doing, we're impeding capital to flow from the institutional investors to asset managers, into businesses, into our communities, creation of jobs, creation of wealth, and we are fueling disparities and inequities of lack of access to good education, lack of access to healthcare, higher incarceration, and this is, what we have the power to change with collective will.
No, thank you, Pilar. And Robert, let me turn to you here. I always feel when I get towards the end of these panels, I'm like, wow, what a great conversation. But I think I've had thousands of them, and so my question to you is, what does this success look like? In the next 1 to 3 years, how do we know if we're moving in the right direction? And over the longer term, if you can help us define what success or at least meaningful progress looks like.
Thank you. Great question. I'll say it quickly. Almost all institutions tracking and reporting their participation and utilization of women and people of color in asset management. So corporate America has crossed over and they report their spend. So asset management being included in that. And then, as I said, a critical mass of leaders in every sector, philanthropy, corporate, pension, et cetera, accepting that it's in their fiduciary interest. It's not a fiduciary duty question. It's in your fiduciary interest to maximize returns by working with women and people of color. That's success. Alex, you're brilliant, but we can't hear you.
Can you hear me?
Now we can.
Now we
I
can.
apologize about that. So one last
Yes.
quick fire question for everyone. I'll start with Brenda. Brenda, what is the one takeaway that you want our audience to leave with today?
Invest with diverse managers. All you LPs who are watching this program.
Suzanne?
I think we keep challenging and leading. That's the objective.
Pilar?
Collective will. Let's make this happen. It's not happening. Let's take action, come together, and really drive change in the industry.
I love that word. That's the collective theme of this panel, collective will. Robert?
Said it already. Critical mass.
And I'll give the last word to Tammy. Close us out, Tammy. Did I lose Tammy?
Yeah.
I think so.
I think I may have lost Tammy, but I really want to thank all of our panelists this morning for joining us. I thought we had a very lively and constructive conversation. Thank you so much for your participation. Thank you for everyone for tuning in, and hope you enjoy the rest of our conference. We will have asset class breakout sessions immediately following the conclusion of this panel. And please don't forget your one-on-one appointments in our networking session. Thank you all. Have a great day and afternoon, and happy holidays, everyone.
Thank you.
Good morning, everyone, and welcome to and thank you for attending the Public Markets Breakout Session. I'm John Mercerberg, head of the Public Equity team. Participating on our panel today, in addition to myself, we have Robert Fang, the head of our fixed income team, and representatives from our 4 different emerging manager fund of funds. I'll introduce Robert and our fund of fund partners later in the session. Next slide, please. So during this session, we'll show you the public equity and fixed income teams, provide a quick summary of public market AUM and assets managed by MWBE and emerging managers, describe the emerging manager transition process from the fund of funds, describe the public markets manager search process, update you on our tentative manager search plans, then have each of our 4 fund of fund partners describe how they evaluate, help, and support emerging managers. We'll finish up with a question and answer session to address any questions you may have. Next slide, please. And then the next slide. This slide lists the members of the public equity team. In addition to myself, we have Moraima Perez, Louise Howard, Mitch Fielding, and Noza Zuminova. Noza supports both the public equity and the fixed income team as well. Moraima, Louise, and Mitch will be participating in the one-on-one meetings after this session. Next slide, please. The pie chart on this slide shows the breakdown of assets under management for public equity. As of June 30th, 2020, public equity assets totaled over $100 billion. The largest piece of this pie was the passively managed U.S. allocation, while the second largest piece was the actively managed developed world ex-U.S. allocation. And then you can see the different pieces laid out in the pie chart. Next slide, please. The tables on this slide show the MWBE and the emerging manager portions of the active public equity portfolio. Most of our emerging managers are in the fund of funds program. We have about 330 million invested in emerging managers who have small cap benchmarks, and that's through Legato. And we have over 1.5 billion invested through 3 fund of funds managed for us by Bivium, Exponents, and Leading Edge. That's an international equity. Now, the boards hire our fund of funds through a consultant-driven process. And Robert will talk about that process a little bit later in this session. The fund of funds have discretion to hire the emerging sub-managers in their portfolios. So the number of sub-managers hired and how the dollars are allocated among the sub-managers is up to the fund of funds. But they must do so within guidelines that we give them. The guidelines cover things such as maximum firm AUM at time of funding, portfolio limits versus the benchmark, and BAM also reserves the right to decline the addition of a sub-manager if the sub-manager is already in another of the other fund of funds portfolio. At this point, I'll hand off the presentation to Robert Fang, who's the head of public fixed income.
Good morning. I hope everybody can hear me okay. Welcome everyone to BAM's annual Emerging and MWBE Manager Conference. Next slide, please. My name is Robert Fang, and I want to introduce everyone to the public fixed income team. The team consists of Karen Barkley, Rebecca Yeh, and Noza Zuminova, who assist us with projects. Karen or Rebecca will be available for one-on-ones for fixed income. Next slide, please. This pie chart shows the breakdown of assets under management for the public fixed income asset class. Our three largest allocations as of June 30th are governments, which is passive, mostly passive, IG credit, and mortgages. Next slide, please. So this table shows our MW portions of our active fixed income portfolios by US managers. If you look to the right of the chart, you'll see our fund-to-fund AUM and our developing manager AUM. Our fund-to-fund AUM, our only fund-to-funds went out of business in the fourth quarter of last year. So currently we are in the middle of a search to replace them for our fund-to-fund program. So I'll not be able to speak publicly on this. But the developing program, which is a direct relationship with smaller managers, has all the old fund-to-fund AUM. At the end of June last year, our developing program had about 680 million. And now the three managers, as you can see, make up our developing managers have close to 1.3 billion. Next slide, please. So these next slides are very important for managers who want to have a future allocation with us in terms of a direct relationship. Next slide, please. So our criteria for transitioning a sub-manager from the fund-to-fund program to a direct relationship is similar to us hiring a manager. Our basic tenet is that we have to believe the manager can add value. So here are some reasons, but they're not inclusive. BAM has meetings with possible managers, and we listen to their philosophy and process. We look for stable teams and good organizational structures, not too many departures. Risk management and compliance standards are also very important. Also, investment returns are important and a vital way for us to measure these managers. For our active managers, we target keeping 75% of the excess returns. So for example, a firm charges 25 basis points in fees and has outperformance for the year of about 1%. In this way, we retain 75% of the excess returns. Therefore, fees are very important in our calculations. BAM strives for diversified portfolios with low correlations to other managers. This helps fill in gaps in our program, essentially white space for our overall portfolio. Also, it is extremely important to have input from the fund-to-fund manager and from one of the system's general consultants. The fund-to-funds should know these managers the best. They have them in their lineup. The consultant input is invaluable because they view the entire universe of managers and they can compare to other managers and how this manager can add value to our lineup. Having both is critical. So there are a couple of other additional requirements per the New York City Procurement Policy Board rules, or PPB rules. Next slide, please. So next we'll move into our public market search process. Next slide, please. So the 5 boards of the New York City retirement systems all have their individual consultants, which are here today. The process in public markets starts with each of the 5 consultants making a list of managers. BAM checks to see if there's any overlap on this list. Per the PPB rules, we need to see a manager appear on at least 2 lists. BAM sends the overlapping managers a due diligence questionnaire. We then conduct interviews and meetings. After that, we will have our recommendations, and then we will go to our investment committee with our recommendations. Our investment committee can approve or disapprove our recommendations. If they disapprove, the search committee will go back and take another look at the managers. If they approve, then we go to the boards with our recommendations. The boards make all the final hiring and allocation decisions based on our recommendations. We do not allow placement agents in the search process. You should contact BAM directly. Next slide, please. So these are our tentative searches for the following year. To participate in a search, you need to have your firm and product data in the Callan database. in Wilshire's database, and also in the eVestment Alliance database. Those are the databases used by the consultants to screen firms and products when we do a manager search. So unless there are any other questions, do you have any questions? And unless there are any other questions, I guess we can hand it off to John Mersberg.
All right, thank you, Robert. Next, we'll have each of the fund of funds describe how they evaluate, support, and help emerging managers. The first up is Kai Hong from Vivium. Vivium received our was one of the recipients of our Diverse Practitioner Awards today. So take it away, Kai.
Great. Thank you very much, John and Robert. And thank you to New York City for the opportunity to present here. So as mentioned, I'm with Vivium Capital, and we're one of the fund-to-fund managers for the City of New York. When we look at due diligence, in the process, what we're focusing on ultimately is finding, what a manager's true ability is, separate from, any market, impacts. And the process, focuses on, qualitative and quantitative assessments to get at that. Ultimately, what we're looking for is, market independent alpha, skill, translated into, outperformance. And as part of that, we're going to spend a lot of time, particularly with emerging and boutique managers and those firms that are earlier on in the process, understanding the manager's mindset, how they think as an investor, a leader, a business owner through, psychology assessments and ongoing, conversations. Recognize that there are also certain organizational and operational factors that can influence, alpha, and being mindful of those and assessing those directly as well. And ultimately, what we're trying to get to through our process is a good set of expectations on what a portfolio and an investment team is going to deliver over time. On the right-hand side, you see kind of the framework of how we would take a look at doing due diligence in various asset classes. And so what we're presenting here is market breadth and information efficiency. On the upper left-hand side, you'll see asset classes where there's low market breadth, so fewer number of differentiated securities, and higher information efficiencies. So areas such as treasuries, U.S. mega cap, U.S. large cap. In those categories, when we're talking with an underlying investment manager, what we're going to focus on are going to be more specific to portfolio construction, risk management. In those areas, it's probably harder to have a differentiated viewpoint on a particular security like Apple or the 30-year bond. And it's going to be more about how the portfolios are built. And so, our diligence process is going to be, tailored differently. On the lower right-hand side, you have areas where there's larger market breadth, more differentiated securities, and less information. So non-US small cap, emerging markets equity, and the like, high yield. In those areas, our conversations with managers will focus more on, individual security insights, what you can find out or what the team, believes is different than what the marketplace believes. And so, the process again will be different and tailored to the different asset classes. Now, what does this mean to you as an underlying investment manager? At a start, we have a questionnaire on our website, which we, invite all managers to, to fill out and that we, review. And so we can start to think about, again, building these expectations of what you're going to, deliver. What I would say that firms need to be able to articulate, in that, and when the questionnaire gets at is, what are you good at, and why is that going to ultimately add, alpha? On the next slide, we talk a little bit about our, how we aim to support the overall universe, and this, relates to funded and prospective managers. So what we see is, or ultimately what we're looking to leverage in the emerging and boutique manager space is the intersection of motivation and skill. Where the emerging managers will have investment experience and the team that they've brought together, keyed in with motivation and entrepreneurial spirit to leverage that into, outperformance. However, there, as I mentioned previously, there are a lot of non-investment, aspects that could hamper your success. In those, what we try to help out is providing, what we say is holistic insight to sustainable growth. Provide introduction of references to other potential capital sources, guidance in terms of how to manage, business operations and, apply best practices. Advice on cost management, vendors that you may use to support your business, and then foster community and engagement amongst other firms and your peers. And ultimately, the goal of this is to allow you, the investment manager, to focus on the process and adding value for clients. Now, what I close is with some, a lot of, some actionable advice, right? Ultimately, as manager, kind of engage with us. Some things I would suggest. One, when you contact us, I would suggest you contact us one at a time. Sometimes managers have, feel that if they blanket the investment team, they'll have a better chance of getting a response. But rest assured, we will try to respond to everyone, and it's more efficient. Secondly, I would say be patient. It may take time for us to kind of get back to you, and we certainly will reach out, as necessary. I'd also say, you have to, in this business, recognize the biases and preconceptions that the industry may have towards smaller and diverse firms. And our goal here is to help you rise, to that occasion in our interactions with you, our guidance. That said, expect us to challenge you and to be direct with any feedback. I've gotten sort of the feedback myself that maybe the comments might be a bit harsh or the due diligence quite stringent, but ultimately, we're trying to be fair and again help you be your best. It's hard to build a firm. AUM growth is often out of your control, and it can be, a real trying process. But be patient, and rest assured we're here to help. And be committed to the business, but be realistic. It's a marathon, and lately it's become an ultra marathon, where the time frame is even longer than you would expect. But that's ultimately why programs like New York City's are essential in providing opportunities and support for all of us. Okay, so with that, I'll turn it back to John.
All right. Thank you, Kai. Appreciate those remarks. Next up, we have Diana Tamhankar from Legato.
Thank you, John. Good morning, everyone. Thanks for joining us today. I'm Diana Tamhankar with Legato Capital Management, Senior Research Analyst. So Legato's research process seeks to identify entrepreneurial managers with the greatest potential to deliver high risk-adjusted returns over intermediate and long-term periods, particularly in the long-only public equity space. We employ both quantitative and qualitative analysis in evaluating managers. We perform comprehensive due diligence on all aspects of the firm to identify strengths, weaknesses, and the greatest risks. But we also look for opportunities to engage and develop managers, exchange ideas. You learn from us, we learn from you, and we strive to build good relationships. We assess an organization's most powerful drivers. We pay attention to innovation and thought leadership as well. We dig deep to understand the team dynamics, the investment process, portfolio structure, performance results, performance pattern. We're looking for consistency and adherence to strategy. Now, we understand there are several challenges emerging managers face, such as low AUM, limited staffing, limited resources, short track records. These do not exclude you from our search, assuming there are no specific client restrictions. But what we would like to see is a well thought out business plan. As you can see on the slide, ESG is included as an area of evaluation because we believe that it is becoming increasingly important. Currently, the ESG part of our analysis is more for data gathering and measurement. We want to know what the managers are doing within their firms, if there are any ESG initiatives, and how they are incorporating ESG in their investment process, if at all they are. It is not a disqualifier. We will not exclude a manager because of a low ESG score, but it could be a tiebreaker in manager selection. So all things being equal, we will favor a manager that has some ESG integration, again, emphasizing all things being equal. The last thing on the slide I want to touch on is Legato's focus list, or our buy list. After thorough evaluation of managers in our investable universe, our highest conviction managers are placed on this list. This list is comprised of managers we are closely monitoring, managers with the highest potential of being funded if there's an opportunity, if we win a new mandate, or if we are seeking to replace a manager within our existing lineup. Just to share statistics, about half of our focus list is comprised of women and minority firms, and over 60% of Legato's total assets are currently allocated to women and minority firms. Just a few tips to ensure that your firm is on our radar. If you are able to, fill out databases such as eVestment, submit your information in our website along with your marketing materials, add us to your distribution list for updates, white papers, and also reach out to us to set up an introductory call if you have not spoken to Legato in the past. Next slide, please. Thank you. As part of our commitment to the emerging manager space, we make it a point to help and support managers whenever possible. Could be feedback, advice, guidance, any way we can assist, happy to help, happy to share our perspectives, whether it's firm related or strategy related. But more formally, we have formed 2 peer groups to help in manager development, a compliance peer group and an ESG peer group. Once or twice a year for each peer group, we host a call featuring industry experts to discuss relevant issues, important topics related to compliance or ESG. These peer forums are a great venue to learn from industry leaders, ask questions, and also share best practices. So as an example, our most recent compliance peer group call focused on cybersecurity. The speaker touched on vendor management, cybersecurity policy issues, and technical safeguards as it relates to internal networks. On the ESG side, Legato became a UN PRI signatory in 2016. And in that role, we continue to move forward and strive to raise managers' level of knowledge through discussions and also by establishing our ESG peer group program. Our most recent ESG peer group call was about ESG data, rating, and methodology. The speaker talked about how third-party vendors or index providers are scoring companies on ESG, why the scores for the same company vary by provider, and some differences in rating methodologies. Past topics include how institutions are evolving and viewing ESG, how the overall landscape is changing, and how ESG can help firms identify risks in an organized manner, how ESG can be used as part of risk mitigation. These events are fully sponsored by Legato. We are not compensated in any way. We simply want to create programs that may be beneficial to entrepreneurial managers. Thank you. Back to you, John.
Thank you very much, Diana. Our next speaker is Carolyn Diaz-Roberts from Leading Edge. Carolyn?
Thank you, John. Good morning, everyone. I'm Carolyn Diaz-Roberts with Leading Edge, a firm founded in 2005, 100% minority owned. We have 6 investment professionals that focus on public markets. And we've specialized in emerging managers since our founding, and our founder, Clayton Jew, has been working specifically in this area since 1991. And what we do is we develop customized portfolios of emerging managers for our clients. We begin with the client's investment mandates, in this case, New York City's. We identify risk and return objectives. We determine appropriate benchmarks for the underlying managers. We define diversification and diversity goals that meet the client's objectives, and that can be a variety of items. And then we move to manager selection, and we look at a lot of details, but overall, we're looking at the investment risk management processes, the organizational strength, we look at just how we can put together the best possible program for our clients. And this leads us to the customized optimization process that we use. And one of the things that we do is consider both market factors as well as the underlying managers' patterns of performance, and again, how they look at the world. So if we start with the investment philosophy and process, we're looking at something that has consistency and discipline, because that is what is repeatable. And this is very important to the success of the program. We're looking at the strength of buy and sell decisions, and we have proprietary measurement tools that were developed in-house. And that helps us understand how each firm is successful, including in underlying industry groups. We are able to assess and also compare, because we have a proprietary database, we compare against managers big and small, and that really informs our decisions, and it certainly supports the strength of employing diverse managers in the industry. We're looking at different time periods, and as I mentioned, since we have a proprietary database, we're able to look at inception to date periods and rolling periods and any period that we choose to review. And this really is essential and helps us in getting a complete look at how a portfolio has performed over various market cycles and in various environments. And of course, this year has been quite the test for anyone working in any industry, really, but in financial markets as well. And we're happy to report that our portfolios have held up well. Our managers have really adapted well, and we're very grateful to them. And we continue to maintain a close dialogue. This is this is one of the areas that we specialize in. We're very individualized in the work that we do, and that extends to the managers. Whether we've met you or we're about to meet you, that is our approach. And we're looking for unique features that you may have. We're looking to understand your competitive edge. And as I mentioned earlier, we're looking for sustainable and repeatable performance. We also look on a qualitative basis at who you are, who are your staff members, what has the turnover been, is there an incentive for the employees to remain at the firm? We look at the strength and the experience of the team, and then we also look very importantly at operations. This is a very difficult world to manage portfolios in, and you really need some strength of systems. And we're happy to discuss that with individual managers who are thinking about entering the institutional marketplace. And also, risk management is something that some managers have highly developed systems, and other managers may not focus on that. And that's one of the early conversations we have with managers who approach us. We are also looking at compliance, very seriously in the world that we work in. There are many attempts to hack into different systems, and it's important to our clients, it's important to us, and important to each of the firms that you're able to maintain your operations and continue to manage the portfolios. And we're also looking at how a firm is growing their business, because as many of the speakers here today have referenced, it is certainly a challenge, especially for minority and women-owned firms. It's important to have enough capital and support to sustain yourself. It would be wonderful if everyone received cash flow right away. Yes. So I'm going to move on to our next slide, please. Thank you. So we're looking at overcoming some of the barriers. So, in doing so, you're not competing with us against large firms. We focus exclusively on emerging managers. And we also serve as the first funding for some managers. Haven is an example of that. Ken Hawley is a portfolio manager we've worked with in prior firms. So we're happy to do that. So anyway, as we are approaching the industry as a whole, we welcome people to approach us and to ask us questions. We have an open door policy, and we again like to support the emerging manager space. Thank you.
Hi, thank you very much, Carolyn. Next up, we have Cesar Gonzalez from Exponents. Exponents was formerly known as the FIS Group. Someone just whispered in my ear that we may have some technical issues with Cesar. Cesar, are you there?
Okay. Good morning, everyone. Thank you again, John, for inviting us, and thank you for our longstanding relationship with the New York City systems and to our manager. Exponents, our goal is to be a multiplier effect. What we want to do is help the managers before firm their formation and also as they grow their businesses. We view manager risk as during their early inception, which is under 100 million. It's also a risk when they're at above a billion, and we've seen firms close. And there were lessons learned that we do share with our managers, and later on I'll talk more about our manager development program. When we look at a manager, we look at them holistically, just like our peers in the industry. The pie chart in the middle shows you the weights that we appoint based on our internal scoring system. Performance is 25%. We believe that past performance, is not an indication of future performance. So we develop internal systems. One in particular is April, which allows us to systematically evaluate and extract the managers through excess return by extracting their factor biases. We don't want to reward them based on their factor biases or their investment process, but we want to reward them based on their investment skill. What's important for us as we look at the qualitative part of our evaluation is really understand the people behind the strategies. We are not looking for masters of the universe. We are looking for students of the market. And this is very important, especially this year. We want to make sure that our managers are thinking as they go through manage their portfolio in different challenging markets. We want to make sure that they stay true to their process and they don't panic. How do we evaluate that? One of the tools that we use is Info Analytics, which allows us to really check how they're trading and whether their trading is consistent with their investment process. We want to have an interactive dialogue with our managers, so we do provide them with that feedback. Many of our managers don't have access to some of the tools that we use. So part of an ongoing relationship with them, we do share our insights and things that we believe could improve and help them. And that includes businesses. And as Carolyn said, business management is very important for emerging managers. We want to make sure that we fully understand that they can run the business and that they can fund the business. As Kai mentioned earlier, it takes some time to generate assets. What we wanted to make sure is that there's commitment behind the founders and that there's access to working capital. One of the things that we've done at Exponents is develop the ecosystem, which allows our managers in our platform to get discounted rates using different institutional services and providers. And the discount range is between 22 to 60%. And that allows them to extend their working capital as they build their business. Another item that is very important for us is the ability of the managers to also help other managers. If you go on the next page, part of our manager development program is our team sharing our best practices, but also our managers helping coach other managers. For example, we have a manager in Canada that we funded when they were 10 million. They're over $1 billion now. We have another Canadian manager that's starting to understand how do you manage institutional money in the US. We connected them, and that helped both parties to grow their businesses and also connect their relationships. Within human resources, we found that, especially in the international space, which we play heavily, a lot of the managers focus on domestic equities, and sometimes their investment strategies doesn't translate to international. One of the manager we recently helped is Channing Capital. Channing focused on value investing in the U.S. And when they tested their strategy to do it international, they recognized that they don't have the resources, the trading capabilities to trade international. So we connected them with Josephine Jimenez, which previously run Victoria 1522. What it did for Channing is it allowed them to have a diversified business, ability to compete in the non-U.S. international space, as well as for Josephine to focus on managing her portfolio and have Channing management run the business part of it. Within product development, Denali is another manager that we help. They focus on U.S. equity. We, in our international product, recognize that many of the managers are very short in their Japan exposure. We thought that Denali's investment process would allow them to develop a strategy, a Japan-specific strategy for us. They did the testing. It took months to go back and forth. And when we found that the Japan strategy did work, we asked them to further do analysis and develop an EFI strategy. And as a result, it turned the business around. When we engaged them, they were at 100 million and they were able to grow the business again. And the last bullet point is the Exponence ecosystem. That is free to the managers to participate. We also assist managers with connecting them with private investors to get them working capital. Again, we don't co-invest, we don't get commissions. Our whole goal is to help the managers build their business so that we can process them and put them in client portfolios. That's what we focus on, Exponence. And the last item is we want to make sure that the firms also hire diverse professionals. So we added an HR firm focused on diverse hiring within our ecosystem. That's another tool that we provide our managers. John, I'll bring it back to you.
Thank you very much, Cesar. And thank you to all of our fund-of-fund partners for describing how you evaluate and help support emerging managers. Next up on the agenda is an interactive discussion. Are we able to get questions from the audience? Hearing silence, I'll take that as a no. So until they can get that working, I'll throw it out there to everyone on the panel. Do you have questions for either myself or Robert on how we handle our emerging manager fund-to-fund programs? Or if there's anything you'd like to add on how your firm does your work?
I guess I can
add
start.
That's okay.
Sure. So when you look at diligence, right, the stuff that we've talked through, we are all doing. John, you and Robert are doing this as well on your side. So when you engage with managers such as ourselves, what do you find most helpful in terms of what we can do for you as partners?
I would say that one thing we have very small staffs, and one thing we tend to rely on you on and the general consultants is say, the nitty gritty of operational due diligence. Is a firm institutionally ready from a back office perspective? That's something our team will look at, but, firms like yours and the consultants have people whose full-time job is evaluating, operational readiness of managers. That's something where we really rely on our fund-to-fund partners and on the consultants. And we also, with only, on the public equity team, with 5 people on the team, when we're at full strength, don't have the bandwidth to cover the whole universe of managers. That's why we try to leverage our fund-to-fund partners, and our consultants.
Great, thank
Carolyn,
you.
you had a question or a comment?
Yes, thank you, John. I think everyone in the audience listening is probably wondering, what about asset flow? You know, how long does it take? When can we expect to see some asset flow? And if you could describe a little bit about how you go through that process, that might be of interest.
Sure. In terms of asset flow, it really starts at the top-down asset allocation level. So in the recent asset allocations, public equity has been reduced, right? Money has been flowing to privates. That has been the general trend, right? So in that sense, for public markets managers, it's been a headwind. So we really haven't been able to allocate more money to the fund of funds as the overall public equity asset level has been going down. That's kind of been the major constraint. When also money tends to have been, U.S. equity allocations have been whittled down over time. So we now focus in the fund-to-fund space only on small cap, which is consistent with how we invest in the broader portfolio. We're in the broader portfolio, we're active in small cap. We're not so active in mid cap or large cap. So we've tried to align the program, the fund-to-fund emerging manager program, with the rest of the portfolio. And we now have moved the bulk of the active assets to the international space. And that's consistent with how we run the broader portfolio, where in emerging markets and international developed markets, most of the assets are actively managed.
And John, if you can address how managers transition into the main portfolio, I know that's another question that is on the mind probably of some audience members.
Sure. I think Robert addressed that earlier. But to transition a manager from the program, we really need to have high conviction in the manager, as does the fund of fund, as do the 5 consultants. On top of that, it needs to fill, a missing piece in the broader portfolio, because the mechanism to transition, or used to be referred to as graduated manager, is spelled out in the city PPB rules. So there's a whole process and criteria that if you look in the PPB rules, you can find. Also want to make note that, for example, in the U.S. small cap space, in terms of active managers, BRRRRs chose to have only one active small cap manager. They have one active manager and the fund-to-fund program. Right? So you wouldn't expect BRRRRs to be taking a lot of managers from that program when they're happy with one active manager. At the other end of the spectrum is NYSERS. I believe NYSERS has 7 active small cap managers, and the Legato fund-to-fund small cap program. So it's a type of thing where, especially for those programs, there's limited slots for the transition or graduation of managers. In public equity, since we've started the program, we've graduated 1 manager. That was a small cap manager in the developed ex-US space. Again, that's an area where we have, in general, more active management. We're planning on doing a manager search in the developed world ex-US space for next year. And we expect to have lower minimum requirements for funds to be considered for that. So that's probably one of the best opportunities for active managers and managers in the fund-of-fund program to get into the larger program?
Yeah, I think the answer to your first question about the flows is pretty important. I think we looked at our current developing managers, and that's the only thing I can really talk about right now. I can't really talk about the fund-to-fund program because we do have a search. But when we look at the developing managers, since about 2012, there hasn't really been, and I looked at it a couple of years ago. There really hasn't been any kind of capital inflows except for organic growth in those accounts. And the reason for that, partial reason for that is because those developing managers are measured against the Barclays Ag. And how we kind of structure our fixed income program is that we structure it in terms of how we divide up the ag components into their three subcategories, meaning governments, mortgages, and corporates. So we go ahead and asset allocate because we know our risk. We know the risk of the entire portfolio. We take a look at correlations quite often, and we see how correlated we are. We have to think about the risk for the whole portfolio, not just for the fixed income program. So we know what our treasury and how that, those positions are correlated, and we kind of will take up and down our asset allocation due to that. So I think from our standpoint, it's kind of really, I understand that a lot of managers go into the Barclays Ag, and I think what we would like to see is them going into mortgages or them going into corporates or treasuries. I think, as Kai had said earlier in his presentation, there's probably less efficiencies in the treasury market for them really to generate performance. So, we kind of look at managers for those two sectors specifically. And hopefully we're going to start thinking about transitioning all our managers from the Barclays Ag into the components of the Barclays Ag. So in this way, we can give assets when they do well. I think that's really important. We reward them when they do well. We have larger portfolios that look at those asset classes, and we can see how they do. If they do better than the bigger managers, then they should get more assets. This way, we're not just putting something on paper and saying, we're not just checking the box. We're really helping them grow. With our name in their pitch books for a corporate product or a mortgage product, I think that'll be more helpful in terms of them growing.
I would also just throw it out there for my peers here. How has COVID impacted your manager evaluation process? For us at Legato, it has pushed us to ask even deeper questions, look at what managers are doing from a business continuity plan standpoint, how COVID is really impacting their process, what the managers would do if COVID stays long term, and we're really looking at attribution and the sources of outperformance and underperformance.
Yeah. I just want to share from our manager experience. One of the challenges is hiring new staff member. The inability to really meet them in person or train them in person next to you. Even at Exponence, we hired a junior analyst in July, August, and it could be very challenging from both ends, from the analyst perspective and also from the employer's perspective. So that's one area that we have seen our managers are challenged. We even have one manager that we were about to allocate money to them and decided not to take the money because they were afraid that they would not be able to fully train a new analyst, and they believe that they need another body to accept the new flows from us. So that's an area that we've seen consistently is an issue as it relates to COVID. Otherwise, most of them have really planned their disaster recovery. It's part of our evaluation on an ongoing basis, so they're able to transition quickly, working remotely. Many of them are capable of continuing running their businesses from home. One area that affects them from a research perspective is not being able to visit some of the companies, and that's more for fundamental managers. but just like everybody else, everyone's learning how to navigate that using technology. That's our experience so far.
Yeah, I would say at Vivian, to John's point, one of the big focuses on COVID and the shutdowns initially was operational, in kind of making sure that the firms had the right, wherewithal, operationally to be able to run remotely, to be able to do everything they need to do, and then almost equally as importantly, from a business standpoint, that they had the right runway in order to be able to see this through. Because even early on in March, you had the sense that this wasn't going to be a short-term, item, and so we had to take a look at how we were going to get things done. On the investment side, is fairly smooth. I think a lot of the tools are there to have the conversations. We have all the data on a daily basis, so we could see what the portfolios are doing and gather that from prospective managers. But on the operational diligence side, really kind of enhancing that process to dig in a bit deeper, Diane, as you mentioned, to kind of look, a little bit more at maybe, reference checks and, on vendors, reference checks at, other clients, and, sort of trying to get a broader sense of what is going on that you otherwise might be able to assess sort of, face to face. But I think the interesting thing to us is that a lot of this is going to keep going, even as hopefully we make it through to the other side here. A lot of the things that we're going to institute and procedures that we're adding, I think, can be helpful in us doing diligence on a go forward basis, sort of changing what the process is going to be like and how we engage with managers.
Well, for us at the beginning of the pandemic, we sent out quite a bit of information to managers, helping them understand what we would be doing and transitioning to virtual on-sites. And that includes some tips on how to use a camera, because we've maintained our level of due diligence by asking firms to provide video tours of their office. We're able to see the staff members who are working in the office, and those working from home can chime in. I think the whole world has become experts at using Zoom and other platforms. And in some ways, it's been positive. We've heard positive feedback from our managers as far as their research efforts. Everyone's using virtual, and the level of contact has been extremely high. And we look forward to continuing that. It's hard to predict the future, so we are looking forward to being back in person, visiting with managers. But until then, we're continuing to go through a very detailed agenda, and also to listen to and maintain dialogues on an ongoing basis with the managers.
All right, thank you.
Maybe.
Go ahead, Kai.
Sorry, John. I was just going to add a question, but if you had something you want to add,
no, go ahead. Floor is yours.
Yeah, I was just saying that maybe one of the interesting things for the people listening, for peers and John and Robert as well. If I talk about our the main engagement with managers, one of the things that I found interesting is there's often a disconnect between what the managers think they are doing and presenting, particularly for newer firms, and what we actually come out to assess. A good example is, a manager who may think they're deep value because of the way they screen the universe, looking at low priced book initially, but not realizing that as they hold these securities in their portfolio and let their winners run, the overall portfolio doesn't look like that anymore and doesn't behave like that anymore. And back to kind of what I was saying during, my part of the presentation, we're focused on those expectations. And so it's sometimes, I think, jarring for the managers to hear from us that you say you're deep value, but I don't think you're deep value. And, this is what I think you are. And I think, that has been, it happens often. And it's kind of one of the things that I think, people, before they engage us, should probably take a good look at themselves and say, okay, well, what are we really going to provide? And hopefully the feedback that we give them is helpful. But yeah, I'm curious if any of you, also see kind of consistent disconnects in your engagement with the managers.
Yeah. For
We
us,
do
one of the
actually.
Go ahead.
Yeah, so for us, we do see that disconnect as well. But what we do is we do not rely on how the managers are categorizing themselves from a style perspective. We look at it based on the characteristics and based how we're evaluating the strategy. We put our own we put them in our own sub style. So it's not necessarily what they've put on eVestment or what the managers have labeled themselves. It's based on our assessment of the overall portfolio, and that's how that's how we are going to position them in our portfolio to make sure that our overall portfolio has a set of complementary managers.
Yeah, for us, we have an experience where even our own analysts defined a manager to be X. And when we expected that market to do well, the manager didn't do well. And what we found was when you look at holdings-based analysis, you can create the factors and the analysis that you want to present to support your case. So we started really relying as a check using our April system, which looks at the factor profile of a manager. And we've seen a manager that was relative value, but because of their process, it started driving them to be deep value. And it was a learning lesson for both the manager and us. So, sometimes it's not just the manager that will be shocked that, something changed within their process that they didn't think it will happen, but because of new techniques that we have developed internally allow us to isolate those. But again, you talk to them and reset the expectations, both from their end and also from us from a portfolio construction.
And we also, as I'd mentioned earlier, we have a proprietary system. We have a database where we are being fair to the managers and not comparing them to the wrong peer groups. And so we have customized peer groups that we have vetted. And also, like some of my colleagues here on the panel have mentioned, we assess style. We measure, we do regression analysis against various indices. And we can see the history over time at a glance in our system. So we can see if managers have moved closer to the benchmark, farther away, whether there's any type of style drift, whether there's any change in cap size, and it really helps inform our process. And then we can drill down, again, not just against the broader benchmarks, but on an industry and sub-industry level to see exactly how effective a manager is at buying and selling securities. And that is kind of illuminating to some of the managers that we meet. There are many managers who are very competent. They understand their portfolios. And, if a manager is starting out and they don't have the systems or ability to do that, that is information that we discuss as we're conducting our due diligence. And with our funded managers, we are in regular communication, monitoring the portfolio. So if there are any anomalies or any question that there's any change to their strategy, it's something that we identify right away and engage with them on it.
Okay, I think we've got about 3 minutes left based on the timer below. Diana, did you want to address that, or does anybody else have anything else to add?
Oh, I did already.
Okay. Sorry about that.
Yeah. No, I would say I'm sure all of us, right, are doing this due diligence and, have a pretty good handle on what the managers have. But again, what I've found interesting is when it really doesn't sync up with what they think themselves, right? And trying to deliver that message to them. Like Cesar, to your point, I think we all have the capability to figure out, what historically has happened over time through analytics. But if that doesn't gel with what they're presenting, that's the difference between explicit and implicit bets in the way we look at it, right? Explicit is what they say they're doing is actually happening, and implicit is what they don't say is they're doing, but is actually happening as well in their portfolio. And, to what level of comfort, do you have when there are these implicit bets that the managers don't even, understand, themselves. But, that's what makes this all pretty fascinating when you go through diligence, very educated people, very, detailed processes. And sometimes, it still doesn't work the way they expect.
Well, I think a key part of this is, and I think this is pretty much well understood. I don't think anyone in the investment industry understands that you're going to be 100% right all the time. We do understand that if managers have underperformance. That's why we usually we don't give it a quarter. If you have a bad quarter, we'd be firing all our managers after the second quarter, pretty much, as they were taking overweights in credit and and the performance show. I think we all understand. I think the most important thing for firms is that they express exactly what their strategy is, so we know that they're gonna, when there's periods of these, when there's trouble times or when the markets are actually taking off, we know how they'll do, and I think that's the most important thing. I think as we help manage the allocations for this, John and I, and I think as long as we know what to, and we have managers who will come up to us and say, we got that call wrong, but we're going to try harder, and we're going to get it right, and this is why we think we're going to get it right for the rest of the year. I think that's all we really want to hear.
Robert's
Okay, well,
actually.
go ahead.
I was just going to say, Robert, it really touched on an important point, that understanding and being forward-looking and how portfolios work in the marketplace, and not churning managers, not firing them, and churning the portfolio is very important.
And on that note, I'd like to stop and thank you all very much for participating in today's panel. We thank as well everyone who observed and on the panel, and thank you for participating in the conference. And we look forward to speaking to some of you starting at about noontime in the individual one-on-one sessions. Thank you all. Have a great day.
Thank you, John. Thank you, Robert.
Good afternoon, everybody. My name is Katarina Schumann, and I'm an investment officer on the hedge fund team at the Bureau of Asset Management, or BAM, which is part of New York City Comptroller's Office. I would like to welcome everybody joining us today for this panel, and all of you for your participation. I'm joined today by several of my colleagues from BAM, along with our consultants. And I'd like to begin today's discussion by having our panelists briefly introduce themselves. And we will start with Neil Messing, who heads BAM's hedge fund team. Neil?
Yes, hi, I'm Neil Messing, and I do hedge funds for the Bureau of Asset Management.
Next.
Hello, my name is Wesley Pulisic. Welcome to this portion of the meeting. Hope everybody's well. I manage the alternative credit allocations for New York City.
Hi, my name is Jennifer Wildman. I'm a senior portfolio advisor at Axia. We're a specialist consultant focused on hedge funds, private credit, private equity, real assets, and real estate. And we work with the team on a number of the asset classes.
Hi, thank you for the invitation. I'm excited to be part of the event. My name is Brad Myers. I'm a managing director at GCM Grosvenor. GCM Grosvenor is a $59 billion asset management firm focused exclusively on all aspects of alternative investments, hedge funds, private equity, private credit, real estate, infrastructure, and secondaries. I've been at Grosvenor for approximately 17 years, and I'm a member of the investment committee for both the hedge fund business as well as the credit strategies. And we work closely with New York City as part of an emerging manager, private credit, and real estate mandates.
Good morning, everyone. Thanks for spending some time with us. I'm Steve Bossi. I'm a managing director at Goldman Sachs. I'm part of what's known as the Alternative Investment and Manager Selection business. The acronym for that is AIMS. Similar to Brad's business, we really kind of span across all of the various asset classes. My particular focus is on hedge funds and private credit, where I'm an investment committee or a co-chair of a number of the investment committees relating to these investments.
Thank you, everybody. Thank you, our panelists. And we will start with an overview of the hedge fund team and portfolio. And this is Neil's waterfront. So we'll go back to Neil. You're on mute, Neil.
Yes, sorry. Next slide, please. Yeah, so just going through the hedge fund team. You've met Katerina already. You've also met Jen, our consultant. In addition, at the Bureau of Asset Management, Leon Dunklin also helps us with hedge funds. In terms, sorry, next slide, please. In terms of an overview of the hedge fund portfolio, you can see our allocations there to each of the strategy types. In total, the hedge fund portfolio is somewhere between 3 and 4 billion. You can see that a good amount of that the hedge fund portfolio is allocated to what we call emerging managers, and also a good portion of that is invested with women and minority-owned firms. Next slide, please. So our definition for emerging managers is at the time of our investment, funds are less than $1 billion in size or have a track record of less than 3 years. And just some other things on this slide of note, you can see that we focus on what we consider to be the 4 main hedge fund strategy types: tactical trading, relative value, event-driven, and equity long-short. A maximum position size of 10% for any one fund and 12% for any one firm. In terms of numbers instead of percentages, we have allocations to 2 women and minority-owned funds and 11 what we call emerging manager funds. And with that, I'll turn it over to Wesley.
Oh, thank you, Neil. Yep, as Neil said, we will now listen to Wesley and have him speak about OFI team and the portfolio.
Hi guys, hello again. So we could probably just go to the next slide. The alternative credit team at the Bureau of Asset Management actually covers 3 distinct asset classes: high yield bank loans and opportunistic fixed income. And today we'll be talking about opportunistic fixed income, which is a private markets asset class, a standalone asset class at New York City, just like private equity, hedge funds, real estate, and infrastructure. We have 4 dedicated members to the team. Obviously myself, Brent Pasternak and Tina Suo, both senior investment officers. They joined just over a year ago, so they were pretty new when I introduced them last year, and now they're already, I consider them already veterans. And Simon Liang joined us during the pandemic, so he's never actually worked in the office, but he hit the ground running, and he's a huge part of our team. Supporting us is Nozen Manova, who works across the public markets asset classes. Unlike some other of the private markets asset classes at New York City, we don't have a specialist dedicated consultant, but we work with the generalist consultants across the 5 systems, which are listed here on the slide, and also the names of the people that are our primary contacts at those organizations. Next slide, please. So what exactly is opportunistic fixed income, OFI? Some institutional managers call it private credit, some call it special situations. We think about it as being New York City's exposure to public and private, performing and non-performing credit and credit-oriented strategies. It's a long-lived program. We have some shorting, but really only for hedging purposes. The benchmark of the program is an average of a high yield and levered loan index plus 300 bips. And 300 is quite a hurdle, I understand that. But when we started putting the program together, we thought about the different ways that managers can potentially add alpha to the program relative to a public market. And we thought about, credit selection, complexity, origination, structuring, an illiquidity premium for level 2 and 3 assets, some ability to put on leverage, either fund level or structural, and of course having mandate flexibility. And when you look at all those levers, so to speak, that managers can pull, we think that we can put together a program that does add about 300 bips of outperformance versus a public market exposure. In terms of size, it ranges between, the program ranges between 4 and 6% across various New York City pension funds. We have in aggregate about $7 billion in the ground right now, with about $2.3 billion undrawn, and that number is thankfully getting smaller as our managers have been deploying into the COVID-related opportunity. More on that later. We have 17 managers, so it is a bit of a concentrated program relative to some other private markets asset classes at New York City. And we like that because we want to have a program that is manageable. And also, we think a smaller number of managers will allow us to achieve the alpha we're searching for and not some type of alternative credit beta that's spread over, let's say, 40 or 50 managers. We deploy about 800 or 900 million a year. This year, we did a little bit more because we did lean into the COVID-related opportunity. Next slide, please. Last year, we talked about setting up a first-time early-stage manager program. This year, I'm happy to say it is up and running, and the timing couldn't have been better. We did partner with Grosvenor to set up an extension of ourselves, an extension of the program to invest in small and emerging managers. The size of that program, the Grosvenor New York City Partnership 1 SMA, is about $300 million. What we think about when we think about emerging managers is, for open-ended funds, something that's about $1 billion in size, a track record of less than 3 years. It's really their only strategy. There can't be multiple of these open-ended funds. And for closed-end funds, we're talking about something that's about 1.5 billion AUM in the strategy with a track record of less than 6 years. And it makes sense that it would be a fund 1, 2, or 3. So something along those lines. This is the guideline for the program. It's not set in stone, but directionally, that's what we're looking for. The target commitment sizes for each manager really starts around 30 million. So we're looking to have maybe 10 managers in the program, give or take, depending on conviction and fund size and a couple of other factors. And of course, anything that Grosvenor puts out, as I said, it's complementary to us. So what we already have in the ground. And we think this should be deployed over 3 to 4 years, but we all have been leaning into this COVID-related opportunity, so it's probably going to be a little bit faster. And that wraps up my overview.
Thank you, Wesley. So now that we have an overview of hedge funds and OFI, we're going to talk about how BAM makes investments in hedge funds and OFI funds. So Wesley and Neil, could you please discuss the investment process? Next slide. Yeah.
Yeah, I'm going to take it from here and just quickly run everybody through our process. We usually start by asking for a marketing presentation to make sure it's going to be something that we would invest in. There obviously are a lot of strategies that we don't do. For example, we don't do anything in long-only equities or long-only fixed income. Long-only fixed income is either Wesley or Robert Fang or John Mersberg. Once we've received the marketing presentation, we go through it, and if it looks interesting, we'll request a meeting, and that will be the start of our due diligence. If we continue to like you, we have something that's called a green light meeting, and that is basically introducing those firms to our CIO and deputy CIO, as well as our risk team. If all of those individuals and our respective teams, continue to think it has the potential to be an investment, we finish up our due diligence process on both the investment side and the operations side, and then finish up everything with our consultant Axia. In addition to that, we put together a investment memo. It's presented to our internal investment committee, and if it passes our internal investment committee, we take it to our boards. The manager presents at our board meeting, and our trustees ask questions and then decide whether to approve the investment. And after that, of course, there's the finishing up of the legal documents, and that is our process. With that, I'll hand it over to Jen at Axia.
I'd just like to add, Neil, can I just add one thing here?
Sure.
Sorry. Compliance asked me to mention that throughout this process, we don't actually work with, we are not allowed to work with placement agents. So that should just be clear to everyone in the audience who hasn't heard that before. And also just a little bit of a some differentiation for opportunistic fixed income. As I mentioned earlier, we work with the 5 generalist consultants. So instead of how Neil mentioned, he works with Axia, I would work with those 5 consultants that were listed on the other slide. And therefore, any manager that goes through this process would also work with those 5 consultants. So it is a little bit more, let's say, laborious on our side. We do still try to adhere to the 4 to 6 month time frame, but just wanted to mention that.
Thank you. I think it should go back to me. Thank you. Thank you, Neil and Wesley. And as they mentioned, another important constituency in BAM's investment process is our consultants who assist BAM's investment teams to review and surveil the funds. With that, Jen, could you provide some background on Axia and its process?
Great. Thank you, Katarina. And thank you, Neil and Wesley, for having us here today. We're really thrilled to support the hedge fund and opportunistic fixed income programs, and just very much appreciate the opportunity to participate here today. So as you know, New York City manages a number of pension funds. We work with the funds that invest in hedge funds alongside with Neil, and then we also support a separate plan across all private markets. As I mentioned, we're a specialist consultant focused on alternatives in private markets. We have a total of 284 employees across our global offices in the US, Europe, and Asia. and our headquarters is in New York City. We work to support our institutional clients in their endeavors across all these asset classes. So when considering whether or not you should reach out, we do focus on all private markets as well as hedge funds. We advise on and manage just over 172 billion in client assets across those asset classes, and about 50% of our client base is similar to New York City, public and corporate pensions. The remainder is spread across various types of institutional investors. And I do want to highlight that many of our clients do place, as New York City does, a great emphasis on diverse and emerging managers. And to support that, in turn, we spend a great deal of time searching for new managers to include in our universe. So just on this slide, you'll see a bit about our due diligence process. In the interest of time, I won't go into too much detail, but I'll share some of the more relevant information for emerging managers. First, out of the 284 employees, 141 of our employees are dedicated to research and risk. On the investment due diligence side, the analysts are broken out into specialist teams. And the research is really the machine that drives our advisory process. And that, of course, flows through to our clients. And as you can see on the bottom right, all of this culminates to a wide breadth of coverage. So we are looking at a great deal of managers. We have due diligence on over 3,200 programs and have been in contact and are tracking over 6,300 programs. And if you could just flip to the following slide. So just to touch on our efforts to connect diverse and emerging managers with the investment community, it's really important to us to support the growth of managers in this space. It's clear that diverse managers continue to be underrepresented as a percentage of the alternative and private market industry. So how do we do that? So number one, we really try to be leaders in the space by working with organizations. You can see some of them listed here. And they focus their efforts a great deal on supporting women and minority-owned businesses as well as emerging managers. We ourselves look to connect managers with the LP community. As a matter of fact, just yesterday we held our annual Diverse and Emerging Manager Forum, where we connect our investors with emerging managers, giving them time to present just, similar but on a much smaller scale than you're seeing here today. And we host various roundtables and look to highlight emerging and diverse managers in our communications to our clients. And I think it's most importantly, we're really always trying to actively source opportunities. So finally, I'll just close with the easiest way to connect with us is to email us at diversemanagers@axia.com. The email's on our website if you didn't get that. And there it actually allows us to share a brief survey focused on diversity and emerging managers in the space. But with that, I will pass it back to Katarina and we'll be here for questions and forth.
Thank you, Jen. And we will go to Bradley now from GCM Grosvenor, who will provide some background on Grosvenor's investment process.
Thank you, Katarina. And I wanted to echo first Jennifer's comment. I'm excited to be a part of the event. Thank you again for inviting me. It's an exciting event, and in the work from home environment we're all in, it's exciting to be a part of this event and emerging manager opportunity. This first slide that you can see really walks through the primary components of our investment process more broadly. For the sake of time, I thought I would focus on the next slide. So if you could go to the next slide, which really highlights how we work with emerging managers in our process. We have a strong commitment at Grosvenor and a focus on small and emerging managers. So as an example, across the firm, we've committed or invested with $17.9 billion to small and emerging managers and over $7 billion to diverse managers. And that really spans across all alternatives, hedge funds, private equity, real estate, infrastructure, and private credit strategies. And our approach to small and emerging managers, I would really bucket into three primary areas. First is the investment activity, which I'll walk through in more detail in a moment. Second is the guidance and consulting, in our view, as to what best practices are in the respective alternative strategy of where the manager is focused. And third is promoting awareness of the emerging and diverse manager space. First, as it relates to investment activity, I think it's notable to highlight that our investment process is the same, whether a manager is a new, emerging, small manager, or whether it's an established manager. on our investment due diligence, operational due diligence, and risk management due diligence, we have the same dedicated specialized team that focuses on that due diligence, and we have the same processes and governance structures in place that evaluates those opportunities relative to their peer group. And on the investment side, there's several qualitative and quantitative factors that we look at, but at a summary level, I would bucket it into four primary areas. Background and detailed knowledge of the people and their experience level. Number two is the investment process and how they think about everything from sourcing the idea to all of their due diligence and work product and evaluation of that, to the ultimate position sizing and portfolio construction. Third is detailed reference checking, both in terms of reference checks that the managers provide us, but also our internally sourced references from our own network. And then lastly, going through very detailed trade examples and walking through the managers' models and work product to evaluate the quality and content of their work. The second bucket, guidance and consulting as to best practices. It's part of our due diligence process. It's really something we try to do in helping these small and emerging managers build out and grow their business. So there's several examples of this, helping them with their governance structure, with their investment terms, liquidity and fees, of how they compare to the industry in their sector or region, improvements to their investor reporting or risk reports, evaluating key service providers, operational due diligence enhancements, really trying to educate the small and emerging managers in terms of leveraging our experience in the alternative space. And I think we can add a lot of value. We do add a lot of value, in my view, to the small and emerging manager space in this. And frankly, most of the managers, not all, but most of them, I think, view it as free consulting in terms of how to improve the quality and stability of their business. And then third, as I mentioned, promoting awareness of the small and emerging manager space. And so how do we do that? We run 2 annual conferences that serve to promote the awareness to small, emerging, and diverse managers. The first is something we call the SEM Conference, the Small and Emerging Manager Conference. We've been running it for 14 years. It's been a very successful conference. And then second, what we call Consortium, which is a focus on diverse and women-owned managers that are just starting up, and that's been running for 17 years. And really the goal of these events is really to connect LPs and GPs in the space and to lead discussions on important related topics that are relevant to how they can grow and build their businesses. So with that, thank you again for having me, and I'll pass it back to Katerina.
Thank you, Brad. And finally, we have Steve from Goldman Sachs Rocatan to discuss their process.
Good morning, everyone. And again, thank you for spending some time with us. Brad, you said everyone's working from home. Goldman has actually come back to the office, and I've been in the office since the end of June. So we do have the flexibility to work from home. But if you look at my background today, this is not my home office, but this is my office. So look, just a few words on Goldman in our program here. I'm not going to spend a lot of time on this, but I think the important takeaways are, number one, this is a very important business to Goldman Sachs. It's been a business, we've been in the business for many years, going back to the acquisition of Commodities Corp, which was founded in 1969, and we acquired it in the early 80s. So this is in terms of the hedge fund business, this is a business that we've been in for many, many years. And if I look at our investment mandate, whether it's on the hedge fund side, on the private credit side, the private equity side, or any of the other long-only businesses that we run, looking at small and emerging managers is core to what we do. We have very much an open door policy. So we're happy to meet with many firms. It doesn't mean everyone is necessarily going to get capital, but we're certainly happy to meet with firms. And similar to the approach that I think others have taken, we have a keen focus on women and minority-owned businesses in general, and in our little world, firms that are investment firms specifically. And one of the things that we did this year is we reached out to over 550 of our funded managers or funded GPs, whether it's on the long-only side, the hedge fund side, or the private credit, private equity side, and really try to understand their ownership structure, and their thinking about women and diversity and inclusion in their businesses. In that survey, 13% of our businesses are minority owned and are female owned. Sorry, apologies. 13% minority owned and 9% female owned. So that's about $32 billion of capital that we've allocated. So from our perspective, if you look at just our little ecosystem within Goldman Sachs, but if you step out and look at some of the key initiatives that the firm has taken, things like Launch Opportunities Fund, that's a private equity and venture capital focused fund that is really targeted at women and minority owned businesses. So that is really kind of a core tenet for our businesses. If you, next slide, please. If you look at our investment process, similar to what Jen and what others have said, it's quite similar. We have an investment approach, we have a risk management approach, and then we have an operational diligence. So there are three various kind of processes that may happen all about the same time. But I think one of the things that's a little bit different, and one of the things that we try to do, and we started doing this about 4 years ago, is really similar to what Brad said. We don't have a separate process for small and emerging managers. It's the same diligence process, the same standards to which folks are held. But one of the things that we try to do is really disaggregate our judgment by the use of this factor framework, if you will. And on the page, you see 4 different factors: governance, process, infrastructure, evolution. And one of the things that we learned when we took a look, when we stepped back and took a look at our investment committee process, one of the things that, and we've always, as a business practice, have always had investment considerations, which are things that we like about a particular fund, and then investment concerns. Things are certain risk characteristics. And really, the approach there is to make certain we have balanced viewpoints at the investment committee. And one of the things that we heard, and this is probably 7-8 years ago, oh, this so and so's a rock star, he or she's really good, and so that was interesting, but not necessarily informative from an investment committee perspective. So what we tried to do is basically take out the star power from a particular fund investment and really try to disaggregate different aspects of our decision-making process, such that when collectively you score each of these factors and you actually look at, some have predictive power, some don't. So when we go back in time and really reevaluate our decisions, we do it in a much more granular way. So it really helps us, and certainly at the investment committee level, really helps us understand where we've done well and where we need to maybe evolve our thinking, if you will. I won't go through all of the various factors, but I do want to kind of highlight under the governance the firm ethos, and that's really where we focus on the concepts of just diversity and diverse thinking. We do believe very firmly as a business and as a firm that having diversity of thought, diversity of people, makes both for a better decision making, but it also creates an environment where people want to work and want to stay at work. And we think that's very, very important from a continuity perspective. Similar to what other, and now I'll toggle a little bit to the small and emerging managers. We have a similar practice where we will act as, I think Brad used a good term, free consulting initiatives. And for those that we will back, we have a whole suite of folks that will help, whether it's the refining the message, refining the pitch, making certain you have the appropriate service providers, making certain that the reporting is correct, making certain that the risk framework is appropriate and what investors are expecting. So look, it's an important, it's not something that we charge for, it's just a free service, if you will, but it's really I think very helpful for folks that are getting started in their businesses. And I think the next slide, please. I'm not going to spend a lot of time on this page, but I think what this does show you is we have at the firm both for-profit businesses where we are actively investing and engaging in women and minority-owned businesses, but we also have some philanthropic issues. And I think Goldman is very well known for the 10,000 women or 10,000 small businesses, and those are not necessarily investment-related, but more business-related. But I just wanted to leave that with you so that you have a broader picture of some of the initiatives that we have here at Goldman Sachs. Katerina, I'll turn it back over to you.
So now we are at the part of the panel that so many of you have been waiting for, and that's a discussion with our panelists. And we will start our conversation with the topic of investing in volatile markets, and in particular, the impact of COVID on the investment process. And also, I'd like to mention that we encourage all of you to take advantage of this opportunity to ask any questions that you have. Our panelists, BAM in general, via chat function on the bottom right of your screen. So now I'd like to begin by asking all of our panelists the question. Since COVID interruptions began in March, how have your IDD and ODD processes changed, if at all? And if they haven't changed, do you expect to make any changes as a result of universal working from home? Wesley, perhaps we can start with you.
Sure. Well, let me first tell you, let me be honest, let me be transparent. When COVID hit, we pivoted quickly and started thinking about how we could lean into the new opportunity set. And we did not feel comfortable bringing brand new managers to our trustees that we hadn't had a chance to diligence properly. So we looked at our incumbent managers and we looked at managers that we had already had extensive conversations with. And that's who we ended up recommending to our trustees. So I'd say initially we were uncomfortable with the idea of not having the ability to do on-site diligence. Let's fast forward to today. I feel like we still have not recommended a brand new manager to our trustees, but I do believe that at this point we feel comfortable enough bringing such a manager to our trustees and are in a couple of active conversations right now. So we've evolved a little bit and I think now we probably would feel comfortable, but it was difficult in the beginning.
Neil?
Yeah, I'm not sure I have much to add to that. I don't think our process has really changed. Other than the fact that we're doing more Zoom calls and conference calls instead of face-to-face meetings.
And our consultants, do you have anything on that front?
Sure, I could start. In terms of our process and how it's changed during the COVID pandemic, obviously less travel, while in-person meetings have been important historically, I think will be important once the vaccine's rolled out. We've actually found it to be several benefits to the work from home environment. And so the way we've navigated, we've been very active investing in 2020, as Wes described, in terms of taking advantage of the dislocation in the equity and credit markets. And we pivoted as we've been focused on these kind of Zoom and interactive virtual sessions, several of which we had the benefit of a very deep team that was covering the universe for many years. And so we had already known a lot of these managers, even if we didn't have an existing allocation. And so some of the benefits, we were able to be more efficient, right? So obviously less downtime from travel and from commuting. And so you could just simply have more interactions, more meetings back to back each day, just more high touch. So instead of going to New York or a manager meeting and you might bring a couple of people on the trip, now you can have multiple interactions from risk management, operational due diligence, investments, junior people, mid-level people, senior people. To Steve's point, you're getting diverse backgrounds and skill sets that can join these calls and interactions. So multiple targeted sessions has really allowed for diversity of thought, diversity of insights, and a lot more people can take advantage of that due diligence process because you don't require to have multiple people visit on site. And so the other point I would highlight is that having your computer in front of you during the session allowed us to have a lot of data in front of us that you may not bring with you on a manager trip. So, having your prior manager notes, having the risk reports and exposure and stress tests from the manager, having your Bloomberg in front of you or to get market data and insights as you walk through positions. So it was actually an advantage around just having a more robust and interactive, high-quality dialogue with the managers as you conduct due diligence. So between the efficiency, the high touch, the ability to bring in multiple members of different groups at the firm has actually been a benefit that I think as we look forward post-pandemic era, I think there's enhancements to that that'll likely be a hybrid approach between this kind of virtual world and the on-site due diligence.
Yeah, and Katerina, what I would add to that, I think we at Goldman found very similar characteristics. We immediately went from working in the office in March to working at home. We started with Blue Jeans. We transitioned to Zoom or WebEx. I think we're fluent in a number of these video chats now. But I think two key things that we noticed. Number one is it was just much more efficient. It was much more efficient because we weren't flying all over the world. We have teams globally, and it was very leveling. So the teams in Asia, the teams in London got the same information at the same time as the New York team. We could actually do it all together without, me having to fly to Hong Kong or Tokyo and be jet lagged and try to conduct a meeting. It was just, I think, the level of energy and the leveling of information. Yes, you have everything at your fingertips, but I think it was really that, everyone's kind of operating on all cylinders at the same time. And I think that really, we saw very good efficiencies of time. And also, a number of us think about it, when you're flying to, whether it's even Chicago or the West Coast, you're on a plane for at least 2 or maybe 4 hours if you're 5 hours coming from New York. You just find time. Like you can get a lot more done in the course of a day. And so I think our productivity actually increased. I think the other thing that, the one drawback that we too have been very active. There was, one of the areas that I cover is credit. And when I set out my plan in January for 2020, that quickly pivoted and changed substantially in March because now there was a big dislocation to take advantage of. We certainly wanted to get on our front foot to do that. And so there were a number of diligences that we wanted to get under our belt. But the one thing that I think we've noticed with these Zoom meetings, or however you want to characterize these types of meetings, you don't always get the texture from people. There is some nonverbal language that you get in meetings when you're sitting around a table, and that's a little bit harder to get in this environment because it's only one person talking at a time, and so that part, what we've done differently to try to augment we've always done. A series of reference checks, not on the list that you give us, because those are your 10 best friends that will say nice things about you, but really off the list. And we've tried to enhance the way in which we do our reference checks to talk to suppliers, to talk to competitors, to talk to former employees, and really just try to put that mosaic together. Because investing for us, and I'm sure for others on the call, it's really about the mosaic and how does everything fit together. And I think that's one of the, apart from using Zooms more regularly as a course of practice, I think the biggest change for us is an enhanced way in which we do reference checks.
Thank you, John. Do you have anything to add?
Yeah, I mean, I'll just echo everything that was said, but I do have something to add. I mean, on the efficiency side, I 100% agree. We've been much more efficient, get a lot done on in terms of activity for new managers and for topping up or making changes to current managers that we've already met with. It's been one of the most active years in private credit as well as in hedge funds. And I do agree with the one drawback, especially on the operational due diligence side. Body language is very important. So I also agree with Brad in that when we can go back, we most likely will go back to in-person meetings. But I think you'll also see a lot more Zoom. The other drawback that we found is there are some things that certain managers don't feel comfortable sharing over email. Like there's SEC letters, there are, their internal and investment memos. And we have found that managers are really willing to work with us in certain ways to show that. In some cases, they've mailed, paper copies, or in some cases, they've actually gone out and emailed, or in other cases where they're a little skittish, they'll put it on the Zoom and present it page by page, and that can be tedious for our operational due diligence teams and our investment teams. But there are workarounds, right? So I think all in all, it has been much more efficient. But yeah, there's still some drawbacks, but I've seen, everyone seems to be making it work. And I think the managers are working more with consultants because they understand you still have to get your work done, and that's how they get their allocations. So we make it work.
Thank you. Thank you. That was great. And to follow up on that, with respect to allocations, do you think you will be able to allocate money without doing on-site face-to-face meeting? And what, if anything, would give you sufficient comfort to make your allocation with a manager that you haven't met personally? And I believe Wesley Neal, do you have anything on that?
Yeah, I mean, we will, depending on how things transpire with the vaccine distribution, we do intend to bring new managers. And what will make me comfortable? I think the last 8 months or 6 months have made me comfortable in the sense that this is now kind of the new normal. This is how we interact. I do believe things will mean revert in terms of eventually post-vaccine distribution, we'll get back to more normalcy. But I think about that like an 80-20%. We'll revert to 80% of what we remembered, and 20% will be different because that 20% will be permanently changed. But yeah, I also mentioned earlier that Grosvenor came on at a good time, and I mentioned that because it's right when COVID started, and they were able to give us some exposure to funds and managers that we didn't know. So although I have not recommended brand new managers, we certainly did get the exposure of brand new managers through our partnership with Grosvenor. So that timing has been extremely helpful.
Neil, would you like to say anything?
Yeah, I guess I would say a couple of things. One is, I agree with everybody's comments about efficiency and everything, but one of my favorite phrases is don't mistake activity for accomplishment. And, we're supposed to, our job every day is to find good investments to make. One of the things I would say about Zoom meetings is that, they can be boring. And there's days, I'm sure, with everybody that you have way too many Zoom meetings. But the positive from that is that I feel like it makes the really interesting managers stand out more. And that's why I think eventually we'll have no issues investing with a fund that we find really compelling, even though we haven't met with them face to face.
Thank you, Neil. I'm monitoring your questions, and one of the questions was, what's the minimum ticket size of investment in emerging manager hedge funds? Wesley, Neil?
Well, since they asked for hedge funds, I'll start first. We don't really have any hard and fast rules except for position size and amount invested with one firm. The reason why we don't really have any hard and fast rules is because we feel it varies from strategy to strategy. And when you have strict rules, there's the potential to miss a really good opportunity. Having said all that, our hedge fund portfolio is about $3 billion. So a 1% position size for us would be $30 million. So we don't think we would want to have a position in the portfolio that's less than 1%. We would like everyone to be able to move the needle for us. We have our smallest investments are probably around the $50 million mark, and our largest investments are probably around the $300 million mark. Now, having said that, at this point, the larger firms, we've probably met with all of them and have either decided to invest or not invest. So almost all of our time these days is being spent with, what we would call small and mid-sized firms. So it's unlikely we'll be making any additional $300 million investments, and it's more likely that the position sizes in the new firms that we're investing in will be at the lower end.
Well, I know that it was about hedge funds, but Wesley, what about your funds? Do you want to talk about ticket size for emerging managers?
Sure. I think I mentioned it earlier, but we have the program with Grosvenor that I think the starting point, and Brad, please follow up with this on these comments. The starting point is about 30 million, and then we can flex up or down depending on conviction, fund size, and other factors. But please, Brad, if you will.
Yeah, and taking one quick step back as it relates to Grosvenor for diverse and emerging managers, we don't have a hard and fast rule, and so we can start very small, even less than the 30 in the case of our New York City partnership. And then we're willing to be patient and grow over time. And so in the case of our New York City partnership, it's approximately 30 in terms of how we want to size positions within this portfolio, but it's very much, just in terms of having relationship and starting relationship with Grosvenor, we've had examples where they're even smaller than that, and we build from there and grow the relationship and help and advise them.
Thank you. Another question that we have from the audience is, what do you see as some of the most impactful changes managers have made to their portfolio construction and risk management processes in order to be more adaptive and resilient to the new systemic risk created by the pandemic? So I guess maybe we will start with consultants, and then we'll go to Neil and Wesley, given that Neil and Wesley have been talking a lot.
So I don't know, Jennifer, Steve, you want to? I could chime in. In terms of changes to, go ahead.
Yeah, look, I'm happy to. I'm sorry, I thought we were going to the consultants first. There have been, I would say, kind of 4 observable changes that we've seen this year. Number one is really a focus on liquidity management and financing. And, certainly in the structured credit space earlier this year, if you didn't have the right financing, you were toast. And we've seen, while we certainly saw some of this back in the 2008, 2009 time period, we saw a lot of thankfully smaller but yet big growing pains in certain segments of the market. So a real focus on liquidity of the portfolio vis-a-vis the redemption privileges that your clients have, but also just liquidity of your profile with respect to the ability to trade that portfolio. The second area that we saw was really a closer deaggregation of alpha versus beta. And just having high returns is, look, everybody wants high returns. But beta you can actually get for free. And in hedge funds and private credit funds and private equity funds, you pay a lot for that beta, right? And so really a keener and sharper focus at the GP or manager level, really trying to understand the constituents of return for their portfolio. And a derivative of that, I guess, which is the third thing, is really looking at the various factors. And we saw that not just with the quant funds, whether it's fundamental equity or quantitative equity market neutral funds, but we saw it predominantly with, just broadly speaking, equity long short funds, really trying to understand what factors are driving their performance. And that's something I think that was and that's kind of been on the come for a bit. That's not groundbreaking by any stretch of the imagination, but I think we saw really, just given what happened in March, April, and May, we saw a renewed focus on some of the market gyrations, if you will, and how that could impact a portfolio.
Yeah, I think that's a great point that Steve makes. I think on the credit side, it was absolutely a leverage financing and liquidity management test for funds in March and April. And I think for those, especially in the structured credit space, that may have gotten caught with repo financing or with short-term funding and gotten caught from a margin call perspective, I think there was some new lessons, or for some of the funds, old lessons relearned on some of these managers, I think, and that's very much true. And we noticed that, and I think some of the funds have reacted to that in that space. And then we definitely, the point about factors, we've seen that multiple times in this environment, even November with the growth value factor rotation, and just some of the managers that are maybe less quantitative focused, they don't have the risk personnel or the experience to know what they own. They're very good bottom up, very good idiosyncratic. They do a lot of great work, due diligence and modeling, but they may not roll it up to the portfolio level as well as us or Goldman or Axia or others that are thinking more holistically to what risk profile that manager may own and what they may be exposed to, because everyone can figure it out ex post after the fact, but what do they own ex ante? And that's the tougher challenge for these funds. And I think that's something that a lot of these managers are trying to build up their experience and their ability to analyze that. And then the last point is just there's an arms race around data and analytics, and I think that's true not just for the quants, but for equity and even credit managers, of just getting and paying for and investing in data research, data specialists that they can then marry with their fundamental processes. And I think that's another trend of what we've seen this year in terms of, it's really across strategies.
And just to add the financing part of it, I mean, you both mentioned structured credit, which of course was an area that was really impacted, due to financing and how the managers were structuring that. But I'd also add to that we saw a lot of the impact on the relative value side and with some of the volatility managers, and just kind of matching your financing with the duration of the trades. And it's something that we've always known, and it's something that the experienced managers definitely understood. But over time, you sort of forget what damage that can do, and then it takes another event like this to kind of solidify it and just kind of look back at how you're doing things and restructure. But the other thing that we saw change for us was just structuring of the products and managed accounts. One of the things that was really difficult for clients was the ability to move really quickly, to have dry powder on April 1. There were a lot of dislocation products out there. There were managed accounts that would allow clients to do this. And so we really actually saw a bit of a shift to kind of think about committed capital or drawdown products or dislocation products or SMAs that allow for the manager to quickly take in capital from investors without them having to go to their boards and get approvals that would take too long for them to be able to take advantage of these swings. So that was another thing that we saw, and I think would benefit both the managers and investors.
Thank you. I don't know, Neil, Wesley, do you have any comments?
Yeah, I'll just follow up with what Jennifer said. We in late 2019, we brought to our investment committee the idea of setting up some type of flexible accounts that, like a trigger fund that could potentially draw capital based on what's happening in the markets. Because you saw earlier that process we had, which can take 4 to 6 months, and that's not very nimble. And so we wanted to set up something that allowed managers the flexibility, the access to the dry powder within our accounts when events such as COVID took place. So we were set up to set it up. And then COVID happened, and then we quickly set those accounts up. And we set them up in perpetuity because we know that this is not the last time something like this is going to happen. And we know that our process is likely not going to get any more streamlined. So we did set up these types of trigger mandates to be able to take advantage of this type of volatility in the future.
Thank you. I have the last question from the audience, and the question is, and it's for Grosvenor. Can you clarify the investment objective in terms of investment strategy and investment return objectives for Grosvenor Private Credit 300 million allocation?
Sure. So in partnership with Wes and his team, we're really looking for longer duration credit opportunities, pretty flexible in terms of types of strategies, allows us to be nimble to the opportunity set. And so, we have a collaborative dialogue and approach with Wes and Brennan and his team regarding sourcing of ideas. It could be anything from, asset-based lending to, direct lending to distress for control, corporate distress, taking advantage of kind of COVID-sensitive opportunities that occurred in the spring and into the summer, and really stepping in and being a liquidity provider and getting an excess premium for that. And so it's not we have the flexibility to take advantage of more liquid opportunities, but it's really designed to be a multiple of invested capital focused opportunity as opposed to a quote unquote more liquid hedge fund opportunity with simply an IRR focused. It's really a combination of an attractive risk adjusted return, but with a multiple of capital over time.
Thank you. And we're almost at the end of the hour. And I know there was one question about how people can contact us, and people can contact Bureau of Asset Management by emailing to diversity@comptroller.nyc.gov. And I don't know if our consultants would like to repeat their emails where people can send their information and questions.
Yeah, I can repeat ours. It's managers@axia.com. You can also go to the website. At the bottom of the website, it says 4GPs. When you click on that, the email is there as well, in case you didn't hear it properly.
And for Goldman, you can just direct emails to me, and I will then on-forward those. So my direct email is steve.bossy@gs.com.
And for Grosvenor, same as Steve, you could direct it to myself, B Myers, BMEYERS @GCMLP.com.
Thank you. Well, this has been a very constructive. Sorry,
Zarina. Just since it's a question from everybody in the audience, and it's in the contact information is very important. If it's not already on our conference website, we'll work with the team and get everybody's email and phone numbers put on the conference website. So.
And to that point, the website will be available for the next 30 days. So if you missed anything, you can go back and check the chat or any other section of the website. And again, thank you, everybody. Thank you, our panelists. Thank you, our participants. That has been a very constructive conversation. And I hope you all stay healthy and safe. Thank you.
Good morning, and welcome to the Current Market Environment and Trends in Infrastructure and Economically Targeted Investments breakout session. Glad that you're able to join us today since we have an exciting panel assembled for you. My name is Christopher Pock, and I have the privilege of moderating this session. On today's panel, we have Petra Nikolova. Good morning, and welcome to the Current Market Environment and Trends in Infrastructure and Economically Targeted Investments breakout session. Glad that you're able to join us today since we have Brian Cook, the Assistant Comptroller for Economic Development. Looks like I'm getting a little bit of feedback. Apologize for that. We're joined by Melissa Ding from BlackRock, New York City's partner for the Infrastructure Emerging Manager Program, along with the Infrastructure Specialty Consultants for the New York City Retirement Systems, Nick DeLoretta from Axia, and Todd LaPena from Stepstone. With such an esteemed panel, but limited time, we will provide an overview of our programs first and save time for questions at the end. Let's jump right in. If we go on to the next slide, please. Petra, would you mind giving us a quick introduction to the infrastructure team?
Everyone, I'm Petra Nikolova, and I run the infrastructure program for New York City. The asset class is the newest one in our portfolio, and now we are invested in 10 managers across 12 strategies. The way we invest is through both funds and most recently co-investments, and we invest globally. We don't have geographic restrictions. How do we do that? You see the team. It's the Bureau of Asset Management team, Yasmin Arges, Blair Barberino, David Friedlander, and Marina Borsch, who also work with some of the other private asset classes. And then we also work with our consultants, Stepstone and Axia. And that is really a brief introduction. So Brian, I think to you now for ETI.
So, hello, I'm Brian Cook. I'm the Assistant Comptroller for Economic Development. Of the many duties in our bureau, my favorite is, of course, the Economically Targeted Investment Program. As you can see, we run a fairly lean team. Aside from myself and Christopher Pock, the director of the ETI program, we have Lauren Kroll, who is the Deputy Director of ETIs, and Doris Lay, who is a loan officer. As you can see, there are no consultants on my slide. That doesn't mean I get away with not having to reach out to consultants. It actually means that because we're investing in strategy rather than an asset class, we can work with any consultant across the systems, depending on the type of investment that we choose to make. And I'll go more into that later.
Thanks, Brian. At this point, I would like to take a quick moment to provide an overview of the New York City retirement systems, which may be a recap of Alex Donier's earlier comments. The New York City retirement systems is not one large fund, but is actually comprised of 5 individual pension systems. The Teachers Retirement System of the City of New York, the New York City Employees Retirement System, the New York City Police Pension Fund, the New York City Fire Pension Fund, and the New York City Board of Education Retirement System. Collectively, the 5 systems are commonly referred to as the New York City Retirement Systems, or the systems. As of June 30, 2020, the end of our fiscal year, the total planned assets were a little north of $213 billion. And of this, ETI and infrastructure each make up about 1.2% of the total AUM, or approximately $2.5 billion. The recently increased new target allocation for infrastructure ranges from 3 to 4%, depending on the system, and for ETI, a flat 2%. With the recent increase that I just mentioned to the target allocation it looks like we have some work to do. Now, Petja, folks are probably wondering who qualifies as an emerging manager. Could you give us a little bit of background and walk us through the Infrastructure Emerging Manager Program?
Thank you, Chris. Absolutely. We are excited that this year we actually have in place an emerging manager program that we were working on last year. So now it's all set, and we are working with BlackRock as our partner, and Melissa Ding with BlackRock is here today as well to give you further insight into the program. Very broadly, the program would include funds 1, 2, and 3, and a target size of $1.5 billion US. And as I mentioned, Melissa would give further detail on the program a little bit later on.
All right, thanks, Petja. And Brian, I am sure some members of the audience are also wondering what exactly ETIs are. So could you give us an overview of the program?
Happily so. The ETI program stands for Economically Targeted Investments. It's one of the oldest ETI programs in the nation, dating back to the 1980s. ETIs are, synonymous in many ways with ESGs. Our job is to, target economic value into specific areas. For us, that is to benefit low, moderate, or middle-income New Yorkers in neighborhoods in New York City or the surrounding counties. Our investments, while we're up to 2% of the pension fund and we have 1.2% out, we actually, right now, with future capital commitments, have about 1.5% allocation. The important thing to note is we do this in a variety of ways. As you can see towards the right of the slide, Access RBC and AFL-CIO Housing Investment Trust are external managers who we work with to influence markets and provide liquidity where there might not be one. We have a number of real estate investments that are, while Access and Capital and AFL are fixed income products, real estate is directly purchasing of buildings, obviously. And then the PPAR loan portfolio, which is one of the only direct investing programs in the pension system. So it's very widely used by asset type, but fairly focused right now in affordable housing. Next slide, please. Now, investing with ETIs is not a backdoor into the other asset classes. It's got to pass the benefits tests and the fiduciary responsibility of any other investment, which means when we invest in an ETI, it has to be equal to the risk return profile has to be equal to any other asset in that asset class. So if we did private equity, it would have to match what we would expect from private equity. But it also must produce tangible and measurable benefits that we will report to the boards. And I should note, no venture capitals, no venture capital investments for the pension systems. And last, I'd just note that we do have a $20 million minimum in any asset class, and all investments in direct from the ETI group do need to be institutionally ready, though we can work with any first-time manager funds that might exist should one come about. Thank you.
Thanks for that overview, Brian. Now, some of you may be wondering how to get an infrastructure or ETI investment approved. Luckily, we have this beautiful chart that explains the process. And I should note that this process is the same for private and public asset classes. And also, before we dive in, just as a reminder, the New York City retirement systems have a strict ban on placement agents. So starting from the orange box, after the initial meeting with the manager, the asset class determines if the investment has legs to move forward. And if it does, the manager is invited to present at a green light meeting attended by the CIO, deputy CIO, risk, and the asset class head. If the investment gets the green light, the full due diligence process starts with the staff from the asset class, compliance, legal, operations, risk, and the consultants. After the due diligence is completed, the asset class staff presents the investment to the internal investment committee. And if approved by the voting members of the investment committee, the manager is invited to present to the trustees at the common investment meeting, otherwise known as the CIM. So from the initial meeting to getting the investment approved at the CIM, we are looking at a minimum of 6 months. And it can take longer, depending on factors such as calendar volume and specific legal, compliance, or other issues that may come up during the due diligence process. So the biggest takeaway regarding the process is 1, please give us time, more specifically a minimum of 6 months time, and 2, no placement agents. Now, if we go to the next slide, the ETI process is very similar to the process just outlined for infrastructure, except that the ETI team works closely with the relevant asset class to get the investment approved. The ETI process also involves a RFP, and the proposal can get lengthy, so we very strongly suggest that the managers talk with us first before starting the proposal, as we can give feedback and guidance on what may or may not fit with our program before resources are spent on putting together the proposal. Just as a note, we have an open door policy for meetings, so please do not hesitate to reach out to us and ask us questions. As with the rest of BAM, ETI also has a strict ban on placement agents. So the biggest takeaway from the ETI process is 1, give us time, 2, talk to us before completing a RFP proposal, and 3, no placement agents. That pretty much sums up the Comptroller's Office's process. Now that we covered that, Melissa, could you introduce BlackRock and give us some background on how the Emerging Manager Program for Infrastructure works?
Thanks, Chris, and happy to do so. So, hi, everyone. As Pecha and Chris mentioned earlier, I'm a member of the BlackRock organization in the infrastructure solutions business, which is the team that's specifically partnering with Pecha and the New York City pension funds to implement the inaugural infrastructure emerging manager mandate. BlackRock as an organization is likely familiar to some of you, being the largest asset manager globally, managing over 7 trillion of AUM and solutions across all investment types and strategies to meet our clients' objectives. Some of those on the line may have crossed paths with me or our broader business in the past, but for those who haven't, Infrastructure Solutions within BlackRock is a group that works with investors globally to invest into infrastructure funds, as well as direct co-investments through a multi-manager approach. And this is something that our team specifically has been doing since 2008. And today we manage $5 billion of LP commitments across over 100 investments in the infrastructure space. So this emerging manager partnership that we have now in place with New York City is something we are particularly excited about because investing with new managers has always been a part of our objective as a team, having backed several of today's leading infrastructure GPs when they were raising their first-time funds. In our view, this partnership is especially relevant and important because the infrastructure GP universe is still relatively nascent versus private equity and real estate, and especially when it comes to MWBE firms. But to provide some specifics on the parameters of the partnership program, as Pecha had outlined earlier, we're defining emerging managers as those firms raising closed-end funds 1 through 3, and targeting fund sizes of 1.5 billion in US dollar terms or below. And we're expecting to invest with emerging managers both through fund investments, where we'll make allocations of 10 to 30 million, as well as direct co-investments, where we'll make allocations of 5 to 10 million from this partnership. In terms of the types of emerging managers that we will evaluate, we have the flexibility to invest into a range of investment strategies, but overall we're looking to implement a diversified portfolio for the New York City pension funds. And based on the investment guidelines that we've agreed to, the partnership will focus predominantly on developed market opportunities, particularly in North America, with a weight towards operating assets across sectors, avoiding any particular industry concentration on a holistic basis. In terms of return profile, we're generally seeking to generate a blended 4+ value add like return on a gross basis through capital appreciation and through cash yield generation. In addition to investing with emerging managers, a key goal of ours is BlackRock, and as the New York City plan is to also advise new managers, lending best practices that we've gained from over a decade of infrastructure multi-manager investment experience and help GPs build their practice. So that's a quick snapshot of the partnership and how we're engaging the New York City pension funds. And we look forward to discussing it in more detail with this group in the Q&A and the one-on-one sessions. Thanks.
Thanks, Melissa. And now that brings us to the Q&A portion of the session. And it looks like we have about a little north of 40 minutes left for questions. To ask a question, please use the chat function on the lower left-hand corner of the screen, although I'm being told that it may be on the lower right-hand corner for some folks. There should be a blue circle with an image of 2 text bubbles. Once you click on the blue circle, a chat box will appear. Please use the chat room named infrastructure with what appears to be a green hashtag symbol. And I will try my best to quarterback the questions to the appropriate panelists, but the panels should also feel free to jump in with any additional thoughts. And while we wait, and it looks like there may be a little bit of lag, so why don't we start with a question for the consultants? Nick and Todd, would you introduce Axia and StepStone and explain the role of consultants in the underwriting process?
Sure, thanks, Chris. And good morning, everyone. Nick DiLoretta with Axia. And our role is to assist with vetting and underwriting potential managers for the infrastructure portfolio and program, both from an investment and operational perspective, to provide a holistic view of the manager and to ensure that it is an institutional offering for investment, and looking at all aspects of those areas throughout our diligence process. And happy to be with you all today and look forward to our conversation.
Great, thanks, Nick. Todd LaPena here with StepStone. Similar to the Axia role, we support Petya and her program in evaluating various aspects of primary investment. We focus on the organizations, the strategy, the performance, of course, of manager offerings in the marketplace. A lot of what we do is compare and contrast with similar options available to New York City. We also spend a good deal of time on the operational side, especially with respect to emerging managers, and we assist Petya and her team with respect to portfolio construction and pacing generally as it pertains to the annual strategic plan. So pleasure to be here with you all. I'm sure I've met many of you in the past and look forward to fielding any questions you might have. Thank you.
Thanks, Todd. So we'll throw the first question actually back to Melissa. What are some of the common challenges that you see emerging managers face, and what are some characteristics of your successful GPs?
So Chris, happy to address that question. Maybe I'll take the second one first. So in terms of the characteristics of our current successful emerging managers, I would focus in three areas. One, on investments, two, from an organizational perspective, and three, from a client engagement perspective. So when it comes to investments, the successful emerging managers that we've invested into historically have a differentiated strategy and a view on where the best relative value opportunities are. There are also teams that are executing in an area that they know well, rather than following what's in fashion and or focusing in an area that is not in their traditional wheelhouse. What we also see on the investment side is those who are successful are conservative. They have meticulous underwriting. They leave no stone unturned. They go to the center of the earth to find the right answer, and they cushion into their base cases. And finally, on the investment side, what I would note is that the ones who've been successful are the GPs who have a clear-eyed view on the business plan that they want to put in place for an asset. That includes multiple value creation levers in case one particular one doesn't pan out, and have experience executing on that. From an organizational perspective, those who are successful are those who have a team in place with mutual working history and a balanced team dynamic and chemistry. And for us, what that means is having a collaborative investment culture that's full of respectful challenge, which is quite important. Generally, we see issues arising when a GP becomes a cult of personality, and those firms oftentimes don't have a lot of longevity in them. And also from an organizational perspective, one to think about is that you're not only making investments, you're also building a business. So we're looking at GPs who are planning appropriately for the amount of investment and client activity that they'll have to support, including having a hiring plan in place, a budget, and identifying and putting in place the appropriate middle and back office support as they build their franchise. And then finally, upon some of the considerations from a client perspective, what we've seen is that the most successful emerging managers are the ones who are aligned with their clients. Usually this means having skin in the game in some format. So if we lose money, so do you. They treat their clients like partners. Ultimately, we're in the infrastructure business. And so when we invest with you, we're forming a multi-year relationship. It could even span a decade. And finally, we want transparency and honesty from our GPs. In particular, those who have been successful are the ones who over-communicate when things are not going according to plan and own up to their mistakes. The fastest way to lose credibility and trust is to clam up and paint an overly rosy picture in tough situations, and especially true kind of in this pandemic environment. And so, for us, what has made successful relationships with GPs is having that open dialogue. When times are tough, having a clear idea of the situation so they will work together and find a resolution or a path forward together. So hopefully that's helpful in illuminating some of the characteristics of successful emerging managers that we've invested into. And maybe, I guess, tackling, Chris, your first question on common challenges that we see emerging managers face. Really, there are, I think, a few challenges that emerging managers tend to bump into. I would say the most common challenge is gaining sufficient fundraising traction. And emerging managers tend to have issues fundraising for a few reasons. One, they don't have a portable or attritable track record from their previous employer. That makes it difficult for clients to underwrite them. Two, they don't have the capital really to get deals done. This results in blind pool funds that are hard to commit to for a first-time manager. And then, this really becomes a catch-22 situation. And three, oftentimes, new managers, they don't have a large LP network and therefore don't know who the appropriate people are to talk to or how to navigate LP processes. They also might not know for which clients their strategy would best resonate. For instance, an insurance company might have different considerations than a pension fund. And I guess what I would say is that, as BlackRock, having been in the market for over a decade, back when there were very, very few established fund managers, we had to come up with a process of underwriting and helping first-time funds, again, around some of the challenges that I had outlined. And to address the first 2 points, typically we'll always, at BlackRock, work on a co-investment transaction before or alongside fund due diligence for a new manager. And this provides us with an opportunity, in our view, to gauge a manager's sourcing capabilities, their underwriting quality, and their view of the world. And it helps us due diligence them in situations where there's limited track record. And this benefits, in our view, both the client, but also the fund manager, because the fund manager gets access to capital to execute on their transactions, also helps build their track record and bridge fund commitments. And then, for us, we benefit insofar as we're able to provide co-investment exposure to our clients, but also better help underwrite those managers. I would say outside of investment activities, we also aim to help new managers by introducing them to other clients where we have close relationships as a BlackRock organization. We will actively serve as references for those managers that we back, and make introductions to placement agents, not relevant for New York City, of course, but more in terms of other potential institutional managers. And whether we're committing to a fund or not, we also serve as a sounding board to help GPs better navigate the fundraising process. So hopefully that addressed the question that was raised. I'll turn it back to you.
Thanks, Melissa. That was very, very interesting. Now, if we, I guess, turn to ETIs, I was just wondering, Brian, how does ESG play into your investment thesis for ETIs?
So ETIs are, by definition, connected to ESG. We are looking to benefit low, middle, or moderate income New Yorkers. We're looking to invest in New York City. We're looking to, have the best impact we can on the world. I can say that ESG is generally important for almost any investment across, the asset, the investment systems. It's something you might get asked about by trustees. If you're a public company, you might experience our corporate governance group getting involved with ESG issues. But for us, it's a very proactive investment thesis. So when we're looking at investment, we're going to want to know, A, what's your impact? How are you benefiting the world? And how can we measure it? This often involves a lot of back and forth and sometimes, disagreements. Is job creation something that is benefiting low and middle income New Yorkers in a way that, say, affordable housing isn't? All of this would be something that we would want to talk about. So, and particularly since we're investing in literally the neighborhoods where our trustees live, we're going to pay a lot of attention to what the impacts are. So probably not going to be building a coal mine in the middle of Brooklyn. But with a lot of the new laws about design build that have been passed in New York State, as well as some other positive trends that have been moving for wind farms by Cuomo and some moves by Con Ed to produce renewable energy sources. We're very optimistic that there's potential ESG, ETI, infrastructure connection, in the future. Thank you.
Thanks, Brian. And I guess in terms of strategies that we see as most interesting right now, Petra, I was just wondering, in the infrastructure space, what are you seeing? What's sort of piquing your interest right now?
Thank you, Chris, for this question. To state the obvious, we are long-term investors, so we do look at things, and strategies that pop at certain times, but at the same time, we do need to think about the sustainability of a strategy long-term. So we always look at all strategies and see what the risk-adjusted return is, try to understand the profile. I think it's fair to say that we have found strategies that are broader and include a few sectors or a few geographies to be more attractive, because they allow the GP to move if the workflow in one area, for whatever reason, is lower. If we think about renewables, if there are some retroactive changes and the opportunity set is not attractive, this would allow them to go into a different area. And the same would happen geographically. So I would say we are open to exploring all strategies, but broadly, strategies that are multi-sector, multi-geographies continue to be interesting.
Fantastic. Thank you, Petra. And I was just asked to ask a question. It looks like some folks may be having technical difficulties. The chat function is in the bottom of your screen. It should be on your lower left hand side. And if you go to the infrastructure chat room, the questions can be submitted into that chat. So thank you, Petra. And I guess this is a question for the consultants again. How does a prospective GP make themselves compelling to the consultants? They may have the right strategy and they may have the right people, but sometimes it's just sort of getting noticed. So I was just wondering, is there a process in place for Axia and StepStone?
Sure, I'll start.
Sure.
Thanks, Chris. I think it's part of our role to canvass the market and landscape and understand who's in the market and what their strategy is and how they're trying to differentiate themselves. And so being able to kind of dissect the market that way and kind of provide that relative assessment and really what or how managers can make themselves stand out is really answering the questions of why and how, and why are they targeting the sectors or this specific strategy, and how they're doing it, and digging beneath the surface to provide kind of better insight and granular information, because you can kind of play manager bingo and each kind of marketing meeting kind of sounds the same. And so you want to kind of dig beneath that, have a good conversation to really understand those two critical elements of why are you doing this, how are you doing this, and why that matches up with the current opportunity set and investment landscape.
I'll jump in. Thanks, Nick. From the StepStone perspective, I guess we could add when and where and with who to round it out. We obviously want you to be focused on execution. How soon can the strategy be executed? And so if proof of concept is pretty key. If you've got some assets, seeding a fund or well advanced, pipeline, that is clearly helpful to considering you for the portfolio. From a geographic standpoint and sectorial standpoint, want to be sure that you're focused in the geographies and in the sectors that fit with your strategy and the team's background. So that's really key. And related to that would be ensuring you've got the right asset management expertise as part of your team or have access to it. This is often something overlooked by newer managers who may come from more financial backgrounds or even industry backgrounds, but haven't necessarily operated or managed the very businesses they intend to acquire on behalf of LPs. And of course, the who part of it, it really relates to the team. Who's on the team? How large is the team? Is the team large enough? to manage the targeted fund size and the number of assets you expect to acquire. If it isn't today, is there a clear path to building that team so that LPs and investors like NYSERS can have assurance that performance will be there? Back over to you, Chris.
Thanks, Todd. And, besides the pandemic, the thing in the news recently has been the elections. Brian, I was just wondering, has the recent elections impacted the ETI space at all?
So it's a good question. ETIs tend to benefit from government involvement. If you think of one of the things I said was, we have to make a risk-adjusted rate of return equal to whatever asset class we're investing in. By definition, that means that either we're searching for market gaps. And one of the ways that we lower risk to kind of even things out is often working with government. So while the election, as of yet, hasn't had an impact, there are a lot of potential impacts that we are preparing for and getting ready for. An increased rise in corporate taxes, for example, while we would traditionally look at the impacts on the stock market, from an ETI perspective, we'd also look at what the effects that would potentially raise the value of LIHTC and other tax credit equities. Those things make investing in affordable housing far easier. And that is before we start talking about things like the potential large infrastructure bills or things like that that have been talked about, all of which come with opportunities to consider. So change, is always represents an opportunity, and I think this time in particular we are optimistic about some positive opportunities that will be coming in the next few years.
Thanks, Brian. Thanks for your insight. So the at this time, just wanted to, I guess, turn it back to the panelists in terms of, besides the elections, I know Melissa sort of touched upon it a little bit earlier, but has COVID changed the underwriting process for your respective perspectives? And I guess maybe, Melissa, I know you talked about having the importance on transparency, but has the actual underwriting process changed much?
So nothing fundamentally about our underwriting process has changed with COVID. There was a period of time in March when we and our clients were focused more on asset management, given uncertainty around the situation, but we're fully now open for business and making commitments to new managers. I'd say the main logistical difference is that we are now doing due diligence calls over VC rather than doing due diligence in person. But we haven't found that to be a barrier to our underwriting process. If anything, I think we're having more frequent and more detailed conversations now with new managers. So that's been actually a net positive. I would say what has changed in our underwriting is that we're now evaluating strategies with a COVID lens, meaning that there's a greater focus on strategies that we believe are better positioned to weather the COVID-19 related disruptions and heightened scrutiny. I mean, this has always been the case, but even more scrutiny on managers' underwriting practices and assumptions. So we're looking to invest ultimately in resilient assets that protect the downside. It's always been the mantra of our infrastructure investment team. That's especially important now as we back managers through the continued crisis into the eventual recovery, because there's still a lot of uncertainty around what that looks like. I would say what also has changed is that probably, prior to the crisis, there was, some partiality to funds that had some visible seed assets already in them. That has certainly, flipped on its head post-crisis. And so, now there's focus on diligencing assets that might already be in people's funds, understanding the key risks and the resiliency of the business plans to COVID, and analyzing the robustness of the downside, because what we wouldn't want to do is to invest our clients' capital into assets that were bought into pre-COVID that whose underwriting cases may no longer be relevant with a COVID environment. And so I guess the advice that I would give to managers on this call is that when you speak to clients, to the folks on the line, be prepared to discuss in detail your strategy in the context of COVID, how you plan on navigating the new environment, where you see opportunities and where you see risks. And to the extent that you already have made investments, what is the real impact of COVID to your investments? And to echo a point I made earlier, be transparent about it.
Thanks, Melissa. And with that brings us to the end of our program. I want to, unless there are any final thoughts from our panelists, I want to take a moment to thank the panelists for sharing their time and insights. And if you have any more questions, please feel free to contact us. And our emails are up on the screen. And once again, thank you for attending this year's New York City Comptroller's Annual Emerging and MWBE Manager Conference. And have a wonderful rest of your day and happy holidays. Thanks, everybody.
Hi, good morning, everybody. Thank you so much for joining us. I am David Enriquez, Head of Private Equity at the Bureau of Asset Management, and we are delighted to have with us our key partners who we work with on a very regular basis, from Axia Torrey Cove, Stepstone, Hamilton Lane, and Neuberger Berman, and you'll hear from all of us, as you see on the screen, during the session, and we'll also be having a Q&A session at the end of our presentation. So maybe it makes sense for us to go first to the slides, and I'd like to share with the audience a bit of an overview of the New York City private equity portfolio, and then explain to you our approach to private equity investing. So if we go to the first slide, here we are. So as many of the GPs who are tuned in are aware, we're a fairly sizable private equity portfolio. We have a $12.7 billion portfolio measured by net asset value, which represents about 6.5% of the overall New York City retirement systems portfolio. The other thing which is important to note is that at the Bureau of Asset Management, we are the fiduciary advisor to 5 separate systems, and they are New York City teachers, employees, police, fire, and the Board of Education. And when you look at our strategy, you can see from the detailed breakout pie chart, our portfolio is primarily buyouts, representing a little north of 60%, and then special situations, growth equity, secondaries, and co-investments, which I'll touch upon later. And from a pacing point of view, you could think about New York City as pacing in the range of $3 to $4 billion a year into private equity funds. So that may include large global funds in our portfolio, which will fall into the buyout category. But as is the theme of this conference each year, we are also very committed to the emerging manager opportunity set. And we'll speak about that in more detail. And if we go to the next slide, our team is managed by a 6-person team. Many of you have met my colleagues. The most senior in terms of tenure in New York City are Inash Kajela and Fumi Ladiju, who've been with the team for over 5 years. And then we've had some recent additions to the team, including Nick DeSimone, who joined us about 2 years ago, and then Christian Norambuena and Katya Salavara, who joined us in 2019. And the team received support for Marina Borsic, who is an analyst who supports all of private markets. And when I think about, and maybe I'll pause here and not necessarily go into the team, but just reflecting a little bit upon the calendar year 2020, right? We've all experienced the pandemic and the remote work environment. But what I'd probably like to do is give you a quick overview of what our experience has been. When I think back to December of 2019 and the pipeline of fund commitments and the strategic initiatives that the staff were working on alongside our private equity consultants, as we now are in December of this year, I'm really proud of the work that this team has done because we've been executing without missing a beat. I think we'll close on approximately, let's say 11 fund commitments. We may have one that drifts into January, but we're in the process of finalizing legal negotiations on the LPA and commenting on the legal documents. But we are pretty much 95% on top of what we wanted to accomplish this year. When we think back to like the darker period of the pandemic, when it first hit the United States in late March and early April when we all went remote, what we did was we took a bit of a pause and assessed our pacing, the impact of valuations and public markets on the broader New York City portfolio, and we coordinated with our consultants to try to assess what is the state of the private equity portfolio, what should we be doing from a pacing point of view. And what we ended up executing in 2020 was the plan that we had in the fourth quarter of 2019. And I think that's critically important because what we did was we sort of kept to our discipline of consistent pacing. I think one of the lessons that New York City learned, and maybe even the broader LP community learned from the global financial crisis, was that it's important to have vintage year diversification and to have consistent pacing. So when I look back at 2020, that's what we executed. And as I look forward to 2021, that's the way we're approaching the market. So from a pacing point of view, the real story for New York City is one of consistency. The other part of our title for this session is priorities. What are our priorities as we look forward over the next 1 to 2 or 3 years? I had referenced co-investment on the initial slide. We have currently about a 5% exposure to a co-investment strategy. And our Chief Investment Officer, Alex Donier, in his opening remarks, also mentioned a strategic initiative at New York City to have co-investment programs in private equity and real estate on the heels of a successful launch of our colleagues in infrastructure who have an active co-investment program. So I'm delighted to share the news that earlier this year, our boards of trustees approved a private equity co-investment program, which we are now in the process of finalizing. And this is a program where we're going to partner with a global firm with a separately managed account to mine the co-investment opportunities from our core portfolio managers and to achieve better returns for our fund and for the beneficiaries of the 5 systems. Our goal is to have that operational in the first quarter of 2021. The other priority, I'll circle back to this theme of consistent pacing. When you look at our pacing of $3+ billion a year, it's historically been, and I expect it to continue to be, a combination of re-up commitments to our high conviction existing managers, selectively adding top quality GPs into our portfolio that may address certain areas of white space. And by white space, by example, what I would reference is in the past couple of years, we've added some mid-market managers, both in North America and in Europe, because we had less exposure to the mid-market. And finally, but just as important, will be a continued commitment to the emerging manager opportunity set. And if we go to the next slide, on emerging managers, what's important to note is that our experience in New York City has been an evolution. We started doing it in a bit of an ad hoc approach initially, and then, like many other public pension plans, we sought expertise from third-party managers, and we had several fund-to-fund programs to get exposure to emerging managers. And then our approach evolved in 2012 when New York City took the emerging manager effort in-house and started a direct emerging manager program for private equity, where the private equity staff would source, engage in dialogue, identify opportunities, conduct due diligence, and make commitments to promising emerging managers. And that was a program that was very successful. And as some of you may know, it was actually led by our CIO, Alex Donier, who had joined the Bureau of Asset Management in 2012. And the program was effective and was reauthorized twice. Once in 2015, where it increased from $425 million to $500 million. Most recently in 2019, where it was increased from $500 million to $600 million. And those incremental increases from 15 to 19 was about 20%, and that represented the growth in that opportunity set, as well as our own conviction in our ability to achieve private equity returns with new and emerging managers. The second leg of our approach to emerging managers is one that we launched this summer. So at the end of the second quarter, we closed on a very innovative program across all of private markets, but in private equity, we closed on a $621 million program with our partner Neuberger Berman, and you will hear from Pat Zoller later in this presentation. And that's a program that's addressing the earlier stage and even smaller managers as they spin out and launch a franchise. And if we go to the next slide, you will see here, this is an overview of our direct emerging manager program. As a reminder, this is the program that we executed on in 2012, 2015, and currently the 2019 program. And in this program, we're identifying private equity managers who are raising less than $1 billion on the cover of their fundraise. Now, what we also do is we don't have a Roman numeral requirement, but it's in the spirit of helping managers who are setting up a new franchise and building a business. What we find, as we heard in the discussion earlier today about diversity, whether it's ethnic diversity or gender diversity, we all know that the private equity industry is one that has much more work to do with respect to diversity. But what we also know is that it will take some time because of the nature of managers where they like to home grow their talent from the junior levels as they rise up through the ranks. What we've discovered in our experience with emerging managers going back to 2012 and even before that, it's really in this universe of spin-out teams, of fund formation, where we can find a very attractive combination of investment talent and diversity. And when we look at our emerging manager roster of general partners, we have approximately 40 to 45% of them are led by women or minorities. And when you look at our program guidelines, what you'll see here is we tend to target commitment sizes in a 6 to 8% of the LP base. And that sometimes has led us to commitment sizes that tend to range from $35 million to $75 million. In terms of strategy focus, it's consistent with what we're doing in our main portfolio: buyouts, growth equity, special situations, and secondaries. And we have a long-term goal of targeting 10% of our annual pacing to emerging managers. As you can see at the bottom of the slide, up until November of this year, we've committed about $1 billion to 19 emerging managers from our direct program. What's really exciting for us is how the private equity team innovated and structured what we call the New York City Neuberger Berman Northbound Early Stage Emerging Manager Program, which you'll hear about in a moment, to target that earlier stage. Because as you can see on this slide, when you look at our commitment sizes of $35 to $75 million, and you look at the average fund size in our direct program at about $570 million, what we realized was that we were missing a part of the emerging manager universe in private equity that was smaller. So let me turn over now to my friend and colleague, Pat Zoller from Neuberger Berman, where she can explain more detail about our exciting new program that we have with her and her firm.
Good morning, everybody. David, thank you very much for that kind introduction. I am delighted to be here this morning to address the Northbound NYC Emerging Managers Program. We were delighted to have been chosen to be your partner in this space, and believe that as part of our history of investing in emerging managers, we started the Northbound Fund back in 2007, which you know well because New York City was one of our early investors then. And over time, like you, as we've continued to invest in emerging managers, the growth of the marketplace, the opportunity to invest over the long term with these managers just continues to keep us very excited about the space. In fact, I'm a partner within our private equity business. Started Northbound, as I said, back in 2007. And when you look across our private equity platform, we're committing about $10 billion annually to both funds and co-investments. When we look at part of that platform, we've invested in more than 70 first-time funds and strategies, invested in almost 80 minority and women-owned management firms over the last decade, and we are committing almost $4 billion to funds that have less than $750 million in size. One of the great opportunities that we have as part of this program, because it's a global program, again, with meaningful allocations to Europe, the expectation is that our more than 80 investment professionals around the globe that focus just on primaries and co-investments will be able to bring some meaningful opportunities to this portfolio that we're managing on your behalf. So just to give you a little bit, to give the audience a little bit more background on what it's intended to do. As David said, the plan is that this will do things and go places that you aren't already doing internally. So importantly, as opposed to the $1 billion in fund size, we're looking at those managers that have funds that are less than $750 million, really standalone first-time or second-time institutional funds. The strategies that we are looking at in this program are mostly buyouts, but we expect a meaningful piece to be both the growth and special situations. No venture in this portfolio, but with these three asset classes and strategies, there are numerous opportunities around the globe to find great opportunities for this portfolio. And we'll be doing primaries, co-investments, and secondaries. You mentioned your new co-investment program that's going to be launching in the first quarter. Being able to do co-investments in this program, we also think is meaningful, especially for first and second time funds. The ability to be able to bring capital for co-investments, we believe, gives many managers an opportunity to start to develop an attributable track record. And so not only can we do co-investments once we invest in the fund, but we're happy that you allowed us the opportunity to do a co-investment even before a fund is raised and then sell some of that down into a fund. So again, a really meaningful way to be able to impact the launch and the growth and the development of a first-time fund. And then the sizes that we're looking at, it's certainly smaller on the lower end because these will mostly be fund sizes that are smaller, but down to 15 million and then up to 60 million. And that 60 million is actually designed to actually allow us to do a few different investments that are more strategic, a few investments that actually allow this capital to come in and to be able to really launch a fund, to be able to negotiate, opportunities for follow-on funds, and the opportunity to bring, all of the strategic advice and guidance to both the New York City program as well as the Neuberger Berman program can bring to bear on these managers. And again, as I said, it's a global portfolio focused on North America, Europe, and Asia. So I know I'm going to have, after this, we'll have a chance to do some one-on-ones. I'm very much looking forward to those. But, as an overview, this is a strategy. One other thing to know, we've got an open door policy. My information will be part of this. And so any managers that, that fit this category or want to learn more about what we're doing for New York City, me and my team would be delighted to meet you. With that, thank you very much.
Sorry about that. Thank you, Pat, so much for that overview of our program. And on this slide, for the benefit of the general parts who in the New York City portfolio, I just wanted to briefly review what our process looks like. And it's not dissimilar from most limited partners and institutional investors, but we just wanted to give you a bit of an overview. Like in many instances, the key is really establishing a dialogue with the Bureau of Asset Management, with the private equity team, as well as with our consultants, right? And we've made commitments, to emerging managers and more established funds, after a period of getting to know them and monitoring performance. And then one element in the second column, which is specific to the Bureau of Asset Management and New York City, is what we call the green light meeting. And the green light meeting invited me to present to the investment committee, and it's usually an hour or an hour and a half meeting over strategy, track record, team, market opportunity. And the purpose of the meeting is for the IC to understand the opportunity, discuss it with the private equity team, and then to determine and vote whether to provide a green light to go into full due diligence or whether there are some follow-up questions that we need to address. Assuming the green light committee approves moving forward with diligence, then the next step is the Bureau of Asset Management private equity team would schedule on-site due diligence with the manager. We would also notify our 3 private equity consultants that we are moving forward, and oftentimes they understand where we are in the stages of dialogue. Internally, we will also let our risk and compliance team know, since they will be leading some of the effort on operational due diligence and compliance due diligence. And this is the other piece, a public plan that's very important, and that's bullet point in the due diligence column. We will also share with the manager and ask them to complete our disclosure schedules, and also to understand our policy advisory notice, which summarizes some of the requirements that New York City has in its side letter when we make a commitment to a private equity fund. Once the due diligence process is completed, the private equity team at BAM prepares an investment committee memo that would be presented to the BAM investment committee. The consultants also would prepare their own recommendations on the opportunity. Then there's a 2-step process in terms of formal approvals. The first step is the BAM investment vote. And so that takes place. We have weekly investment committee meetings. And then once a recommendation from the PE staff is approved at investment committee, it would go to the board, the 5 boards of trustees. And there's maybe a bit of an asterisk here. So for non-emerging managers, more established managers, say raising north of $1 billion, right, or a new strategy within an existing private equity platform, those would go to the boards of directors. For the direct emerging, there is discretion at the staff level, and that would be final business approval would be at the BAM investment committee, and then we would continue legal negotiations to close. And so then the question is, when you look at these 4 major steps in our process, how long does it take? And I would say that typically it's a 4 to 5 month process from beginning to signing subscription documents and closing. The key element we have found at the staff has been to try to take the legal process and the legal negotiations and to try to run them simultaneous with the business due diligence. And in that way, we can sometimes shave several weeks of the process. And that's usually what we aspire to do. And so at this point in the presentation, what we'd like to do is have our 3 private equity consultants present a little bit on their firms as well as their process, so the GPs who are tuned in can understand their role in the New York City investment process for private equity. So with that, I'll turn it over to Michelle at Axia Torrey Cove.
Great, thank you, David. Good morning, everyone. I'm Michelle Davidson. I'm a partner at Axia and co-head our advisory activities in the U.S. And as David noted, just want to quickly walk through our process at a high level and note that the process is the same for both established managers as well as emerging managers. And one thing that may be a little different from some other firms that you've dealt with in the past is that our process is completely separate for investment due diligence and operational due diligence in terms of having separate teams focus on each of those aspects of the process. And so the investment research team really focuses on strategy, team, track record, how managers source their deals, how returns are generated and at what level of risk, and is this repeatable? While the operational due diligence team focus on processes, procedures, internal controls, legal terms and agreements. You're looking for things like conflicts or overall alignment, and just in general business risk or potential for fraud. And throughout all of our processes, we work very closely with our clients. We call our model an extension of staff model, where we share updates frequently through calls and also on our systems, which is our Max portal, where we'll share manager meeting notes, reports, and fund analytics. All of that's accessible to our clients on a real-time basis. And then our focus is really not on conducting due diligence and then going on our way for the next couple of years. We want to be continuously engaged with managers and get frequent updates through regular calls and meetings and AGM attendance, whether managers are in the market or not. Just want to stay abreast on their activities, continue to know them, which has frankly been very helpful during the COVID environment where on-site meetings are limited. To just have prior history with managers over sometimes many years is certainly helpful. Then if we could go to the next slide, please. Thank you. And typical consulting slide, bunch of arrows pointing to the right, but it does highlight our due diligence process and how we think about manager evaluations. So it really starts with sourcing investments, and there we do that in a variety of ways. And I know when I started in the private equity business many years ago, there were a couple hundred funds in the market. A little easier to cover them effectively with 1 or 2 people that could be generalists. But today, with several thousand funds in the market at any point in time, we found it's necessary to specialize to really effectively cover all the different managers and strategies. And so our research team is divided by sector. We have specialists covering all the major sub-strategies and geographies within private equity. And the sector teams are really tasked with knowing the full spectrum of managers in their respective space. And particularly as funds are successful, there's a tendency to raise larger and larger funds. So we want to continually look for new and emerging managers to maintain that exposure to the lower end of the market. And that includes both spin-out teams as well as completely new groups coming together. And it's also a focus for us across the firm. So all of our professionals will attend conferences focused on emerging managers. We have a completely open door policy around meeting with managers, and managers can contact us directly on our website. And we also have a dedicated email address, which is diversemanagers@axia.com. So MWBE managers can contact us through that email, and we'll make certain they get reviewed and highlighted to our clients. Based on all those different sources, we build out a forward calendar of opportunities in the market, or those that are expected in the near term. And then for funds that are actively raising capital, we'll put the opportunity through our process, and that starts with what we call a preliminary screen and then further review. So here we're looking for things like, is it an institutional fund? Is the management team sufficiently built out? Do they have the right type of experience? And is the strategy differentiated in any way, as well as other factors? But if a fund does not move forward, we'll let the manager know why. But each step of the way, we are constantly communicating with our clients, often through regular pipeline calls. And that's where both Axia and our clients, such as the New York City Board of Education and the Bureau of Asset Management, will discuss managers that are of interest and if they could be a fit for their program. So we'll jointly agree on which funds it makes sense to move forward with further diligence. And that's represented here in this graphic by what we call deep research. So that may start by sending our due diligence questionnaire, depending on what is available in the data room. And focus will be on really diving into prior deals so we can assess how value was created and is that replicable and by the current team. We'll look at firm economics and how they're allocated. And here, really looking at both alignment, particularly for larger firms, and then sustainability for startup firms. Do they have the economics that'll tie them over? And also evaluating whether the team is incentivized to stay together over the long term. Just given the long-term nature of private equity funds, just want to make sure economics are not going to be a source of contention a couple of years down the road. And we typically conduct an on-site visit, but these days they're virtual site visits with the manager. We want to meet both key professionals as well as junior professionals and walk through prior investments in detail. Our operational due diligence team will spend time with back office professionals and any third-party service providers and dive into the legal documents. So we'll also conduct extensive reference checks and in many cases background checks. But I would note that we typically only put managers through full due diligence if there's a high likelihood that there will be a fit with one of our clients. We don't want to create unnecessary burdens. We want to get to know managers and have a lot of information on them, but the full due diligence process is pretty intensive. So we reserve that when we know there's a high likelihood of client interest. And then if our results of diligence are positive, the opportunity will go to our private equity investment committee for approval, and that will be approval for a specific client. And then after approval, we can provide our investment and operational due diligence memos to the client along with our recommendation. And then in terms of negotiation and execution, for many of our clients, like the Bureau of Asset Management, on behalf of the Board of Education. They do use outside counsel, and so we will weigh in on the business terms, but are typically not directly involved in the negotiations. So that's a bit of a summary of our process, and happy to answer questions afterwards. Look forward to meeting some of you in the one-on-one sessions, or hopefully in the near future. But in the meantime, I will turn it over to Mike Koenig of Hamilton Lane.
Great, thank you so much, Michelle. So my name is Mike Koenig. I'm the Chief Client Officer at Hamilton Lane, and I lead all of the client-facing elements of our business. I'm also a member of our investment and allocation committee. So specific to this, I have a lot of experience with our investment process and how it works. And so what's on the slide that's in front of you is a summary of that. I thought I'd go through a little bit of this, but then also try to give some sense on what our focus areas are in each of the steps, and how we think about as we talk to and work with GPs, kind of preparing them and what their expectations might be for working through our process. So for us, it starts with really with sourcing. So what we would like to do is cast the widest net possible, see as many potential opportunities as could be available. We have a really large team that is designed to examine the market, to determine when opportunities are likely to come back, to reach out to general partners in some examples. But one of the best sources that we have in terms of finding out about investment opportunities is through our website. We have a button right on our website that says Submit Investment Opportunity, and so general partners go in there. There's some forms to fill out and some documents to upload to begin the process for them getting to meet us at Hamilton Lane, and for us getting to know that general partner more. And you can see some of the stats on the right side when we think about sourcing. A little over 1,000 funds. These numbers are from 2019. And so a little over 1,000 primary funds that we've seen. We think that's a really representative share of the full market. And a lot of that is because the general partners out there are actively providing us information. That's a really important step. So after we get that information, at least an initial look of it in, we assign a team to it that prepares a screening memo. So this is a several-page memo for all, in this case, 1,000 of these opportunities. It's presented to our investment committees. It looks at the overall opportunity set that the manager is describing. It looks at the initial track record, and it talks a little bit about the professionals, the team, the experience, and the approach. And so this is for us a good early indication of what that general partner is trying to go and target in the market. And we talk about that at every investment committee and try to then think about how does that move forward. And so the next step for us is what we would call an initial due diligence. So this is where we start to get a little bit more detail about that investment opportunity. So you could think about that a little bit like the middle box here on the right side, or the middle set of circles. We're meeting with the general partners. That typically is in our office, although I think we all know over the course of the last year that those have all been virtual. And we focused really hard on being able to maintain that element of this process, still spending time with general partners, as many as possible up front, as we start to think about the investment opportunity, even in a virtual or Zoom or Microsoft Teams environment. And so at that point, we're starting to add to and supplement that initial screening. We're starting to dig a little bit more deeply into track record. And so there is one of the big expectations, I think, when we meet with managers. It is our expectation that they will bring and present to us a well-defined track record, or a strong pre-fund track record that they have attribution for. So that's an important kind of element to that initial due diligence. The reason being, as we continue to move forward and we get to more what we would describe as full diligence, one of our really important outputs and one of the really important pieces there is a full attribution of that known track record. So whether it's at the partner level, whether it's at the type of company, whether it's at the level, the amount of leverage on a business or the price paid. We try to look across the track record and understand, in terms of what replicability, what has gone on in the previous track record that is going to happen in the future. So that track record piece is important. That then again moves us into full investment diligence, which is a lengthy questionnaire. It's a full day site visit. So again, in terms of expectations, Hamilton Lane comes on site to the general partner's office for a day, meeting all of the senior, and in some cases, many of the many people in the entire firm. We spend time talking about the companies in the track record, in the portfolio, or in the sort of experience set, if you will, of the lead partners of the investment opportunity. And similar to Michelle's comments, we recognize this is a lengthy and time-consuming process, and so we're trying very hard to do that in places where we know there's something actionable in terms of our client base. And so the piece that goes along the side of this process the entire time is connecting that back to our clients, looking at what our strategic plans for our clients are, thinking about how those pipelines are building out, and understanding that there's this real nexus of the work that we're doing and the needs of our clients, so that what we aren't ending up with is just an approved list of investment opportunities. We don't operate our business that way. We operate our business to complete final due diligence on a set of opportunities that are going to get capital commitments from some form or fashion of our clients. And so it's that reconciliation of it all is important. As we keep moving through here, operational due diligence comes in, background checks, a separate site visit by a separate team. Our ODD team reports to our head of risk management, so it reports to not within the investment team, but within our risk management function. They are scheduling a separate and dedicated site visit. And in many examples, we're trying to play a role in helping the legal negotiations. Clearly, in the example of New York City, they have their own counsel that they're using. But in many of our clients are benefited, we believe, from having us execute on some of that. And then finally, which leads a little bit into my next page, which I'll talk just about briefly in a second, is the ongoing monitoring and reporting. We expect in terms of what we prepare for our clients is an in-depth review of opportunities and actual investments that we've made out into the future. And so that means attending annual meetings, advisory board meetings, GP update meetings, again, all a little different in the environment that we're in, but something that is, we think, really, really important, because if we now shift to the next page, I'll hit just a couple pages at the bottom here. We think that it really doesn't end with due diligence. This is about building relationships with general partners, and sometimes it doesn't even start with due diligence. So what we would like to do is have those relationships and have them not even necessarily when a manager has a fund in market, but be talking to general partners and to investors throughout the cycle to understand what they're preparing for, when they think they'll be back to market, and really trying to build a relationship that has a series of frequent contact points, so that we think we're in a better position when the time comes and to execute on that diligence process. The other piece that again is important to us is technology. We have spent a lot of our time and resources at Hamilton Lane on building our technology infrastructure, and it's specifically designed so that as information comes in, the good example here is as information comes in from general partners, whether that is a phone call that we've had, whether that's a meeting note, or whether that's a track record and a structural piece of our due diligence process, we're able to have elements of technology that anyone in the firm, where appropriate, can see that, so that when any of our client people are talking to their client, we're speaking to the same set of central facts about a general partner and investment opportunity. When we're just thinking about the market as a whole and understanding how all of that pieces together, that becomes very important, that technology becomes the catalyst for it. And so when we think about this blending art and science, technology has really helped inform the science part of that. It's also in some ways, the art of this is relationships and communication. We've built technology and workflow systems that don't just look at the nuts and bolts and mechanics of it, but describe the way we're interacting in the investing community overall. So that's an overview of our process. And again, I tried to hit on what I think are some of the key elements and expectations. And so with that, I will turn it over to Jose to continue the presentation from here.
Thank you, Mike. And I'll keep it brief so there can be some time for questions here at the end. And part of it because a lot of what you've heard from Michelle and Mike would apply to the process that we follow. And let's start with Jose Fernandez. I'm a partner with Stepstone. I also have an operational role as co-chief operating officer, but most of my time is spent working with clients and on the research side, where I lead alongside with another partner, Tim Weld, our small buyout sector team, which is where a lot of the emerging managers that we consider here, as you saw that most of the portfolio for New York City is in buyouts. That's where most of the managers are sourced. But we also have dedicated sector teams for growth equity, special situations, secondaries, who would be analyzing your fund if you are in one of those categories. But in terms of the most important part of our process is obviously getting into the process, and that's very easy to do. As others have mentioned before, we also have an open door policy, and the easiest way is our contact information is in the materials for the conference. Myself, my colleagues, Mike McCabe and John True, that also work closely with New York City. You can contact any of us by email, and we'll make sure that the right sector team is in touch with you, has a meeting, gets to hear your pitch, and gets all of the information into our database that is available to all of our clients. New York City being a very active user of that database. So if you're having a meeting with us, the team at the Bureau of Asset Management will know about it, and we'll see the notes, and we'll see materials that you share with us. So once you're in the process, then it follows. There's the stages here. Really, just for you to know, again, I think as others have said, we will take that initial meeting and subsequent meetings, but only advance to a full due diligence process once we have a good client and portfolio fit for the opportunity, because it is a time-consuming and involved process for both the manager and for us. And maybe go to the next slide now. Just so the one thing I just wanted to make sure to illustrate here is that throughout that process, we're in constant communication with the Bureau of Asset Management. So they, as we progress through each stage of our process, and the Bureau of Asset Management progresses through each stage of their process, we're in constant communication throughout. And so I would say you can talk to us, you can talk to them. Obviously, you should talk to all of us at the same time. But just know, usually what you tell us, we are comparing notes with the Bureau of Asset Management with respect to that, and also our thoughts on the opportunity. So I think given the time, I'll just turn it over back to David, because again, I think the key takeaway is, remember just how to get in. You just contact us directly. We will make sure you are in touch with the right people and you get the right attention, and go from there, and hopefully end up on the final approval stage. But David, I'll turn it back to you.
Great. Thank you so much, Jose. So very briefly on our final slide, and then we have time for Q&A. The due diligence requirements for a commitment from New York City are fairly straightforward. I would just highlight maybe three on the diligence requirements column. And that is one, we use the ILPA due diligence questionnaire. And then secondly, we have what we call a Bureau of Asset Management supplemental DDQ, which addresses some areas that are specifically important to us, including diversity, where we ask about programs that the GP has and levels of sort of gender and ethnic diversity, which goes into the third requirement, which is a diversity profile. Our consultants, as well as our existing GPs, know this, that we ask for information on gender and ethnic diversity among the investment and senior management team. And one of the other things which our consultants and our trustees are aware of is when we do have managers present to the boards, it's incredibly important for them to address diversity as well as ESG. We had a robust discussion earlier on the main stage about diversity, and it's a discussion that's been consistent in my 4.5 years in New York City at our board level, where you will have managers who will present their levels of diversity as well as the programs that they're executing on and what their ambitions are. And what I've found interesting since I've now been here for almost 5 years is when those managers are back in front of our trustees, because the Bureau of Asset Management and its consultants are recommending a re-up commitment, our trustees will ask those managers about the progress that they've made. And so it's something that's always been important to our boards and something that, we're encouraged to see the dialogue sort of increase in the industry, this year, despite sort of the regrettable catalyst for it. So maybe with that, we'll stop our formal presentation, and I think we have about 10 minutes or so for Q&A before we head into the one-on-one meetings. And I'm looking at the chat box, and I'm not seeing anything. I'll ask my colleagues on the screen if they see any Q&A, or if we could get technical assistance if that's needed. Oh, okay. So one question, and this is directed, I think it looks like directed at the consultants as well as to Pat, is around what have you seen in the industry in 2020 in terms of LPs committing capital, like to private equity funds generally, but especially emerging managers? Has it slowed down because of the pandemic, or has it been consistent?
I can take a first shot.
Go ahead.
I would say we've been surprised at the kind of consistency of the fundraise cycle and investment pace. I think there's been certainly some institutions that paused, slowed down, et cetera. But generally, I would say our clients have been committing consistently. I think that if anything, thinking about emerging managers has become more and more a component of this as our asset class has grown. I think so too has the complexion of it and the choice of it. And so I think that that's probably on balance increased slightly, but our experience has been, again, with only a couple really examples in very specific places, the market from a commitment perspective has continued pretty consistently.
And David, I would agree with that. I would just add that generally it takes emerging managers a longer time to raise capital, and so this environment, because people have not been able to do diligence as quickly sometimes as they would like, maybe that slowed it down a little bit, but not very much. I mean, again, it always takes a little bit longer. The one thing I would add, though, is that there's an additional element that I'm seeing this year that is impacting emerging managers, especially those emerging diverse managers. The numbers of conversations that clients are engaging us in around especially diverse managers because of some of the events this summer has never been greater. And so my expectation and what I've seen already is that especially for diverse emerging managers, there's an even greater impetus to make investments.
Great, thanks, Pat.
And I would just echo some of those comments. I think to your point earlier, David, about one of the lessons learned from the crisis was having a consistent investment pace. So our clients have really been focused on continuing to deploy capital in this environment. But we have seen a bit of a bifurcation in the market where existing relationships are getting done fairly quickly, just given prior knowledge of the manager. And I think emerging managers and diverse managers, it is taking longer, more conversations. In many cases, they haven't met clients previously, so LPs are a little more cautious. And so it is extending the fundraising timeframe further. But in general, commitments are continuing to happen. So that's the good news.
Great. And then we have another question. This one is directed to Pat. It looks like it's an LP perspective. What do you miss out on as an LP if you don't have emerging manager exposure?
Well, I think you miss out on many things. First off, you miss out first and foremost as an LP and a fiduciary, you miss out on the opportunity for great risk-adjusted returns. So the reason why we invest in the space in both dedicated emerging manager portfolios as well as those that are just core portfolios is because we see the opportunity for outperformance for any number of reasons. We've seen it, and there's a lot of data, a lot of studies out there, and the earlier main panel talked about some of that. So you miss out on that, the opportunity for outperformance. But then the second thing you miss out on is this ability to kind of identify relationships early on that will be your core relationships later in life. The persistency of returns in private equity doesn't exist the way it used to. It used to be if you had a top quartile manager, now that would be the top quartile manager for funds to come, many funds to come. Because that is not the case anymore, there's a need to constantly identify kind of the newer managers, this farm team, if you will, because these will be your future core relationships. And if you're not doing that, you can quickly get to a point where you don't have those managers. It takes a while to get to know them, and by investing in them with smaller allocations, perhaps when they're an emerging manager or through a partner like us, you get to know them early on and know that some subset of those managers will be your core managers for the future.
Great, thank you. And then I think we have time for this one other question that just came in for the three consultants on the panel. Given your role with multiple clients, how does an emerging manager benefit from your broad client relationship? So I guess it's sort of around, if you have one, like say New York City invests in an emerging manager and they go through the process with Axia, StepStone, and Hamilton Lane, are there benefits to that for that GP? And maybe each of the three of you can take a shot at that, and maybe we go in the order of StepStone, Axia, and Hamilton Lane.
Yeah, so there's definitely benefits to that. I mean, the fact that we review an investment means we're reviewing it for all clients, right? And sometimes we do get an opportunity comes into New York City staff first, and that's how we learn about it. And and that will be reviewed, but not just for New York City, but for all of our client base. So it depends on portfolio construction. It doesn't fit for all clients, but that is the benefit, that you're not getting an audience for just one client, but our entire client base.
And I would say similarly at Axia, when you go through our process, we do speak with all of our clients on our pipeline calls, talk about what we're looking at for other clients, see if there's potentially a fit. And each client does have their own unique goals and objectives. So in many cases, it may be a fit for only one client or two clients, but it is something we're looking at, and we'll definitely, if we're doing the work, make sure other clients are aware of it, and give them the opportunity to meet with the manager as well and see if there's potential synergies.
Yeah, I would agree with all those points. Our process is to have one, again, as I mentioned earlier, around the technology, one central repository where all of our interactions, all of our discussions, all of our funds are sitting. And so something that comes in specifically from one client goes into that. It then is shared with all of the clients, whether in a pipeline call or a discussion that we're having in investment committee that then filters through all of our client service people. And the other piece that goes along with this is it is always good around communication to hear from general partners where there are clients of ours we know they're talking to. I think that helps add even more kind of insight for us into it. But we've been very focused on structure around making sure there's a single record of information for a general partner, so that as we're talking about that, everyone has it in front of them.
Great, thanks, Mike. And you know what? We're about to wrap up our panel, and I'll take the liberty as the moderator to just do a rapid fire, quick couple of questions to all four of you. And given the theme of our conference each year, as well as the events that our country went through over the summer and the spring, just want to ask each of you, if you had to estimate what % of the GP community recognizes the importance of diversity in their business models and the need to address systemic racism, like what would be your ballpark percentage estimate? And then secondly, going forward, who do you see as the driver for change, the GP side or the LP side? Since we had heard references that it's really the big institutional investors who can play a key role. So why don't we go in the order of Pat, Mike, Michelle, and Jose.
So the percentage of folks who care about it, I would put that at close to 100%. I think it's very impossible to have gone through the environment that we've gone through without it being, kind of top of mind. So they care. Execution always kind of follows that. And so we'll see how much matters, how much gets measured and the like. And to that point, kind of the drivers of it. Interestingly enough, I actually think this is the moment for GPs to step up. I think that LPs, especially folks like New York City and other really large public funds, public pension funds, have cared about this for a long time. But I think this combination of GPs now, not just saying they care about it, but putting real teeth around it, holding themselves to real metrics, I think that's going to matter really in the long term in terms of making real transformational change in the private equity industry. And I think that what goes along with that, I think that private equity and GPs are really doing this now because the LPs, even though they've cared about it, have stepped up basically the penalty for it. Not getting it right actually comes with greater penalties now. And actually getting it right comes with more rewards now. So I think this linking, of the carrot and the stick, with the LPs and the GPs realizing that now they have to do something, you can't just give lip service to it, I think is really creating a great moment for diversity.
Yeah, I would agree with all that. And I do think it's close to, it probably is 100% that are aware of it. We need to keep the percentage moving up and up in terms of the ones that are doing something about it and then are acting on it. I think the onus is on the GPs, although interestingly where I think the next phase for LPs could go is similar to, David, what you described in terms of New York City, having more and more LPs asking about these changes over time. So how has the firm changed that they're investing with from the last fund to this fund? I think that's a really important element of it's about how do we make sure that general partners are embedding it in their processes and pushing it down. That's the other piece. We talked earlier about general partners promoting from within and increasing the ranks, making sure that they're finding ways at every level, but importantly at the junior levels, to have a more diverse firm is really, really important to us.
Yeah, and I'd say it's nearly universal in terms of the recognition to change and to bring diversity to the private equity community, and particularly, amongst general partners. But clearly, what they've been doing in the past hasn't worked. So they really need to change hiring practice, recruiting practices. And so sometimes to force change, you need the LPs behind you and driving that. So I think to a large extent, it will come from continued LP focus on that, LP requirements. And then over time, when it becomes the norm, we'll see more GPs adopt that proactively. But I think initially it's going to take the LPs continuing to push.
Yeah, so I agree that the awareness it's universal, right? I mean, I can imagine an LP that doesn't at least say that this diversity is important. But I think that the difference is the ones that say it and the ones that are really doing something concrete about it. And frankly, one of the things that makes StepStone proud to work with New York City is that New York City has been a pioneer in the push for diversity. And David, you went through the timeline, and we've been working with New York City since 2011. So we were there when the initial program was put together. And even though before it, New York City was investing in diverse managers, just having that intentionality about it is really important. And seeing more LPs do that, I think, is really important. And I think another part where New York City has been a leader is this, you mentioned it, in terms of asking for the statistics and holding the people accountable if the statistics haven't changed in the right direction when they come back for a RIO. I think in the past that just didn't happen, right? I mean, I think the board may have, not any LP may have asked the question about diversity, but it was that was it. It was just asking the question. There was never any follow-up. There was never any tracking. And it was easy for the GPs not to do anything about it because they would answer the question and move on. I think now it becomes a strategic priority for the GPs to increase their diversity, or they're not going to be as successful in their next fundraise. And I think that's what it takes. It takes more of that. Really holding the GPs accountable to improving the metrics. So I do think the events this year have prompted other LPs to sort of follow the lead that New York City blazed many years ago. And that's, I think, going to be for the benefit of everybody.
Great. With those hopeful and inspiring closing comments from Jose, we're going to thank the panel for joining us. And we all look forward to the one-on-one sessions coming up. And I think the contact information for all four of our partners, as well as for myself and my team, are available on our websites. So don't hesitate to reach out to us. And everybody, we wish you a great weekend and holiday season.
Well, here we go. Good morning. First, I'd like to thank all of my panelists for participating in this, and hopefully all of you who are watching will get something out of it. But first, before we get started, there's a little business matter that I need to take care of. The Bureau of Asset Management is a public entity, a public agency. And with that, we have something called the open door policy, which basically means if you call me, I will call you back. We have basically 140 investment professionals on staff. I think only 3 of them, or 3 of us, have secretaries. So and if you call me, I'm either going to pick my phone up or you can leave a message if I'm not there. But the most important thing, also, if you request an appointment to come see me, you will eventually get in. Now, some people may have a problem if you call me, like say on a Thursday, and you want to come see me on Monday. Chances are I'm probably busy. But if you call me with enough notice and time, you can come in to see not just me, but anyone else on the investment staff. I'm saying all this to make it clear. We do not permit, do not allow, nor should you involve yourself with placement agents. I want that to be crystal clear. At no time should you be involved with a placement agent. You do not need to involve a third party to come see anyone in the Bureau of Asset Management. Now, hopefully we're all clear on this, because somehow, some way, 6 months from now, I'm going to get a call from a business agent or a placement agent representing someone in the minority brokerage community. You don't need to go through that. If you want to see me, call me. We'll work out a time for you to come in. I guess in this pandemic, it won't be an actual face-to-face meeting, but we can do something and set something up. Thank you. Now, having said all that, we're going to now hopefully start our breakout session. First thing I'm going to do is ask all of our panelists to introduce themselves and give us maybe 2-3 minutes on their backgrounds and the things they do. And then the second thing I'm going to do is run them through a series of questions, and then we're going to finish this thing up with hopefully an opportunity to do some question and answer. So let's just start off with the first person on my screen. Oops, I'm hitting the wrong thing here. Cancel that. Brian Rubin, can you just tell us about your firm and a little bit about yourself? We'll start with you.
Absolutely. First of all, thanks for including us, myself, and Mike Rogan from T. Rowe Price. We really appreciate the opportunity to be here and to speak to everyone. I have been at T. Rowe Price for 23 years. I started in the middle office and came to the trading desk in 2001. I started trading high yield in 2003. And I manage the trading team for high yield, levered loans, and emerging markets, Latin America. Which is about 60 billion of assets all in amongst all those 3 asset classes. T. Rowe Price is a $1.3 trillion asset manager. We are a global firm, and similar to you, what you explained, we have an open door policy. We're very committed to the diversity and inclusion. We do have a head of that within the firm. It is something that we focus on. As a firm, it comes from the top all the way down, and something that we believe in, and we are very, like I said, very excited to be a part of this, and look forward to this session.
I guess next, Mallory, could you do the same?
Absolutely. Thank you very much for having me as well, and having the opportunity to present here today. My name is Miley Robichaud. I oversee the fixed income trading for North America for State Street Global Advisors. I've been with State Street for 21 years, my entire career actually. I started on the bank side and moved over to Global Advisors in 2005, which at that time was when State Street Global Advisors was centralizing trading. Prior to that, we had been in the PM trader model. So I've been a part of the centralized desk literally from day one. In May of 2016 was when I took over the desk. We're set up in a regional format. So like I said, I oversee trading, fixed income trading for all of North America. Anything comes through my desk across the liquidity spectrum, from rates to high yield, EM, mortgages, structured products, the whole 9 yards, with the exception of our cash business that is part of a separate unit here at State Street Global Advisors. The team is made up of 7 people. Everyone's located in Boston except for one. One is located actually in Stamford, Connecticut. And our fixed income business is just under 500 billion globally. And we're set up geographically. Boston is the North America centralized location. We have a sister desk in London, and we're in the process right now of centralizing fixed income trading in the Asia Pacific region. So I look forward to the discussion today, and thank you again for including me.
Okay, thank you. Great. Mike Chambers, please.
Hi, my name is Michael Chambers. I'm from PineBridge Investments. I'm a senior vice president in the Leverage Finance Group. I've been with PineBridge for over 9 years now. Been in high yield for over 24 years. Started out with TCW and then Crescent Capital, and then came over to PineBridge. I'm honored to be here today and very optimistic, and think what we've started at PineBridge doing with some of the MWB brokers as of recently, and feel like going forward there's a lot more to do. Thank you.
Thank you. Mike Grogan, can you please?
Yes, sir. Good morning, everyone. I work with Brian Rubin. I've been at the firm since 2000, been in trading since 2003, started in the rates and FX area, moved over to credit in 2005. Been trading investment grade credit since then. I have management responsibility for the IG investment team, our securitized team, which includes our ABS, CMBS, CLO product, also our MBS, our mortgage product, our rates traders, and also our municipal traders report to me as well.
Thank you, Mike. Paul, sir, please, could you go ahead?
Sure thing. Hi, I'm Paul Whitehead. I'm the global head of equity trading and the global head of transition management at BlackRock. It's great to be back, although, at least virtually, and look forward to kind of seeing everybody throughout the session. I'm 24 years with BlackRock by way of BGI, and have been involved with our emerging broker efforts all the way back to the early 2000s when we started the program in BGI. And so, I'm used to seeing a lot of familiar faces when we're in this audience, and hopefully, I'll get to see you all again soon. Thanks for having me.
Yes, thank you. We're going to basically open this up to a series of questions. The main thing we're going to try to get at today is how the business has changed and how firms can best prepare for themselves for the changes and how things are going to evolve over time. When I think back to where we were when this thing started 12 years ago, and I remember and I can look at the asset allocation that we had back then. 12 years ago, Bureau of Asset Management, we weren't invested in things like alternative credit. We weren't invested in things like hedge funds. We weren't invested in things like private equity. The bulk of our assets were in things like public equities, fixed income. That was the lion's share and still is of what we do. But as this business has changed, that part of the pie is continuing to get smaller and smaller and smaller. So as an emerging firm, if that's where you're going to be, you're going to have to adjust and you're going to have to change. I can remember going back then again 12 years ago, and we had a long list of active managers that were managing the lion's share of our public equities and our fixed income assets. But over time, not just us, all the major public plans have shifted from active to passive management. We've gone from active managers to index. And one of the things about indexes, they trade less and they also pay less. So again, if you are a minority, a women-owned or disabled veteran firm in this space, you're constantly going after a smaller and smaller portion of the pie. Also keep in mind, when we first started this, our first approved minority women's list, we had 25 firms. A couple of years later, we even grew the list to 47. But over these last few years, I'm sure we could all sit here and list a number of minority and women-owned firms that either have gone out of business, merged with someone else, or even just changed their business models. So now, as we speak here today, our list is down to 14 firms. The business is changing, and if you don't change with it, you will not survive. Let's start off, I guess, with the first question, and I'll run through each of our panelists with it. Please explain you and your firm's view on how the industry has changed and how any firm can best equip themselves to prepare for the future. Brian, I'll start with you.
Yeah, I mean, the business has changed a lot. Gone are the days where obviously firms, especially in high yield, are making massive markets, 25 up, 10 up, and liquidity is key. So from my standpoint, as a trader that has always liked to work orders and always picked brokers that I trust, it's changed a little, but not as much as I think others would say. I think what we focus on is counterparties that we can trust, counterparties that can execute, and counterparties that can line up the other side. And that is what we're looking for. And for a high yield trader like myself, we're not expecting to get liquidity on the wire because those days are gone. So I think the big focus here is just finding trustworthy brokers and that we can work with, that we can grow with, and that we can, try to learn throughout the business together. Mike, I think that's kind of how I look at it. Grogan, from a T. Rowe standpoint, does that sound about right to you?
Yeah, Brian, definitely. I would think, obviously, this past 8 to 9 months has kind of sped up some of this, evolution that's been going on in the fixed income trading markets that we've experienced the past couple of years. There's definitely a renewed focus on technology and how do we interact with the markets. And it's different markets obviously are more electronic than others, and how they interact. IG is more so than high yields, and as we go towards the more liquid products, there's more electronic interaction there. But that doesn't mean that the relationships like Brian talked about are not important. So I guess my advice as we look through into the future is you want to think of ways to invest in technology. How do you increase your touch points with us and the market in general? But also you need to invest in the right people, right? Because it still is a relationship business that's out there.
So true. Mallory, same for State Street? Same question?
Yeah, I would echo many of those same sentiments. In fixed income space, some of the ideas here that have already been kind of touched upon, but the business has become so much more fragmented, and the relationships and the breadth of counterparties, especially for a desk like the one that I oversee, that we have our hands in a little bit of everything. The importance of having these relationships, but then also having access to counterparties that are able to provide us liquidity for all of the different types of instruments that we are transacting. And so just to kind of put that into perspective, we do about 80% of our business with 10 counterparties. We do the last 20%, that tail is done with, in any given quarter, 60 to 70 different counterparties. And so that is where, especially in some of the less liquid products, we do depend on those relationships and the relationships that we have with counterparties to be able to efficiently price, the whole spectrum of securities that we are trading here. I would add, I think, again, to echo, I think technology is so important. Just with the number of transactions that we are doing, being our business is skewed more to the index side. A lot of that business is obviously quite scaled, and so the efficiency of technology, of being able to go out and execute trades in a timely and efficient manner. So really staying close and connected to the clients that my word of advice would be investing in the right technology, staying close to what your clients' needs are, and understanding that it may not be a one size fits all. And even within that, there may be different degrees and layers of connectivity that you need based upon, which segment of the fixed income market you're transacting with that client on.
Okay, thank you. Mike Chambers, please.
Okay, I would definitely echo a lot of what was already said, for sure. My perspective from a high yield trader since the late 90s, I've definitely seen a lot of change in this industry. Those days of using fax machines and big tube TV style Bloombergs have gone away. And so just in that alone, I mean, it's bottom line for us, I feel, is technology is only making things that much more efficient. And definitely need the relationships, but the one thing that has hit home for us has been technology. Working from home has been a prime example. I mean, we feel like we have missed a beat. In high yield, there's still a lot of over-the-counter trading over the phone, obviously, and that's where the relationships come in. But work from home has allowed a lot of that to shift to IB, to some of the electronic platforms. I think over the last couple of years or so, I've been talking with more brokers that I've never talked with in the past just because of the advent of IB. So I definitely think technology is what's going to drive that to start these relationships and to build upon them, and then to get that communication with guys you can trust and guys that are going to work orders, guys that are going to get things done for you. So I definitely want to echo technology.
All right, thank you. Paul, BlackRock's perspective?
Yes, I mean, so much has changed in the last 10 years, and kind of being the lone equity guy on the panel today. Obviously technology is a theme, and so I couldn't echo that enough. And I'd like to think of what's happened this year, particularly with the pandemic, as it's an accelerant of pushing forward those firms that are not technology enabled to really figure out where they fit into the execution landscape. We've definitely seen in the brokerage business, consolidation. We've seen it in both terms of sort of volume with large banks. We're doing more with probably our top 10 than we've done in the past. We're also seeing consolidation, as Mark alluded to earlier, in the minority broker space, which ultimately we think is a good thing because it's bringing together niche counterparties that have specific skill sets, combining them, which then gives them a more holistic offering. In terms of equities specifically, equities is a scale game at this point. We're largely an agency market, which means that there are opportunities if you continue to develop your platform and focus on your infrastructure, clearing, things that aren't really that sexy, but are actually a really important part of the overall execution process.
Paul, thank you. Our next question is going to be, how does a small emerging firm best prepare themselves for the future? One of the things I've noticed over the years, because I have small firms come in all the time, they want to know how to get on our list. And I run them through a series of questions. And I ask them, so what's your area of expertise? What do you trade? And they'll tell me, from mortgages to high yield, from investment grade to governments, they'll tell me I trade non-US equities, US equities, small cap, large cap. And I'm going, you're a 3-person firm and you do all that? And they'll go, oh, of course, yes. But the firms I've seen on our list, the smaller ones that have thrived, they've picked one thing, one area, one space, and those 3 guys or girls, or excuse me, women, live in that space, and that's what they do. And they grow that space through being the best that they could possibly be in that one space. And we have a few brokers on our list who have done very well with that. So if there's some advice you can give to some of these smaller firms out there to best prepare themselves for this environment that we're currently in now and how to grow it over the next few years, what would that be? I'm going to start, Mike Chambers, with you.
Okay. Once again, it boils back to what we talked about in the last segment, technology again, I think. We want to continue to build these relationships that we start, but the first entry for us sometimes is the technology of just, getting in contact with us on IB, because phone is definitely a conversation to be had, but it's so much easier with IB. But I would tell you, we've been very successful with Castle Oak. We got introduced to Castle Oak by one of our astute business development persons, Brian Connery. And I took a meeting with them. They talked about their platform, which they set up with Bloomberg. And since we use Bloomberg Palms as our trading system, it's pretty seamless. And so the fact that it was seamless and it was something we've never tried, we checked it out. And, at first we did a few small trades just to see what the outcome would be. And sure enough, we got a number of bids and a number of offers on what we were trying to do. And it was in a very competitive process, and it was very efficient in essence that I wasn't calling 50 brokers. I basically put, to start maybe 2 to 3 names on a list and said, I need bids for these. And they came back with bids, and there were multiple bids on there. And that in itself was just, without making phone calls, without making IBs to multiple dealers, was very helpful to us. And so once I saw that, we started giving it more effort and started working with them, building the dialogue daily. I mean, my sales coverage, Michael Henyon, comes into me and says, these lists are out there, and there's stuff that lines up with us, and we're definitely doing a lot more things with them. And just within the time frame, we started with Castle Oak in mid-July, I believe it was. We've done well over 11% of the volume for the New York Pension Fund. And we've even been successful with our other accounts on an overall basis. And we're up to about 3% of our volume, which if you look at our overall volume, we're trading with about 45 plus counterparties roughly on an active basis. And that number sits, call it in the 10 to 15 area. So they definitely have been helpful for us.
Good to know. Mike Grogan, for you, if Monday you were starting your own, you and your 2 best friends, y'all starting your own firm, what are the first few things you guys would go about and try to do?
So if Brian and I were going to start our own firm, which we're not, by the way.
Okay.
Yeah, you know what? It's the combination. It's the balance, right? It is the technology, which we talked about before, but it's also finding something, Mark, like you talked about, that you can do well. Like, how can you add value as a broker to our clients, right, across our spectrum? If you just want to look at investment grade credit, which I could talk more specifically about, there it's find a niche, be an expert in a sector. If you want to look at, REITs or look at, the healthcare pharmaceutical space, just, it's hard to be everything to everybody. The large dealers themselves, the JP Morgans of the world, like, they're even finding it difficult to be everything to everybody these days. So, and obviously they have very large balance sheets, which, like Brian echoed before, we're not very large users of capital. So I would say, find that niche that you can be successful at. Build those relationships across the buy side, right? We want you to have good relationships with everybody out there, because that's how we can access liquidity, individually. So we'll be selfish about ourselves, but we know that you need to be open and involved with other money managers as well. That's how we make markets. That's liquidity. Brian, you want to throw in some thoughts there?
Yes, sister his business partner, please.
Yes.
I think you summed that up perfectly. And the 2 things I would say is creating a niche is the most important thing, because you can't be everything to everybody. And 2, there's a lot of low-hanging fruit that you could just get off the bat, like new issue flipping. The street has ignored that to a degree. If you know that traditionally we're going to be add-on buyers, why not find out ahead of time? Are you going to be involved in this new issue? What are you going to add? Is there a level? That is good information that we will give up, and it's good information for our counterparties to have because one, they may be able to trade at that moment, and then two, it's information for the future. So if they see that name, they know to show to us. So it's just building upon those things that are really low-hanging fruit, and you're not seeing the banks focus on that. I mean, we don't get a lot of calls when new issues break anymore. The larger shops have become lazy. It's transitioning to maybe a platform or something like that. But it's really low-hanging fruit that you can connect on day one, and then you have information for going forward. So those are my two things to echo on top of what Micah said.
All right, thank you. Mallory, the same.
Hey,
If you
Mark,
start your firm on Monday morning.
I see, Mark, can I add one other thing
so
there? We
please
talk
go
about platforms, which I don't know if we're going to talk about later, but if you look at the market accesses, the trade webs, like Mike said before, the Bloombergs of the world, those are important avenues. And we use those as much as other, as generally as out there in the markets. When we engage on those platforms, we are giving up information, right? So there's a snapshot of pretty much our business as a whole that we're putting out there on these platforms. I would really push, and I think that some of our counterparties out there have heard this before, is use that information. Like Brian said, like we, in every trade that we put out into the market, we're showing you our hand in some capacity, right? What we're involved in, what we're trading, what our themes are. There's information there. Dealers should use that to figure out ways to come back and engage us. I love nothing more than getting a phone call a week or two later saying, hey, Mike, you were a seller or a buyer of something a couple weeks ago. I might have an opportunity for liquidity. Like that is real value add to the platform.
Thank you. And we're going to get to the platforms later on. Yes. Mallory, again, could you go through, if you were starting on Monday, your own firm?
Sure. I think, you from the start kind of nailed it in the sense of, really owning what you're good at and what you're not good at. And that's fine. As I had articulated, the number of counterparties that we have on our platform, the 60 to 70 that do 20% of our business are so impactful and meaningful to the different segments of the fixed income market that we have to transact in. But, of course, we don't want to waste anyone's time. And, we don't want to waste anyone's time. And so that's the thing. So if you're good at something, we need to know that you're good at something, and that's what we're going to focus on. And to have kind of a roadmap too, to work together, to establish that relationship, and then to say, hey, we are going to maybe get into this part of the business, and then you would be there and have that opportunity then to work with us. If you are getting into another segment of the market. I think the other biggest thing is just listening. There's, each client isn't the same. Even different traders aren't the same, and how they like to manage their, blotters and transactions that they have to do. But to really kind of understand what is helpful, what types of things, how can you add value? And I think really listening and hearing what your clients have to say and how they want to be covered, I think really goes a long way. And I think it's a way that then you can strengthen that relationship to then have the opportunity to see more and more business. And lastly, again, I think it'll continue to be a theme, but the technology is so important, again, from the perspective of the number of trades that we're having to do on the desk, and having that straight through processing is essential. And so, that's just going to maximize, again, the amount of business that you're going to be able to participate in.
All right, thank you. Mike, you used the term value add, and that leads into my next question. You guys do a very good job of hitting goals for us, and we appreciate that. But one of the things that everyone has to keep in mind, the minority women-owned firms in the audience, for say investment grade, we have a goal that they do 15% of their trades with firms that are on our list. And I'm just using these numbers as an example. Out of the $500 million we may have in an account, they may just do 15% of the goals with that segmented one account. But if they view you as a true trading partner, someone they truly value who's bringing something to the table, they will look to trade beyond our account with the $5 billion in that entire strategy. So what we want to get at today is terms of what do you guys look for in a trading partner? Mike, you brought up value add. What do you view as value add? What do you look when you're talking to somebody? Go, yeah, they're not just going to be in the small box of my MWE firms. They're going to be a true trading partner for T. Rowe Price. Mike, starting with you. You're on mute.
I don't know how that happened. Sorry about that. Yeah, it is what we spoke about before. The value add for us is, we are a fiduciary, right? We have a lot of other clients. Obviously, New York City is very important to us, but as a fiduciary, we understand. But that's how we approach the business, and I think hopefully everybody our counterparties understand that or know that for us it is about the entire book of business that we have. And as mentioned before, and that can mean different things to different desks, but it's understanding how we engage in the market and the access to liquidity for our clients. That means different things to different desks, and it is all about the relationship. And for us, it's also individual portfolio managers. We didn't talk about that. We're managing those internal relationships and with analysts. So if there's ways we can engage the whole platform, that's truly the value add to us. Brian, you want to add anything there?
No, I think you summed that up great. I mean, I never take a trade and say, this is just for New York, I'm only going to go to an MWBE. I think about the entire book of business, and I think it is important for every account to trade with an MWBE because trading leads to more trades, and that's the most important thing to us. You buy this, maybe they'll show us something that looks similar. So that's the value add, is connecting the dots.
Thank you. Paul, what does BlackRock look for in a trading partner?
Well, BlackRock, obviously, we're a giant firm, right? So we trade pretty much everything. And this really gets back to something that Miley was touching on earlier about listening. And it's about having the right people in your organization that can engage clients and listen to what their needs are and truly understand where can I then align what our strengths are with what the client's needs are. And I can't emphasize enough, we don't expect small firms to be everything to, the entire platform. We actually don't expect that really of any firm, because we know that, it's the trader's job to know who's strong at what different type of execution strategy, what product, what asset, and is it rebalance? Is it, market on close? Is it a very big scale event? Is it concentrated where you're, really patient and you're just kind of looking around? So there's, different strengths, and you have to align your firm's strengths with the needs of the client. And if you're finding that you're having trouble aligning those, then you kind of have to look inwardly and say, okay, what do we need to get better at? And what do we need to do that? Whether it's talent acquisition, whether it's picking the right technology partners. And I think understanding your technology partners is very important. And we'll talk a little bit more about platforms, and I'll go into more detail then. But it's really about listening and alignment, and then growing from there.
Thank you. Mallory, can you do the same? What do you look for in a trading partner at State Street?
Absolutely. I obviously touched upon some of it a little bit, obviously from the standpoint there. But I mean, I think that the biggest thing is making sure, one, that we are in alignment in the sense that, what you're able to offer is where we have different focus. But I think amongst the different sectors of fixed income, there are different needs. And so, listening to a particular trader or understanding what type of mandate it is. This is an index account, so more than likely, we're going to need to be selling or buying certain securities, at the end of the month. People have the best luck with us who kind of get in front of us to say, hey, here's, an opportunity that we have. I think that you're going to be a seller of this. Or not. And I think really understanding what our goals are, and then coming to us to be able to show different ideas or opportunities that you have on your side that potentially align with what we have going on our side, given the different mandates that we have.
All right, thank you. Mike Chambers, same question for you, please.
Okay. Yes. So as a firm, we're pretty open to dialogue with just about anybody. I mean, you send us an IB, we'll take a look at what you have to offer. I mean, our whole thing from a firm perspective is how do we help our clients achieve best execution? So for us, a trading partner is going to help us provide best execution, but they're also going to show us new ideas. They're going to inform us about any particular buy or sell axes that are related to our current holdings. I'm more than happy to send out our QSIPs, so that dealers know exactly what to contact us on. But once again, we're still open to new ideas. But I think preference where that, as Mike and Brian mentioned, value add, it's something knowing what we're investing in for our firm. So it's not just calling on every single axe or IBing on every single axe. Granted, like I said, we are going to look at them, but to be more helpful, it's going to be something we currently own. New issues, as Brian mentioned as well, that's something that is helpful for us. So it's just being able to, number one, get that dialogue with us and try to figure out what we're trying to do and to help our clients achieve best execution and to be able to be successful working together.
All right, thank you. Next thing we're going to go on to is, does your firm have a formal process to apply as an emerging firm? Is there a formal program? Are there minimums that a firm needs to meet? I mean, what are the things that you're looking for? I mean, I've met with firms starting up all the time, and I try to be encouraging, but even I can remember one time a guy coming in, and essentially he was a stay-at-home dad with 3 kids, and he wanted to trade for us. Not quite what we're looking for. Another guy came in their firm, and their trader was a part-time employee. Again, not going to work for us. Starting with Paul, we have a long history with you guys, and I know you have a formal process, a formal application, and have a great staff, Peter, who will walk people through that process and trying to get them onboarded with you guys. Can you tell us a little bit about that?
Yeah, I think that, one of the benefits of just being at a very large firm is we do have the resource to devote to having a formal program, having structure, and also, really applying what we apply to all our counterparties to the emerging broker space. In terms of, is there a cutoff? Is there a minimum? The answer is no, but you still need to make it through our counterparty credit approval process. And if you're, we don't expect you to be capitalized like JP Morgan, but there needs to be a reasonable amount of capital so that, in the event of any sort of operating issue, you'll be able to make it through to the other side. We also, look at different asset classes because some asset classes are less capitally intense than others. And so that can make a difference as well. But the way that we would view different counterparties, there's really only one bar that people have to meet. But that bar is best execution. In terms of our program, I think what's important about it is 2 things. it maintains focus, and it allows us to kind of measure success. And in my mind, sort of the measurement of success is as our assets are growing and our activity is growing, is our engagement with our emerging brokers growing as well. And so that's something that we sit down with a formal group across all trading teams are represented, and we meet quarterly. There's a very formal process that Peter Lee on our side, Marcus, you mentioned, he helps us monitor and manage. And, this is something that we even go down to putting it in people's annual objectives and it's one of every trader's annual objectives is to engage in our emerging broker program. And so we can then evaluate them at the end of the year based on the asset class that they're trading.
Paul, thank you. I had to take a moment to commend Paul and Peter for the program they've put in place. We have a long history with these guys, and we both, on both sides, come a long way. Paul, thank you.
Great. Thank you.
Does State Street have a formal application process for emerging firms?
Yes, we absolutely do. It's rolled up in our entire counterparty approval process. So the steps that we follow is, first, you would either come to me or come to the specific traders on my desk to represent where you think you can add value, where your strengths are. And if the trading desk thinks that it is a good fit, again, kind of going back to, I don't want to sign someone up if we don't feel like we actually can form a partnership or, have value for both sides, both parts of the relationship. So once that is established, then we have a separate function within our risk management team, the counterparty risk group, that will then go through and review the counterparty to see if they are fit for approval. And as far as minimums, no, we don't necessarily have minimums. You do need to be profitable. And then you need to have a good risk management system, good rigor around your compliance and risk controls to be able to, convey that to us. And then once you're approved, it is something, on an annual basis, there is a full-fledged due diligence process that occurs. And subsequent to that, I am reviewing, because there is so much work that is done in onboarding and then the ongoing due diligence of the counterparty. We want to make sure that we are actually executing trades. And so, reviewing on an annual basis to see what kind of business we're doing. And again, it's not, trying to compare a diversity counterparty to a JP Morgan, because again, I think that it's not necessarily about the notional amounts that you're transacting, but the value that you're capturing for us. And so that would be the process. It is first really just establishing if it's a good fit to go down that path to be onboarded.
Thank you. T. Rowe Price, is there a formal application process?
It's similar to what State Street explained and what goes on, BlackRock as well, where the traders will submit it and it goes through a formal process and needs to be approved. We make sure that there are no violations with FINRA and the SEC. Sorry, I'm checking my notes. That's why I'm looking down. And once we check that there are no violations, it goes through the approval process from a risk, from a legal, and from a counterparty risk. Transact so that we can transact. But it sounds very similar to what is explained by BlackRock and State Street.
Thank you. And Mike Chambers, PineBridge.
Okay. Also echo that we're pretty similar as well, but our process starts with the trader. So building that dialogue with us is where we're going to go with that. And so when we submit approval for our broker, we fill out a form. It goes to what is called our regional counterparty approval committee for review. If the broker is investment grade or uses an investment grade clearing firm such as Pershing, the process is pretty simple. But if it's not, then one of the credit committee members will have to review the firm, see where their financials are, and check legal, any kind of regulatory issues. And once that process is done, it goes to legal for review. There's a final check with compliance. After compliance blesses it, it goes over to IT and operations, and they set the broker up, and it gets in our system. I mean, once again, if a broker is investment grade or clears through investment grade, it's pretty seamless.
Thank you. We here at the City of New York, we do have a formal application process. Last time we did it, last year, we involved 2 consultant firms. But one of the key functions of our process, one of the important functions in our process, is our partners here on the panel. I had conversations with Paul and Brian as well. Who out there, what minority firms out there did you like? Who are you involved with and who are you using that we may not be aware of? So one of the best ways, one of the easiest ways to get on the New York City list is to do the business. Do the business, be on someone's list. When I call Brian 2 years from now and ask him, who do you like? Hopefully he'll mention your firm's name. When I call Paul, hopefully the same. That's one of the key things. Do the business. We're a large plan. We're not going to be someone's first client. That's just not going to be the case. Moving on to the next question. What are the 3 forms of technologies or platforms that you absolutely have to have if I'm going to trade with State Street? What must I have? What must I be on?
You need to have the ability really to be able to price, to price our inquiries. Well, again, I guess I should say you don't necessarily, we don't, it's not a credential that you have to be on these platforms, but I would say you will see more of our business and you will have a better opportunity of printing more of our business if you are on, Bloomberg, Market Access, TradeWeb, again, that whole spectrum of those RFQ platforms where we do, that's where most of the RFQ business that we're doing is on those platforms. We do very little voice, obviously with the exception of some of the higher touch and EM, high yield, and to some degree in investment grade. And so, I often get asked the question, how can we see more? How can we? And, it's not because you're not getting the phone call from us. It's because a lot of our stuff is done electronically. And so, in order to capture a larger market share of ours and to be able to see a lot of the business that we're doing, that would put you in the best position, to see all of that business.
Thank you. Paul, for BlackRock, what are the platforms, systems, programs I must be involved with to do business with you guys?
So there's 3 important categories, and they really apply across all asset classes. And I'll kind of use equities because that's where I live. There's OMS, Order Management System, EMS, Execution Management System, and TCA, Transaction Cost Analysis. You need an OMS, and often people's OMS and EMS are one and the same. There are platforms out there that that you have enough functionality in a single space. But the way we think of it is OMS is pipes and sewers, it's lines to clients and custodians. EMS is ability to interact directly with the market electronically. With particularly with equity markets, that's incredibly important. There are emerging EMS platforms in fixed income, such as Market Access, TradeWeb, and those are platforms that are heavily used by our traders and would behoove you to engage. And we've actually helped counterparties in our program engage with those platforms because I know that they can, in some cases, be cost prohibitive. And then TCA, Transaction Cost Analysis. I'd like you to be able to tell me your view of the execution that I asked you to do. If I asked you to get the close, can you show me across the 1,000 lines that I sent across, did you get the close? If we asked you to work an order over the day, can you show me how you compare versus, the arrival price or the volume weighted average price, the VWAP? These are not super complicated systems, but I think it's important for you to be able to tell your clients, engage with them electronically so that your ease of access is important, but then also be able to explain how you feel you did and have the data to back it up.
Thank you. Mike Chambers for PineBridge. What must I be on?
Well, the number one thing, someone has to have a Bloomberg. Now, all joking aside, there's no requirement for PineBridge. We are on MarketAxess. We are on Bloomberg Palms, which uses the Bolt system. But for us, we're open to meeting with new dealers and seeing how we can take that further.
Thank you. Brian, for T. Rowe?
Mark, I'll take this one for us.
Please.
Mike stole my thunder about the Bloomberg comment because I think that was kind of obvious, but I think it needed to be said. That's obviously really important.
Oh, it definitely needs to be said.
As mentioned before, the different platforms, whether it's Tradeweb or MarketAxess or the different platforms built within Bloomberg are really important. It's also about, with the Bloomberg, it's about making those, your access, which you can make, open to others. When we ask the dealers what they're working on, that's great to have that conversation. But as an individual trader, we know that when you get an order on your blotter, the first thing you're going to do is you're scraping the market somehow, right? So if there's axes that that dealers have that we can't see them, trades might be missed. So if there's ways to get those axes to us, and whether, like Paul mentioned, whether that's coming into our OMS or to our EMS, it's really important we look at that technology of how we deliver that way. It could just be delivering a spreadsheet every day with those axes on there and we can consume it, or it could be fixed connecting, those kind of things. So that's really important as we look through the technology. But I think those are the obvious ones. There's other ones that are developing out there, but obviously the big ones are the Tradeweb and MarketAxess of the world for us.
Thank you. Next, we're going to go on something I call bad assets. And what I mean by that, out of all the different asset classes that we have a gold in, mortgages, it just seems the most challenging for our managers to attain those goals. But at the same time, to me, challenges creates opportunities. To me, if there was a firm out there, an emerging firm that knocked on my door and said, I can trade mortgages, I can trade them, and I trade them well, they would immediately have an opportunity. So I just want to go through you one at a time. What seems to be the biggest opportunity or the most challenging area that you have that an emerging manager could fill that gap? Starting with you, Mike Chambers. I guess you're high yield, but go ahead. Is there some specific area that you seem challenging for you in this space?
I don't think there's, for me personally, challenging, but I think, when I look at for MWBE brokers, that could be challenging is on the loan side. I don't personally trade the loan book. That's traded by two separate loan traders we have at PineBridge. But I know with the way the loan market works, that seems to be a tougher market to get into. So that's something maybe there, if they could get involved there, that would be an area, because I don't see any challenges for us on the high yield side.
All right, thank you. Paul, for BlackRock, what areas you see the most challenging and then the most opportunities? You're on mute. Paul, I think you're on mute.
Apologies. On the challenging front, it is definitely derivatives, listed derivatives, and mortgages. I think those are the topics that continuously come up. In terms of opportunity set, though, solving the mortgage puzzle would probably be the biggest opportunity, in that when I look at the size of the total volume of what we trade on an annual basis, and where emerging brokers are underrepresented, it's definitely mortgages. I would not send any of them down the listed derivatives direction, just because I think it's very low margin business, and it's you have to have massive scale for it to even make sense.
I agree. Mallory, from State Street standpoint, same thing. Challenging areas and opportunities.
Sure, it's similar here. It's those higher touch type sectors of the fixed income market. So you already mentioned mortgages and high yield. We have that as well, and even investment grade to a certain degree. Again, from an efficiency standpoint, if we're not having cash flows throughout the month, or anything really going on with clients, we're obviously rebalancing at the end of the month. And so a lot of times, a counterparty's axis may not be aligned with, when we're actually in the market transacting. So I think it goes back to that notion of knowing your client, understanding your client, and then focusing on those particular areas to be able to better line up. And in mortgage space, we do tend to see that a lot, and I think that is probably the biggest and most pronounced opportunity. And not to mention, I mean, it's something that a specified pool, for example, if a counterparty has a pool that the characteristics is something that we're looking for across a vast array of funds, it could be the opportunity to do much more sizable trades as well, just given the size of that market.
Thank you. Mike G. Rogan, Brian, same question, please.
I was going to say anything with the legal agreement is going to be tough. So, I think one area where it can be grown is emerging markets, especially with the crossover in corporate credit, where you've got stuff that gets lost by the big banks that could be traded either high yield or IG. And there's a chance to come in and pick up and to trade it with us. We have a dedicated emerging market desk. We speak to each other. We work with each other. So it's a very easy connection for us to Mike or myself to make from that standpoint, because I do think anything with a legal agreement is going to be very difficult.
Thank you. In the past, I know a number of firms have had open houses where they've invited different firms in to show them that their trading desk, sort of introduce folk and make them connect folk. Does anybody have anything like that on the I guess in this world we're living in now, probably not. But hopefully you guys can go back to doing things like that in the future. Hopefully we can all say yes, get a commitment from that, for that.
Yes.
Some open houses. Yes. Thank you.
Yeah.
Yes. I think we're running out of time here, if I'm looking at the clock correctly. So I'd like to take this opportunity to say thank you to everybody. And for some folk out there in the audience, I know you had some one-on-one sessions. So I think it's about that time to switch over and do those things. Again, guys, thank you. Really appreciate this.
Thank you all.
Thank you.
Thanks, Mark.
Thank you.
All right, bye.
Having a lot of technical issues this morning.
Oh, no. Okay, thank you. Good morning, everyone, and welcome. You are now joining our session for investing in real estate in a post-pandemic world. I am Janet Londoño Valle, one of the team members in the real estate group at the Comptroller's Office in the Bureau of Asset Management. Before we get started, I would like to introduce our speakers who are here to share with you their insights on what they're seeing in the market, as well as how they're investing in the emerging managers. Yvonne Nelson is the head of real estate in the Bureau of Asset Management in the New York City Comptroller's Office. She's responsible for a $15 billion real estate portfolio on behalf of the 5 New York City pension plans and has been with the Comptroller's Office since 2005. Dave Subaj is a partner at StepStone. Dave leads StepStone's real estate research and fund investment activities, He is also involved in various investment and portfolio management activities and has been with StepStone since 2014. Ishika Bansal is an associate partner at the Townsend Group. She joined Townsend in 2011 and is currently responsible for various client-related activities, including planning, strategic planning, portfolio construction, due diligence, and recommendations of potential opportunities. Tom Bernhard is a senior vice president in the investment research at Axia Torrey Cove. Tom joined Axia Torrey Cove in 2011 and is responsible for sourcing, due diligence, and evaluation of investments. Finally, Peter Brafman is a managing director and is head of real estate at GCM Grosvenor. He leads the real estate investment practice and is responsible for real estate sourcing and underwriting of emerging managers. More detailed bios are available, if you wish, on the conference website. I would like to now get started. If you can, John, if you can turn to the next page. Can you go forward one, please? One more. Yeah, here we go. So this slide here provides a snapshot of the pension fund's AUM as of June 30th. Across the 5 pension plans, there is a combined $213.6 billion of assets under management. As of June 30th, real estate is approximately 4.7% or 4.2%. Of this total, or roughly $10 billion. Each pension fund has an allocation to real estate, and on a combined basis, represents about 7.2% or about $15 billion for private real estate. I would like to now hand it over to Yvonne, who will cover the next 2 slides. John, if you can. Okay. Sorry. I'm sorry to interrupt. People are saying that they cannot hear you. Is your microphone on mute? Can you tell?
The microphone is on, Maybe I'll turn it up. Is that any better? Maybe it was the volume.
I don't know.
And
I hear
then,
you.
yeah, we hear you, but I wonder the audience is not hearing you apparently. I'm not. Okay. Okay, continue. I'm so sorry.
Okay, no. Certainly. So we have 7 members on our team, on our investment team. I was talking about there's multiple ways to start communicating with us. You can contact us directly. We're a public agency. We have an open door policy. I mentioned the fact that perhaps maybe we might cross paths at a conference, either with a team member or with a consultant. And I was just about to mention the consultants that are in the bottom of the slide in the green squares that represent the 5 retirement plans. Each of them make decisions as to who will represent them in the real estate space. And so, and you'll be hearing from a representative from each of those firms today. And those consultancy firms are Stepstone, Townsend, and Axia. So together we work together to execute our emerging manager program. And so on the next slide, so, everybody defines emerging managers in a different way. Perhaps there'll be a standardized definition, but for New York City, the way that we look at the space is we are hoping to generate new business through first, second, or third institutional funds. And those funds could be up to $500 million in size. And regarding the firm, we're looking for a small cap firm that has no more than $2 billion in assets under management. And based on the activity to date, Jen is going to share with us the progress of the program thus far on the following slide.
Thank you, Yvonne. Am I on? Yes. Thank you, Yvonne. So here on this slide, on the left-hand side, you see it's another view of the real estate portfolio. And as you can see, the portfolio is slightly overweight to core, which includes core plus as well. The non-core represents value add, and opportunity. What is of significance here is that the exposure to MWBE and EM has increased to 6.4% as represented here, or roughly $1 billion. A year ago, it was at 4%. And I would have to say that one of the major accomplishments last year was the selection of a partner for real estate, for a real estate early stage and first time fund initiative. Early this year, we formally launched this program, and we are well on our way. We are really excited about partnership because it is a way to deploy transformative capital with managers in different parts of their growth life cycle. And we are to a great start. And I didn't say, but our early stage partner here is GCM Grosvenor, and Peter is going to talk more at length later on in the program. Here on the right-hand side, it's another depiction of the exposure that we have to MWBs and EMs, and the EM. Sorry, can you go forward, please? I would like to. So over the before we go into the next segment, I thought that it would be great if we can talk a little bit with the group and just hear your insights on what you have been seeing in the market as as what are your views on the emerging manager space? So maybe we can start with Yvonne. Can you share with the audience, Yvonne, any strategies, property sectors that you feel currently that we are not targeting for the New York City retirement system?
Oh, certainly. This is a very difficult period of time to navigate through, and we've seen the adverse impacts. They are kind of disproportionate across the traditional property types, and the pandemic, interestingly, has created some tailwinds for some emerging strategies. But, I would say that our focus, pretty much like the way we addressed the global financial crisis, is to identify partners that we know how to deal with distress in the market and that have teams that can pivot quickly to strategies where compelling opportunities are revealing themselves. Basically, it's distress strategies right now, and you have to kind of pick a team that's diversified enough to be able to capture, identify, source, and underwrite those type of opportunities. Typically, if I fall back into what happened before the pandemic, we would have a business plan. We would be looking to fill in holes in our portfolio. And what I mean by that, looking for strategies that complement our existing portfolio, match those up against which sectors are providing the best risk-adjusted returns. But in this type of environment, again, we pretty much are leaning on the expertise of the distress managers that we are aware of and those new ones that we're targeting. I guess it's not a surprise to anyone if I said, we're not going to be doing a retail-only fund anytime soon. Similarly, hotels. I think that those are probably common words of wisdom right now. I think people are waiting for greater visibility to occur in the markets, and we're no different.
Thank you. And now we'll turn to the rest of the panelists. Are there strategies and sectors that you are currently underweighting or not pursuing it at all? And can you just comment on whether this is the result of the pandemic or this was just something that had been evolving and you're just continuing in this direction? And anyone can start.
Yeah, no, sure. So it's a mixture of everything, Janet. And I'll definitely follow up on what Yvonne said. I think she's absolutely right. I mean, look, this is pre-COVID and post-COVID are different times. But there are some things that were transpiring before COVID, and that's where COVID accelerated. And there's some things that are very much COVID related. I think the thing to keep in mind is this has similarities to all prior crises. Like things have all similar things that transpire in the way that they happen. That said, this is very different than what we experienced during the GFC. The GFC was really a liability crisis. This is a revenue and demand crisis. So the result is it's uneven in the way it affects things. And there are certain things, honestly, that are doing great, right? They're doing better than they did pre-COVID. So the question is, how do you play that? So we know this, like things like industrial. Now, that was a trend before, that was happening, but now that's happening even more so. Data centers, storage opportunities. Those are certain residential strategies like manufactured housing. We saw that before; it's accelerated. So how do you play that now, given that there's so much demand going after it because it's got good fundamentals? So that's a fundamental-driven strategy that had legs before and accelerated. And how do you play that? So we're continuing to play that. We played it before, we're playing it now. And that'll be true. On the other end of the spectrum, again, following what Yvonne said, some of the things like, retail, we saw problems before, but that said, what we didn't see before were the things that were happening. For example, it was all about experiential retail. We were all excited about experiential retail. We're not very excited about that right now. It's a real problem. So how do you play that today? I think to Yvonne's point, you almost don't. I mean, it's very, very hard in this environment until you could assess demand. But hospitality is different. That is a distressed asset class that you typically want to buy, or can be. It is right now, or get involved with at a bottom of a cycle. So you're going to see a lot of activity in hospitality, but not right now. I think the biggest difference between what we saw before during the GFC and now, and I'll turn it over to my colleagues, the last crisis was all about capital flows. There was no capital, right? The debt markets dried up, equity markets dried up. And so it was really like a very tough time for a long period of time to get anything done. But that meant everything was at distressed pricing. This is very different. There's a lot more equity in the system going into the crisis. Assets had a lot more equity in generally, like 70% leverage during the GFC, 60% now. Very different. So you have a lot more equity in these assets, and you have so much more dry powder chasing things. So I think this, unlike last time where we saw a lot of assets trading hands, you'll see some of that, but you're going to see a lot more about capital infusion opportunities. You're going to see opportunities to provide rescue financing and those things. We saw some of that in the GFC. It's a lot more of that now. So that's the way we're thinking about the market. Very different for different kinds of asset types. Different than the GFC and the way it's going to play out, and all the things in the middle, like office and multifamily. Multi is going to be fine. It's going to have some of the things, but it's going to be fine. Office, we'll see, and it's going to be an interesting ride. But let me turn it over to my colleagues.
Thanks. I guess I'll go next. I'll try to expand on that with everything that Yvonne had said and Peter. I think the key here, if you're trying to identify what are you not targeting now, is thinking about how uneven the impact of the pandemic is on different property types, how long-term they are on top of that, and the result you have a sequencing of niche property types and major property types that are impacted by the pandemic and the associated recession, that are experiencing different levels of distress and will have different patterns of recovery. So for us, it ends up mapping out in more of a timeline of what's going to be more actionable. And at the moment, the things that are more actionable that people will be actively targeting, whether it's ourselves or our clients for investment, some niches that have been clear winners. Some of the things Peter mentioned, data centers, cold, life sciences have all seen a lot of increased demand, limited supply, a lot that needs to be developed for those property types. Some of the major property types, industrial, logistics, dry warehouses have seen more demand. Not a lot of gas, not a lot of real prices. So it's a sector, and multifamily to some extent too is going to see good long-term demand. Those are sectors that should generally overweight in a lot of institutional portfolios, but those are not new trends. Those didn't start with the pandemic. A lot of institutions had started increasing their exposures to those sectors already, so they're not chomping at the bit to add more at the moment, but they may as their portfolios go over. I don't think a new strategy there is going to be met with a lot of high demand, except for the investors who are currently pretty underweight. Office is going to be a little bit further out. It's going to take a little bit longer to see how this are very long term. It takes a while for trying to reveal current value. It'll take a little bit longer to see how leasing patterns have really changed in the marketplace. There may be some opportunities there, but it's not clear yet. How it's going to be, whether it's just pricing, whether it's significant reduction in the total inventory. And I think hospitality is an interesting one. Clear distress that could come at any point along the cycle. There's a lot of distress. Some people will believe in a recovery, some early signs, target it. Others, may wait to sit out because it does inherently have a lot of volatility with the shortest term leases of any property type. And I think retail, unfortunately, is going to be at the very end of the folks. It's certainly distressed. It didn't pandemic, the excess supply. But I think if you're to ask us what we're going to not targeting today, we're not actively targeting retail. Recognize there's a lot of distress there, but it's going to take a lot of time, more than months or quarters, probably a year or two at least, to really see where retail is headed as an area for new large scale institutional capital to be deployed.
Yeah, thank you. And I would gather that it's pretty much the theme all around. For Tom and Ishika, maybe it's a little different take on the question, but it's similar to what Yvonne was answering, right? Are there have you observed any LP trends or preferences that have shown a shift or change in direction for LPs, for your clients?
Yeah, I would say that the LPs have been pretty much in line with what was discussed, which was just outlined by my colleagues here. It's not really too secret which sectors are most attractive and which ones everyone wants to stay away from. I mean, retail was kind of a mess going into the crisis, and then it just got accelerated. The distress there by the crisis. I think office, which was mentioned earlier, is the visibility is the problem there.
Right.
Nobody really knows what is going to happen with demand, whether it's going to shift to the suburbs, whether there's just going to be less demand in the office space, what kind of permanent issues are going to arise with leasing in that space. Industrial, of course, is very strong and has been even going into the crisis. That's an area that, unfortunately, on the good side, it's strong. On the bad side, everybody kind of knows that, and it's very much in demand, and so it might be harder to generate the kind of returns you want to see there, but it will be pretty safe. I think we are looking at the kind of the supply side, and because it is quite easy to build industrial property in certain situations, so I think you have to pick your spots there. Multifamily is also there's a kind of a couple of different areas that are very attractive there. I think LPs are more interested in that sort of B workforce type housing, or maybe professional housing, and probably in southern markets and in suburbs, if you had to kind of just parse it out that way. The thing that was really popular going in was the urban, kind of the high-rise urban properties, Class A. And I think those are out of favor right now. They will be back in favor, but I think that's all going to depend on when this pandemic wraps up. And I think that's the interesting part. What we're looking at now is a situation where, we could possibly see ourselves in about 6 months being back to some sort of normal if these vaccines work out and if they're distributed properly and widely. I mean, that might not happen, but I think that the distressed opportunity, the window might actually shut next year or slow down. So I think that's just something we got to see how that plays out. But that's the LPs are basically thinking along those lines, at least our LPs.
I'd just like to add, our house views are very similar as well. We don't expect this crisis to be as severe as the last one. We're just better capitalized, and most of our portfolios have a substantial dry powder. We also don't have the same concerns about oversupply and over leverage that we had back in 08. In terms of the sectors that we are focusing on, I would echo that we are and we have continued to focus on industrial and apartment. We had been tilting client portfolios into these sectors for, I would say, over the past 5+ years. And we have actively placed capital into apartment and industrial. Another theme that Yvonne mentioned that has emerged during this pandemic is that we are placing capital with managers that are positioned advantage of market dislocation. Opportunities are more attractive now than they had been over the past few years, as there had not been an abundance of distress. Earlier on, when we went into these lockdowns, we shifted our focus to non-core funds with blind pools or funds that did not have a lot of exposure to pre-COVID assets. We believe that how dynamic the situation is going to be over the next year or maybe even longer, broad-based opportunity funds that have flexibility to invest in both public and private markets can and do look very attractive. And some of the recent investments that we have recommended have been with managers that have the ability to underwrite distressed.
Okay, thank you. I think we have a timer here, and it may start to get a little short. Why don't we turn it to fundraising and sourcing new deals? I mean, this pandemic has pretty much halted all travel, at least for New York City pension funds and for our staff. But how has sourcing new funds and opportunities changed in light of COVID for you, the consultant, and for Peter? And I'm thinking that, for in terms of emerging managers, we rely on, getting to these conferences and having like one-on-one meetings face to face. So how are you now looking to meet and source new opportunities with new management in light of COVID?
Jay, you
And Peter,
want me to start?
you can start. Yep.
Interestingly enough, and I'll be curious, but I have a hunch my colleagues are going to feel the same way. It's actually been more intense rather than less. This technology that we're all using today it has its limits. Everyone on my team will laugh because every day they see limits that I have personally with this stuff, but it is, it's true. But it's, that said, the accessibility to people all the time, at all hours without travel is extraordinary. And that's true on the capital side, and it's true on the investment side, it's true on the asset side. You could do a lot and you could reach out to people, you could get in touch with them. And so we're booked all the time. I think for all of us here, the conferences are phenomenal. A lot of it's confirmatory. You see people again, you definitely meet new people. But since we're all in the business, our doors are open virtually. We find people and they find us, and I'm sure it's true all around. So it has been very, very active from a sourcing perspective. At first I was a little concerned because we had a deep pipeline and it was great. I was like, well, what's going to happen as the pipeline rise up? The pipeline has been replenishing itself continuously. So we're seeing a lot of people. So that part is good. Again, at first I was a little nervous at how you establish relationships when you can't meet them. And there's limitations on that. But you know what? Shockingly, we've moved forward with groups that we have never physically met. And so it's feasible. The last thing I just say, just from the emerging manager perspective, particularly, is just from a capital raising. If you look this year, for everything that's closed, it's actually, believe it or not, on par with last year because there's a lot of stuff that was in the pipeline. So it is broadly in the market. There's been a lot of capital raised. A lot of that was good leading into it, but then a whole bunch of new stuff came in that was distress oriented. The vast majority, almost all of it, is going to established managers. Very little is going to new managers. So that's the hard truth about it, because it's, funds are being raised by established firms. particularly because they have experience in distress. They demonstrate it. They have these relationships. So we're seeing that even the top 5 have an extraordinary amount of it, but a lot of them do and are continuing to raise money. What I would say that the emerging managers do still have the advantage of, or an advantage, is that they are very good at finding niche opportunities or smaller opportunities or digging out things that are smaller. And that has people interested, as LPs interested, has us interested. So I think that's going to be the what the EMs are going to have to continue to demonstrate, that they find stuff in this market where a lot of capital has been raised to go after distress. It's not going to be easy to compete in that stuff for anybody because there's too much capital. So the EMs will have an interesting story and they'll have to capitalize on it, but I think they can.
So Peter, I also know, no, yeah. I was just going to note the fact that I think your group is traveling to actually diligence, right?
So
Sites,
we did.
You're
You're
going
right.
on.
Well, a couple of colleagues who they got to travel. They just got to, but
you got to get out there.
They get out there. It hasn't been much, but it has been in some more recently. Certainly in and around the summer when it's a little bit better. I think right now we're not going to do any travel right today, but we have been doing some traveling. Other people will talk about this, but there's a fair amount of drone activity. You can see a lot of stuff at your desktop, but there are some big things that we're trying to do, and there's just no other way to do them other than to get on the road and see it. One of my colleagues, Mo, just said, I got to get to these assets, and he did. And so, we're going to do some of that, and we'll continue to do some of that. So, yeah, it's just not the same volume of it.
Okay. Dave, are you, what do you, yeah. Is Dave frozen? No, I see him. Dave, has anything that you can add or would like to add, or Ishika as well?
Sure. On sourcing, I'd say one thing that's starting to happen as a bit of a small trend now, I think will continue to grow, and this has some similarities to the GFC, is that sourcing new emerging managers is increasing through spinouts, or people are leaving established firms where they get into a lot of importance. Because emerging doesn't necessarily mean inexperienced; it just means setting up, as a new sponsor entity with the right backgrounds and the right strategy. So we are starting to see some folks step out their big established institutional and new programs, new investment funds. The challenge will be getting capital and having a strategy that appeals to LPs, and having the funding and the overhead runway to get to a close for your fundraise. That's not going to be quick. It's going to take some time. It's going to be on what property types or regions you're targeting, as we discussed earlier. But it's probably going to be at a time where if you're picking something that's got a bit of distress element to it, we'll have some reset prices and better tailwinds for the years ahead. I think we saw other spinouts throughout the cycle, but it's much more challenging to be raising your second fund as an emerging manager right now with a pre-COVID portfolio that's got a lot of write-downs, and the write-downs are not unique to emerging managers, but the time and attention to deal with the asset management challenges is going to be very challenging for lean and mean teams. So I think you will see a proliferation. And the good thing is, when they're spinouts, we have some familiarity with the team already. So the challenges of in-person meetings can be offset by a lot of technology that Peter described.
So I'll just ask one other question, because this is, I guess, just listening to some of the conversations earlier today. Can you talk a little bit about the environment for diverse managers? What do you see right now as far as diverse emerging managers? Is a cap, are they coming out? What are their stresses right now? And are you seeing any trends? What are the trends that you're seeing, rather? Peter, why don't you, if you can.
Sure. So the trends are, I think, a real strong sense that I haven't seen in as much before on the part of LPs more than anything else to really find diverse managers. There's always been an interest, but now it's much more palpable. It's much more intense. There's a lot of conversation at all the organizations, you name it. And it's sort of like, we need to get serious about emerging managers. We need to get serious about diverse managers. And it's funny, like we all talk about it amongst ourselves, right? This whole group here. And we know there's a deep pool of diverse managers out there. And yet when we talk to a lot of the other people in the industry, they're shocked. They didn't know. And so that's exciting. That's different, and I see that continuing to grow. I think the challenges. Do I think the challenges are any more unique for diverse managers today than they were before? I'm not so sure. I think the challenges overall right now are always capital coalescing around a strategy are hard. First-time funds are hard. So where diverse managers I'm seeing, like certainly with all of us, are having success. Is being really good at finding opportunities and bringing them and doing one-off deals and doing joint ventures and getting active. And we're seeing, so I think that's going to have more and more legs. I think we're going to see more of that. And I think we're going to see LPs proactively push to make this happen. And once that starts to happen, you're just going to see a lot more of this. And I think that part is great. But it's always getting started. That's always the hardest part. And sometimes people talk a big game and then they don't always follow through. So it's on all of us to try and make sure these things kind of happen and we don't lose momentum. But this is, I feel, and I'm not trying to just, be hyperbolic, but it's a sea change that I feel. And I think this is different. So I think that's good. We should just capitalize on it.
Okay. Thank you. So we are starting to run out of time and we haven't gotten to our slides on process. So maybe we can just jump ahead and we can start with Yvonne. John, Yvonne is going to be speaking to this, but I just want folks to understand that, if they are seeking capital directly from us, there is a process that everybody will need to undergo, and that's a dual underwriting and diligence process by the New York City Comptroller's Office, as well as each of the consultants. And so Yvonne will kick it off. For early stage managers, we, as I've explained already, we now have a relationship and a partnership with GCM Grosvenor, and Peter's going to cover that. So we will quickly go through each of our processes here. Yvonne will start this page.
Great, thank you, Janet. So this process is utilized for all of our investments. Emerging manager, existing relationships, new large managers, everybody is subject to this vetting. So I just want to say that first off. We created this slide to give you an overview of the New York City process. Overall, it's probably 6 months between the time we take a look at you in an earnest way and bring you through our process, which would culminate with a board meeting and a decision by our trustees. So as I mentioned before, we're touched by emerging manager community, the manager community, and so many different ways. Um, if you contact us directly, we will definitely get back to you. But I'd like to manage expectations here, and that, if you send us an email, if you send Alex an email and you propose a call for next week, that's not going to happen. Okay, so if you want to introduce yourself, that's fine. If you want to send us some materials, that's fine. We have an open door policy, and we will respond to you. That response might take about 6 to 8 weeks, but you will get a call, and in that call, you will get some constructive feedback by some of our team members, which more than likely include Janet. In the rare instance that the team decides that they're going to underwrite it themselves as opposed to Grosvenor, this would definitely be the process that would be undertaken. So, there's internal conversations as to the merits of the investment thesis, whether or not it complements the existing portfolio, whether or not the strategy offers compelling risk-adjusted returns. And, if we agree with that, we start digging in a little bit further, collecting information about the manager, taking a look at their track record, their team, their platform, some of the things that you would normally look at. And before we really invest our time, there is a meeting that's set up with a subset of our investment committee. And this is, I'm addressing right now the gray vertical. It's a meeting, it's called a green light, and essentially it's a go, no go, right? So are we going to spend time on this manager? Because as you can see, we only have 7 professionals amongst us. And so we really try to use our time prudently and efficiently. So this meeting helps us because it's a preview as to whether or not our colleagues and other asset heads, and in particular, our CIO and deputy CIO also agree with us that this strategy has merit. So a green light meeting would be set up. It's essentially a 1 hour pitch session. And if the outcome of that is positive, the team really starts to dive into their diligence. I would also say that on a parallel track, as Janet mentioned, the consultant that's representing that system, and it could be all systems that are looking at a particular investment proposal, or it could be one or more. But there will be parallel diligence going on between the BAM team and the consultant. So here I just want you to be prepared for the fact that you may be asked the same question by different people. So just be patient with that process, because each of us is processing that information and will be producing an independent diligence report. So it's not as if someone didn't hear you and you have to repeat yourself. There are concurrent processes going on. So as we do our diligence, we are preparing essentially a recommendation, a due diligence report that the team will bring to the investment committee. That investment committee is comprised of the CIO, the deputy CIO, and a rotation of a number of asset heads. Also, there's input from our legal team, input from compliance, input from risk, and also during the diligence process on the BAM side, in addition to the diligence that the team performs, they will arrange meetings with you with the special teams here at BAM. There's a special team for risk, for compliance, for operations, and they all conduct their separate diligence calls in their areas of expertise. All those findings are rolled up into the BAM due diligence recommendation that's presented at IC. And if that outcome is favorable, we bundle that up together with the consultant report and start to prepare a board package, and we'll designate a board meeting where that recommendation will be presented. Again, the BAM team, the consultant, and the manager are at the board meeting to make a presentation, and the trustees will vote yes or no. And, essentially, that's the process from the BAM side.
Thank you, Yvonne. Can you just forward one? And Dave, can you take through your process?
Yes, I'll try to make this quick since we're running short on time. So this slide doesn't lay out our timeline and our process. It's very similar. It'll be repetitive across a lot of the speakers today, but I'll just give the audience a sense of how our process fits into the New York City process, which is we have 2 committee meetings instead of the 3, but we're completely done before to be finished before New York City is ready to go to their investment committee. And we may start our initial meeting getting to know a manager at any point. But we try to make use of all the existing material you have, your presentations, your EPM, information you've put up on a data site. We'll try to make as much use of that as possible to get to our first committee phase, which is where we would be approving formal diligence on behalf of one or more clients. So if we had other clients that were interested in your fund and we'd be starting diligence on that timeline. But if it's only one of the New York City systems that's going to be pursuing it among our client base, we might have met you a year ago. We might like you. We might not be making a lot more new information requests because we're waiting until the green light giving us the go sign that there is real interest there. At that point, our formal diligence would begin, and that's a very long process. On our side, it's a lot of information that we're requesting that you may or may not have on hand. It may require a lot of resources to respond to. So we don't want to begin that unless there's some real confirmed client interest. And the things we're looking for all along the way, but definitely we're going to be memorializing in our underwriting are on this page. And I won't go through all the items, but you can see broken into four categories here, looking at the organization, the investment strategy, your past performance, whatever types of investment experience and track record we might be drawing on in lieu of direct track record if it's a Fund 1 launch. And these things you should be able to answer clearly and pretty honestly. I'll point out something, in the team organization, the ability to source deals and add value. Don't give a generic response or something that's not a true competitive. I earlier someone's resources included a Bloomberg terminal and the intention to subscribe to an S&P Global Intelligence Service. That's not going to give you any different information from the rest of the people going after the same opportunities. At the bottom on structure, I'd say this is a great topic. If you are looking for feedback from consultants or even the BAM team, you may get a lot of helpful guidance here because we've seen hundreds of funds in recent vintages and can share with you what terms are. It may help, especially if you want to minimize the friction in later stage negotiations as you advance through the process. So I'll probably pause there. Maybe one closing thought is that 2 items that are not on this page are operational due diligence, which is a thorough process for, but it's something where I'd say we can be very constructive. We can help an emerging manager identify areas that need to be improved or increased, policies or these. It's an area where we recognize that bringing a new organization means that you're not going to have the same breadth of operational infrastructure as somebody on Fund 9, but it's somewhere we can help. The other is that ESG factors are integrated in all of our diligence process from finish. So that's the box here, but something that can appear in all different parts of the organization and the investment strategy. So it is important to an increasing number of clients, and it covers a lot of factors, including diversity that Peter highlighted.
Thank you, Dave.
I can say a few words on our process. We follow a very similar process for due diligence and recommending investments, has been discussed by Yvonne and Dave. We have a very robust and highly selective investment process. Of the hundreds of investments that we are evaluating in a year, we have invested in less than 5% of those. So typically, we have the investments go through, different phases in a due diligence process. I mean, managers typically have to register in a database, provide us with a PPM, and also complete a due diligence questionnaire. We have a team that, we not only have a team located in the US, but we also have offices in London and Hong Kong. So we do take a look of the entire canvas of opportunities globally. Once we complete our initial due diligence, the process moves into a more in-depth look of the manager's experience, tenure, investment process, back office, alignment, deal sourcing. And we also present all investment recommendations to our investment committee. So before we recommend an investment to a client, those investments have to be approved by our investment committee.
We'll go as fast as possible here because we're running out of time. Our process is very similar to everyone else's. I would just note that we source deals, we source emerging managers through pretty much our entire organization. We're global. We have offices all over the world. We have client representatives, client people, professionals who work with clients every day, know what they're looking for, understand the emerging, what their desires are in terms of emerging managers. So a lot of the ideas we get come straight from internal people talking to clients, and then clients surfacing these ideas, which we can then, socialize amongst the larger group. Our process starts with kind of an initial meeting with the real estate team. We do what you could call it a green light memo. We call it an insight. It's basically that gets run through our entire process. All the information that is given in that meeting and the notes are put into our system, so everyone has access to that information. Once we get through that green light process, then we can engage in trying to find a home for a particular investment. So, being mostly an advisory shop, we do need to find client interest to be able to move forward. And then once that happens, we move to the investment due diligence process. I would just make a couple of notes there. We do have a very large operational due diligence group, which actually works in parallel process with the investment due diligence. And then they have a veto right, basically, on operational considerations for any deal that goes forward to the investment committee. That group has actually been a lot of help, a great resource actually to emerging managers, because these are areas where emerging managers tend to have a lot of questions and may not be as strong. So the kind of that process tends to be very helpful to them. As a matter of fact, the other day, it wasn't a real estate fund, but I talked to an emerging manager in the specialty finance area who was asking about where they could go to get kind of an overview of the compliance and operational diligence issues that they should be looking at, because they're raising Fund 2 and they need to get stronger there. Last thing, our investment process, the due diligence process takes about 4 to 6 weeks, depending, sometimes longer. We ask for all the same things everybody else does: a full DDQ and a track record. And I would say the track record is the area where there tends to be the most difficulty for most emerging managers to put together, just because they haven't done it a lot, and they might, there's a process to it that the more established managers understand. So that's an area that we tend to have to do a lot of counseling on. And that's our process.
Thank you. Thank you, Tom.
Okay, so we'll finish up with this. So let's talk about our process from the perspective first of how we evaluate or what we're looking for through this process. And we kind of break it down to 4 different levels, where we think first and foremost, what is a group that comes to us like as an investor. So we look at the deal level, how they source deals, what kind of deals are they investing in, how they create value at the deal level. And so obviously we're looking for your track record with respect to that. But then we also are thinking about you as a portfolio manager. How have you put portfolios together? How have you thought about risk? Where is return coming across the entire portfolio? Is it all the same? Is it all on the buy? Is it on the sale? Something in between, a little bit of both. So those are the kinds of things we're going to evaluate. And very often when we see track records, it's highlighting like, look what we did on this deal. Look what we did overall. We're really going to dig in to see what you did at this portfolio level and how you created value. Then we go further to the extent you have done a fund before, or if you are going to be trying to raise a fund for the first time, how do you think about being a fund operator? It's not that easy. There are lots of things you have to have mechanically set up to do these things. And so part of the process is making sure you understand that and you have these things put together, or you're on your way to do it. You've done this, you've conceptualized this, and you're able to perform at that level. But it's also, how do you return money? How do you reduce gross to net spread between your deals and what you're getting actually to investors? Because those are 2 different things. And then finally, how are you thinking as a fund manager? Are you fiduciary? Are you thinking about this as investing other people's money, not yours? And that's a longer term process to think about. When we think about how to invest with you, we're thinking about all these things. And then we say, you know what, it's going to be a number of things that we're going to consider. And we invest in multiple ways, as you can see. It's a very open architecture approach. It could be at the deal level. It could be a portfolio. It could be a fund. We could anchor. We could provide GP capital. It could be very dynamic in terms of a solution. Sometimes it's a bunch of those things. And so that's all part of the evaluation process. And it's something we work with New York City quite a bit on. At the bottom, we detail a little bit more of the process on this page. It's very similar to what my colleagues talked about. There are different stages, and you can imagine what the stages are. I think the most important thing is just you're going to expect to share a lot of stuff with us, and including your models, including your investment memos. A lot of times people say, "Oh, that's proprietary." It can't be. And trust us, we've seen a lot of stuff. So nothing you're going to show us will surprise us. We'll keep it all in confidence, but we need to see these things. And as we dig deeper and deeper, it winnows down further and further. And there are multiple levels of processes that go through this. It can be very quick. It could be, weeks on a deal, but typically you should expect a time, because we want to establish a relationship, and it's going to involve New York City as well, and conversations with them. So you should expect this kind of process until we get to the end. I think with that, Janet, we have all 3 minutes and 20 seconds for questions.
Thank you very much, everyone. We are, so our esteemed colleague, Jackie Lee, I don't know if you can hear me. Apparently there is one question in the chat box. Jackie, are you on? There we go.
Yes, I'm
Jackie,
on.
can you hear us?
Yes, I can hear you guys.
Have we received more? Yeah, we hear you.
Yeah, so we actually received 2 questions in the chat box so far.
Okay.
The first one, the first question is if there are particular sectors that that we would favor investing in Europe, but not the U.S. or Asia. So anybody could chime in for this question.
Well, maybe I'll take that because we've got 14 investment professionals in Europe, so we're pretty active there. Interesting differences. I don't know if it's an absolute difference of a sector a property type we would definitely do in Europe and we wouldn't do in the US, but we might have more appetite for some things in Europe because you do have in office, for example, a lot more limited supply historically and going forward. So there may be different funds there. Another example is in niche property types. In senior housing, for example, you see a very different level of integration with the government system, government hospitals in using senior housing, senior care facilities as an extension of hospitals in the UK, which is not quite how it works in the US. They're very separated. So some of the demand and stability may be better for care than it is in senior housing in the US.
Thanks, Dave. Can I just add that it relates to emerging managers. Our program is a US-based program. We would not be, at this point in time, be looking outside of the United States. Can we go to the second question?
Of course, sure. The second question is directed for Yvonne and Janet. What are the near-term investment priorities? Any underweights that you are looking to address in your portfolio over the long term?
So I think that we kind of talked about this. So I would say that our thumb is on the scale on industrial, but fortunately we have been introduced to some very compelling industrial opportunities over the past 3 to 4 years that has helped us significantly in addressing that underweight. The other thing that I would mention is that we are closely monitoring the multifamily sector. We probably have a meaningful amount of multifamily, but given the need-based attributes of that strategy, we will definitely continue to invest in this sector as there's, greater visibility going into 2021.
Thank you. Thank you, Yvonne. So we've ran out of time. I would say that this concludes our time together, and I really want to thank everyone who has attended this panel, and I want to thank the speakers for just sharing your thoughts and your insights, and I hope that this has been instructive for those folks who are looking for more direction, and hopefully we will see each other face to face next year. And for now, there will be one-on-one sessions with some of the panelists here, which begins at 12. And so I want to thank you, and I hope you are all safe and well, and have a great holiday season. Thank you.
Thank you.
Thank you.
Bye.
Bye.
Thank you.